in creditor Eurozone was matched by the surplus of investment over savings in debtor Eurozone. And, last but not least, the boom in investment in debtor Eurozone took the form of investment in non-tradable goods and services, notably property-related investments, because the most competitive suppliers of tradable goods in the domestic market were those in creditor Eurozone. Symptoms of these divergencies included the crucial divergence in inflation and relative unit labor costs discussed in Chapter 2. The balance sheets of borrowers, including financial institutions, located in debtor Eurozone, became ever more stretched, as those in creditor Eurozone apparently became ever more solid. But this is, in part, an illusion. Thus, the question raised of the global system is just as relevant within the Eurozone. Where did the risks lie in the event of a reversal in willingness to lend? How could debtor countries have better responded to the policies of the creditor Eurozone and the ECB? They had 4 options. 1. Accept the imbalances described previously, through either higher investment or lower savings, and just hope for the best, the policy they actually adopted. 2. Accept the imbalances, but seek to offset the greatest danger by thwarting any significant increase in leverage within their own financial system, which the Spanish central bank sought to do through dynamic provisioning inside the banking system. 3. Tighten fiscal policy sufficiently to reverse the market's effort to generate a huge current account deficit, tried to a limited extent by Ireland and Spain. Or, finally, 4. Impose controls on imports of capital or of goods and services, precluded by the rules of membership of the EU, not just of the Eurozone. The idea that debtor Europe had some simple way of avoiding the disaster is a fantasy. With the Eurozone in internal and external balance, and creditor Eurozone seeking internal balance via ever larger external imbalances in the form of current account surpluses, debtor Eurozone could only attain internal balance with ever larger external imbalances in the form of current account deficits. Debtor Eurozone had to choose between unemployment and debt. In practice, it chose the debt first and got unemployment afterwards, when the crisis washed away the debt path. To regard the behavior of the creditor countries as axiomatically prudent and that of the debtor countries as axiomatically profligate is asinine. After all, the borrowing would have been impossible without the lending. It is stupid to finance profligacy and then complain about the consequences of one's own choices. Yes, the Greeks should have paid their taxes and run their government more responsibly, but the fact that they behaved in this way was really no secret. Caveat creditor, let the lender beware, is a good motto. The result of the imprudence of both lenders and borrowers is a rolling crisis characterized by prolonged recessions and resentments in debtor Eurozone and exasperation in creditor Eurozone. The result that we also see is a profound set of political and policy challenges. Underlying drivers of the global shifts. The emergence of the global savings surfeit and associated global and Eurozone imbalances were huge events for the global economy. So too was the failure of investment in the high-income capital importing countries, particularly the U.S., to employ productively the surplus funds imported from the outside world. Instead, the resources were wasted in building unneeded and unaffordable houses or in fiscal deficits caused by unfunded wars, unfunded entitlement spending, and unfunded tax cuts. The capital imported by the U.S., in particular, was wasted on a colossal scale. What were the deeper forces behind these huge shifts in global patterns of saving, investment, and capital flows? The answer is to be found in 3 transformations. The first was the shift towards economic liberalism, the embrace of the market as the organizing principle in economic life already discussed in Chapter 4. Back in the 1970s, the high-income economies mostly still had extensive regulations on product markets and even employed direct controls on wages and prices, either permanently or temporarily. Marginal tax rates on high incomes were above 70% in both the U.S. and the U.K. While the high-income countries had substantially liberalized trade in goods in the 1950s, 1960s, and 1970s, trade in services was still highly restricted, and most countries retained foreign exchange controls. In developing economies, controls over markets were far more extensive. Many economies also had high levels of public ownership of industry. In India, the economy was constrained by what had come to be known as the License Raj. In the socialist economies of China, the Soviet Union, and the Soviet Empire in Central and Eastern Europe, comprehensive economic planning and public ownership remained in effect. The developing countries and socialist bloc also imposed comprehensive barriers, including high tariffs, on cross-border flows of goods, services, foreign direct investment, other capital flows, and people in both directions. Ideas and associated events transformed this world of closed and highly regulated economies into the globalized and liberalized economy of the early 2000s. Arguably, the most important change was the embrace of reform and opening up by China after 1978, under the leadership of Deng Xiaoping. The election of Margaret Thatcher as British Prime Minister in 1979 and of Ronald Reagan as American President in 1980 began a revolution in the high-income countries, including privatization of what previously had been publicly owned companies. The European Union's Single European Act, triggered partly by the desire to inject economic vigor and partly by the desire to relaunch the project of European integration, was agreed in 1986 and started to move towards a single market. The Maastricht Treaty, ratified in 1993, put the EU on the path towards the abolition of exchange controls and the currency union, which was launched in 1999. In 1989, the Soviet Empire in Central and Eastern Europe collapsed. In 1991, the Soviet Union abandoned communism and disintegrated. In the same year, India began a process of extensive external and domestic liberalization. The Uruguay round of multilateral trade negotiations was then completed in 1994. The World Trade Organization replaced the General Agreement on Tariffs and Trade in January 1995. Consequently, China joined the WTO in 2001. This was a resurgence of global capitalism. The second source of the underlying transformation was technology. Changes in transportation technologies during this era were not dramatic, though developments and improvements in container ships and high-volume air freight were significant. Improvements in information and communications technology, notably the personal computer, the Internet, mobile telephony, and the mobile Internet, were of far greater significance. These revolutionary developments permitted the organization of production and distribution across the world on a more systematic and timely basis than ever before. That, in turn, provided the opportunity for the accelerated development of export-oriented manufacturing, notably from China, and export-oriented information technology services, notably from India. The third and least important source of transformation has been aging, notably in Germany and Japan. As populations aged and the proportion of young people in the population rapidly declined, the need to invest in new infrastructure and capital equipment shrank. Meanwhile, corporate and household savings generally tended to remain strong. The result has been chronically weak demand. This weakness in domestic private demand was then offset either by prolonged fiscal deficits, as in Japan, or by large current account surpluses, as in Germany, the Netherlands, and other northern European countries. These three underlying drivers, liberalization, technology, and aging, proceeded to shift the world economy into a new shape, one that created huge gross and net capital flows across borders, growing inequality within countries, radical shifts in the location of investment, and the rise of liberalized credit. These shifts led high-income economies into secular stagnation, a world of structurally deficient aggregate demand identified by Lawrence Summers, the former U.S. Treasury Secretary, following the Keynesian Alvin Henson, who invented this term in the 1930s. These forces in turn help explain the low real rates of interest before 2007 and the still lower real rates after the crisis, which was caused in large part by the policy responses to pre-crisis recessionary forces. Let us start with trade. Without the explosive rise in global commerce, and particularly the growth of exports and production in emerging countries, especially China, the scale of the imbalances could not have emerged. This rapid growth in trade, driven in turn by liberalization and technological change, was also associated with a rapid shift in production from high-income economies to cheaper low-cost producers. China emerged over a remarkably short time as the world's largest manufacturing company and largest exporter of goods. This was the first time since the Industrial Revolution that a still relatively poor developing economy played such a huge role in world production and trade. That was made possible by the ease with which know-how could be transferred across frontiers. That, in turn, followed in part from the rise of integrated global companies, which were, themselves, the product of liberalization and improved information and communications technology. Consider also the rise of state capitalism. The emergence of economies open to trade and financial flows allowed net, and as we shall soon see, gross capital flows to reach levels relative to global and national economies not seen since before the First World War. Yet, somewhat paradoxically, many of the new cross-border investors were governments. The emerging economies of East Asia, again, particularly China, and the oil-exporting economies as well, directly controlled their countries' integration into the global financial system and managed their capital outflows. This showed up in a huge increase in foreign currency reserves. It showed up as well in the rise of vast sovereign wealth funds, which, for lack of other high-quality, liquid, and apparently safe opportunities, also put most of their assets in the markets of high-income countries. While economies became more open, states played an enormous role in determining the scale of net capital flows and their corollary, the balance of trade. Of those states, China was the most important. There was also the shift into structurally low inflation. Globalization seems to have been one of the most important explanations for this development. Kenneth Rogoff of Harvard University, for example, argued in 2003 that the most important and most universal factor supporting worldwide disinflation has been the mutually reinforcing mix of deregulation and globalization, and the consequent significant reduction in monopoly pricing power. An aspect of this was the fall in dollar prices of many manufactured commodities and labor-intensive services, such as call centers. This, in turn, was partly due to the entry of low-cost producers in the world economy on prices, and partly due to the rapid decline in the prices of anything incorporating information and communications technology. Moore's law, which is the exponential fall in the cost of computing power first noticed by Gordon Moore of Intel in 1965, continued to operate. In itself, the fall in prices should not affect overall inflation in the medium run. It may, however, generate a short-term gain that allows central banks to hit their inflation target more easily. Taken together, these changes in market conditions not only permitted, but encouraged inflation-targeting central banks to pursue aggressive monetary policies without having to worry much about inflation. Those policies then supported asset prices and associated credit growth. A further crucial change has been the rise in inequality, driven by both rising inequality among working people and rising shares of profits in national income. The changes have, as discussed previously, been large. Yet, while there have been clear rises in inequality in the high-income economies, notably inside the U.S., this has probably not been true for the distribution of income across the globe as a whole. This is because the economies of some big, poor countries, China and India above all, grew faster than high-income countries, offsetting the general rise in inequality within almost all countries. Indeed, it appears from the work at the World Bank that the clear losers from the economic developments of the last 3 decades have been the lower and middle classes of the high-income countries, whose incomes fall between the 75th and 95th percentiles from the bottom of the global income distribution. The forces driving the rise in inequality are complex. Technology helped create winner-takes-all markets, in which the most successful and productive participants could reap the lion's share of the gains. This became notably true in the high-tech sector and in finance, which emerged as the most dynamic industries in high-income economies. Technology also increased the relative demand for skilled workers and lowered the demand for less skilled ones. Globalization directly affected the supply of relatively high-waged but only modestly skilled jobs, particularly in manufacturing. Globalization also greatly strengthened the forces weakening trade unions. Reductions in taxation increased the incentive of managers to raise their pay. The relationship between the incomes of managers and ordinary workers was transformed. The rise in the role of the financial sector also seems a potent driver of inequality. The sector has obtained a substantial proportion of corporate profits in high-income countries and has probably had a role, along with trade and technological change, in the shift in labor incomes as well. The Nobel laureate Joseph Stiglitz stresses the way in which the primacy of market norms has permitted a shift in the balance of power between the owners of capital, managers, and financiers on the one hand, and ordinary workers on the other. One important aspect of this is rent extraction by well-connected elites. That is, the ability to earn incomes over and above their economic contributions by virtue of their powerful position within the economic system. An important proposition here is that the liberalization of credit interacted with rising inequality. Indeed, a chapter in Raghuram Rajan's book on the crisis was titled, "Let Them Eat Credit." Thus, as real income stagnated for a large proportion of the population, liberalized credit provided a way to sustain rising consumption. Soaring house prices also made households apparently able to afford more credit than before. This then led to rapid rises in household debt in many countries, notably the US and the UK, which then became highly problematic once asset prices started falling and economies started weakening. Finally, technology seems to be having another important effect. The prices of investment goods are falling rapidly relative to goods and services in general. This is particularly true for investment in information and communications technology. This means that for any given level of nominal spending, the real value is rising relatively rapidly. Thus, between its nadir in the third quarter of 2009 and the fourth quarter of 2014, the share of private investment in U.S. nominal GDP rose by just 3.9 percentage points, from 12.4 to 16.3%. But over the same period, the share of private investment in real GDP rose by 6.3 percentage points, from 18.3% to 24.6%. Thus, both the level, relative to GDP, and the buoyancy of investment in real terms have been much higher than in nominal terms. This fact must also have strongly reinforced the tendency toward a financial surplus in the corporate sector. This, then, has been a world transformed. The new world economy allowed the emergence of huge shifts in the balance between investment and saving across economies, These, in turn, reflected shifts in comparative advantage in the global location of production, in the distribution of income, and in the functioning of the financial system. Behind these lay even deeper forces: the shift to liberalized market economies, technological transformation, and aging. The economy thus generated has, alas, proved to be highly unstable. Conclusion. The global and Eurozone crises were not only financial crises, they were also crises with far deeper roots. It is essential to make the financial system less fragile. It would then be both better able to cope with shocks and also less likely to cause them. But that is only a necessary, not sufficient, condition for a less unstable economy. The trends of the pre-crisis era were unsustainable, particularly the accumulations of household debt in a number of high-income countries. These were related to persistent global imbalances, and these, in turn, were driven by failures of monetary and financial systems in our newly globalized and market-driven world economy. So, what are the solutions? That is the subject of Part 3 of this book. Part 3. Solutions. Prologue. The crisis put all our thinking about economics, finance, the performance of economies, and the future of the Eurozone into question. The following 4 chapters provide preliminary answers. They show how far orthodox thinking failed and consider in what ways it has to change. First and foremost, this is a crisis of economics, and particularly of conventional macroeconomics. The discussion of the shocks and then the underlying shifts in parts 1 and 2 demonstrates quite clearly that the waves of huge crises which hit the high-income economies was not the result of events outside the economic system, such as an unexpected war or a vast natural disaster. On the contrary, they were the result of developments within the system. Those developments included the expansion of the financial sector, the growth of private debt, and the leveraging up of much of the property assets of a number of important countries. Behind these developments in finance were the emergence of huge external imbalances, massive foreign exchange intervention, and the euphoria generated by the creation of the Eurozone. Yet, while some of this can be laid at the door of policymakers, much of it was the responsibility of the financial system itself and the operation of the vaunted free market economy. So the starting point has to be with the failures of economics. That, accordingly, is the subject of Chapter 6, which is about the failure of economic orthodoxy and the search for a satisfactory replacement. Second, this has been a crisis of the financial system. Naturally, and inevitably, big efforts have been made to tighten up regulation and improve the resilience of the system. These efforts are not insignificant, but, in essence, they are conservative. They attempt to preserve the essence of a system that we already know is extremely fragile, and which is sure to implode once again in our current world of global financial integration, fast trading, and huge flows of funds across borders. So the question is whether one can do simple things that would make the system more or less on its present lines more robust, and if not, what the alternatives might be. That is the subject of Chapter 7. Third, this leads the discussion to the big macroeconomic challenges. How should we manage a world of savings glut, or, which comes to the same thing, excess supply? Is there a real chance of secular stagnation, and if so, what might be done about it? These are, in fact, plausible worries. In particular, our big problem is the addiction to ever-rising debt. And the most worrying debt is not the public debt, with which policymakers are obsessed, but private debt, whose collapse, as we have seen, creates huge public sector debt problems. It's extremely disturbing, however, that the policies being pursued in the big high-income economies amount to an attempt to get the credit machine going again. So this raises a question. Is it possible to balance our economies without such a huge reliance on ever-rising leverage? The answer is yes. This can be done in two complementary ways. One is to close external imbalances. The other is to use the government's ability to create non-debt money. The latter is regarded as unthinkable, but it may in fact be the least dangerous way of running our economy. These, then, are the issues addressed in Chapter 8. Finally, there is the question of the future of the Eurozone. It has become a bad marriage, but one from which it is immensely costly to escape. The question is whether it will be turned into a good marriage, one that all members would join again. At present, this seems highly unlikely. Instead, it will continue to fail to achieve full economic adjustment or provide the basic insurance needed to cope with untoward events as well. Moreover, there is a real danger of falling into a deflationary trap because of the fundamental asymmetrics in the adjustment processes and the failure of the European Central Bank to do its job. This being so, one cannot conclude that the crisis is over. On the contrary, it is perfectly possible to imagine that it would recur. This, then, is the topic of Chapter 9. Chapter 6. Orthodoxy Overthrown. The message London's success sends out to the whole British economy is that we will succeed if, like London, we think globally. Move forward if we are not closed but open to competition and to new ideas. Progress if we invest in and nurture the skills of the future. Advance with light touch regulation, a competitive tax environment, and flexibility. Grow even stronger if this is founded on a strong domestic market built on the foundation of stability. And whether it be in advanced, high-value added manufacturing, our creative industries, pharmaceuticals, digital electronics, in fast-growing education exports, I believe, just as you have done in financial services, we can demonstrate that just as in the 19th century industrialization was made for Britain, in the 21st century globalization is made for Britain too. Gordon Brown, Mansion, House Speech, June 21st, 2006. Why did nobody notice it? Question of Her Majesty Queen Elizabeth II at the London School of Economics, November 4th, 2008. Those of us who have looked to the self-interest of lending institutions to protect shareholders' equity, myself especially, are in a state of shocked disbelief. Such counterparty surveillance is a central pillar of our financial markets' state of balance. If it fails, as occurred this year, market stability is undermined. Alan Greenspan, Testimony before the House of Representatives Committee on Oversight and Government Reform, October 23, 2008. Credit means that a certain confidence is given and a certain trust reposed. Is that trust justified? And is that confidence wise? These are the cardinal questions. To put it more simply, credit is a set of promises to pay. Will those promises be kept? Especially in banking, where the liabilities or promises to pay are so large, and the time at which to pay them, if exacted, is so short, an instant capacity to meet engagements is the cardinal excellence. Walter Bagehot, from his book Lombard Street. On November 4, 2008, at the height of the financial crisis, Queen Elizabeth II visited the London School of Economics, one of the world's leading centers of academic economics, to open a new building. While she was there, she asked a group of dignitaries a simple question. Why did nobody notice it? In response to the Queen's question, the British Academy convened a forum on June 17, 2009. Shortly after these deliberations, a reply was sent to Her Majesty. In brief, It argued that the big failures lay in not recognizing how large the risks were to the system as a whole, how bad risk management was, and how big the mess bequeathed by the crisis would turn out to be. The institutional and political failure was the inclination of both politicians and regulators not to look the gift horse of pre-crisis prosperity in the mouth. This is hardly an adequate answer. It's easy to accept that the timing of a crisis is unknowable. An economic system is too complex for a precise prediction of the timing of a crisis. Indeed, such a prediction, if widely agreed, must be self-defeating. But it is not enough to blame institutional failure, because the institutions that failed were those many economists had lauded, particularly those central to modern finance. This, then, was not an institutional failure, but an intellectual one. The remark at the beginning of this chapter by Alan Greenspan, chairman of the Federal Reserve from 1987 to 2006, underlines this point. Rational pursuit of self-interest is the core ideology of the free market economy. But at the height of the crisis, Greenspan stated the loss of his faith that self-interest would deliver financial stability. It is as if the Pope declared he no longer believed in the resurrection of Jesus Christ. Here is another indication of intellectual failure. On April 8, 2011, at the conference of the Institute for New Economic Thinking, known as INET, in Bretton Woods, New Hampshire, I interviewed Larry Summers, winner in 1993 of the John Bates Clark Medal for American Economists under the age of 40, former U.S. Treasury Secretary and recently departed director of President Obama's National Economic Council. I asked what economics, if any, he had found relevant to the task of putting the U.S. and world economies together again after the crisis. He responded, "There are things economists don't know. There are things economists were wrong about. And there are things where some economists were right. There was a lot in Bagehot that is about the crisis we just went through. There's more in Minsky and perhaps still more in Kindleberger. I think economics knows a fair amount. I think economics has forgotten a fair amount that's relevant. And it has been distracted by an enormous amount." Later in the interview, when asked what he found useful as a policymaker in deciding on the response to the crisis, Mr. Summers referred to Keynes. What did these four thinkers named by Summers have in common? They were all dead, and their work was so far outside the contemporary academic mainstream that they had become Orwellian unpersons. True, central bankers were aware of the great Victorian economic journalist, Walter Bagehot, but his work was gathering dust on a shelf marked irrelevant to contemporary concerns. Many of today's leading macroeconomic theorists, notably including Chicago's Nobel laureate Robert Lucas, probably the most influential of all, regard the work of John Maynard Keynes as embarrassing, and that of the post-Keynesian Hyman Minsky with something bordering on contempt. Charles Kindleberger of the Massachusetts Institute of Technology was an economic historian, and as a result far below the salt where princes of academic economics sat. The economics that dominated academe, and has shaped thinking for several decades, proved useless in predicting, tackling, or even imagining the biggest financial debacle in the world's most advanced economies for 80 years. During the crisis, moreover, the people in authority ran as fast as they could back to Bagehot and even Keynes. Indeed, Bagehot and Keynes on steroids. Yet the fact that a meltdown of the world's most advanced financial systems had occurred for a second time is significant. One Great Depression might be a fluke. A second such crisis begins to look like a pattern. True, policymakers learned lessons from the great economists who had themselves learned from the 1930s. They stopped another depression. But it was still a huge recession from whose effects the affected economies had not emerged 6 years later. So, what went wrong intellectually, and what can be done about it? The failure of official economics. In a lecture given at the South African Reserve Bank on November 2, 2012, Adair Lord Turner, outgoing chairman of the UK's Financial Services Authority, addressed exactly this question. What had economics got wrong? His answer was, the financial crisis of 2007 to 2008 was caused by excessive credit creation, excessive leverage, and too much maturity transformation. The fact that these excesses caused such havoc, and that private incentives and market disciplines failed to check their development, reflects three facts which are fundamental to understanding financial system dynamics and risks. First, debt contracts create specific financial and economic stability risks, and those risks intensify as the proportion of all contracts which take a debt, and in particular a short-term debt form, increase. Second, that the existence of banks as we know them today exacerbates these risks because banks can create credit and private money, and unless controlled will tend to create suboptimally large or suboptimally unstable quantities of both credit and private money. And third, that bank or shadow bank lending secured against real assets, which can change in value, can be even more volatile and pro-cyclical, resulting in credit and asset price cycles which end in crashes and subsequent recessions. The most sophisticated modern economics ignored these dangers because they had been removed by assumption. The workhorse, macroeconomic analytical tool used by central banks was a dynamic, stochastic general equilibrium model, in which finance barely appeared. The underlying models were of movements towards equilibrium in the demand and supply for real goods and services in the economy, not ones in which financial forces had independent effects, on the line suggested by Minsky. Meanwhile, modern theories of finance focused on how markets would or should price assets, without paying attention to the impact of big shifts in asset prices on the economy as a whole. The dominant assumption of the macroeconomic models was rational expectations, and that of financial theory was market efficiency. As Felix Martin notes in his book on money, by ignoring the essential link between the financial securities traded on the capital markets and the monetary system operated by the sovereign and the banks, academic finance built a theory of finance without the macroeconomy, just as neoclassical macroeconomics had built a theory of the macroeconomy without finance. In effect, the compartmentalization of money and macroeconomics from finance and market efficiency removed an understanding of the interconnections among these aspects of the economy. This brings us back to Lord Turner's analysis. In the words of staff at the Bank of England, in the modern economy, most money takes the form of bank deposits, but how those bank deposits are created is often misunderstood. The principal way is through loans made by commercial banks. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. Thus, in making an advance to a would-be borrower, a bank simultaneously creates a debt owed to it by the borrower and a deposit in favor of the borrower. Thereafter, the deposit may be transferred to somebody else, as payment or as a gift. It has become money. In this way, banks create almost all of the money in the economy. Of course, individual banks need to hold on to deposits, otherwise they would have to shrink their balance sheets. But the deposits they lose would go to other banks, unless customers actually flee into cash. So the system as a whole would not lose deposits, and it is the system as a whole that matters to the economy. True, the distinction between banks and non-bank financial intermediaries must not be exaggerated. Most such institutions generate maturity mismatches and high leverage inside the economy. But banks have two advantages over other intermediaries. The central bank will always provide the reserves that solvent banks need to ensure the moneyness of their liabilities, namely, their ability to be redeemed or used in payment, at par with central bank, that is, government, money. Equally, since the 1930s, an increasing number of governments have guaranteed the value of at least a portion of deposits explicitly, regardless of the solvency of the banks, and are implicitly believed to be behind even more of the deposits, quite possibly all of them. Banks, particularly big banks, should be viewed as more a part of the state than of the private sector. These valuable privileges allow banks to expand their lending in good times with next to no constraint. It's easy, after all, for banks to hold on to the deposits they need to fund their expanded lending, precisely because of the public confidence generated by the support provided to banks by the government and central bank. Banks are explicitly part of the government's monetary system. Of course, once the Federal Reserve offered equivalent support to money market funds in September 2008, the latter came to have much the same characteristic as banks. What then stops the bank-led financial system from expanding credit and money without limit? The obvious answer would be that it would stop when participants ran out of profitable opportunities. But this is not a convincing answer if the activities of the hyperactive intermediaries, in aggregate, create the perceived opportunities. Credit growth breeds asset price bubbles that in turn breed credit growth. This is at core a disequilibrating process. And that's why microeconomic financial theory is next to useless in explaining it. It is a macroeconomic process, moreover, not a microeconomic one. It shapes the entire economy. There could then be two further answers to the question: what stops credit expansion? One is that a crisis stops it. That is all too unpleasantly true. In the end, the elastic credit system snaps back into a credit crisis. That is the Minsky moment, when panic sets in. A more pleasant answer is that the central bank stops credit expansion by raising interest rates. The implicit answer of the pre-crisis official orthodoxy was that central banks would stop the excess credit expansion in time, or at least not too late, by responding to rising inflation and the prices of goods and services. But that signal would fail if rising asset prices and expanding credit were not closely related to inflation. That is precisely what happened in the 2000s. Thus, the period before the crisis saw strong external demand for assets denominated in the currencies of the economies in which credit and money were growing rapidly, and a lack of inflationary pressure in the world as a whole, largely because of a huge expansion of capacity and employment in the production of tradable goods. Even a huge credit expansion generated no overt inflationary pressure, but asset prices, housing prices above all, rose substantially. The reason orthodox economics failed to pick up the risks was, in short, that it ruled out what most mattered. Modern financial economies do not equilibrate smoothly. They are dynamic systems characterized by uncertainty and animal spirits, in which the most powerful destabilizing force is the ability of the private financial sector to generate credit and money, and so to produce euphoric boom and panic-stricken bust. So what now? Let us start with what the official sector and the economists who advise it tell us they have learned. Then, let us look at fundamental critiques. The official response to its errors. In the fourth of a series of lectures on the Federal Reserve and the Financial Crisis, delivered in Washington, D.C. in March 2012, Chairman Bernanke addressed the aftermath of the crisis. Mr. Bernanke was not only the chairman of the Federal Reserve, the world's most important central bank, and the epicenter of policymaking throughout the crisis, but is also a distinguished academic economist. He should be viewed as an authoritative source for the opinions of most officials and informed academics. In this lecture, he did two important things. The first was to defend the interventions of the Federal Reserve and the other important central banks after the crisis. The second was to lay out the agenda for post-crisis policymaking. This is what he said. We began by noting the two principal tools of central banks, serving as lender of last resort, to prevent or mitigate financial crises, and using monetary policy to enhance economic stability. In the Great Depression, as I described it, those tools were not used appropriately. But in this episode, and I should say that other major central banks have followed, very similar policies to those of the Fed, these tools have been used actively. And in my belief, in any case, by doing that, we avoided much worse outcomes in terms of both the financial crisis and the depth and severity of the resulting recession. A new regulatory framework will be helpful, but again, it's not going to solve the problem. The only solution in the end is for us regulators and our successors to continue to monitor the entire financial system and to try to identify problems and respond to them using the tools that we have. Mr. Bernanke then made three fundamental points about the role of central banks in the light of the crisis. First, the interventions during the crisis, though huge in scale, were very much in keeping with the historic role of central banks, which is to provide lender of last resort facilities in order to calm a panic. And what was different about this crisis was that the institutional structure was different. It wasn't banks and depositors, it was broker-dealers and repo markets. It was money market funds and commercial paper. But the basic idea of providing short-term liquidity in order to stem a panic was very much what Bagehot envisioned when he wrote Lombard Street in 1873. This is, broadly, correct, so far as central bank operations are concerned, though the interventions of finance ministries went well beyond standard lender of last resort operations, since they involved buttressing the solvency of failed institutions. Second, these interventions saved the economy from another Great Depression by preventing a cascading collapse into bankruptcy not just of the financial sector, but of large parts of the U.S. and world economies. We don't know the counterfactual and never will, which makes it easy for opponents of these interventions to argue they were unnecessary. But it's hard to believe that an unmanaged implosion of much of the Western world's financial system, at a time of overextended balance sheets in much of the private sector, would not have created a global depression at least rivaling that of the 1930s. No sane policymaker could have taken that risk, and, fortunately, after the post-Lehman shock, they did not do so. We were forcibly reminded of the dependence of the financial system on the unique capacity of the state to create the money that people want when they trust nothing else. Third, the way oversight of the stability of the financial system as a whole will work is for the regulators and our successors to continue to monitor the entire financial system and to try to identify problems. This is in addition to a host of more detailed changes, to be discussed in Chapter 7, aimed at making institutions and markets less fragile. The financial sector, argues Mr. Bernanke, will need the permanent, persistent, and penetrating oversight of a paternal state. The core of the market economy, its brain, so to speak, cannot be trusted to operate without adult supervision. This is not a small matter. Mr. Bernanke emphasized, then, that maintaining fiscal stability is just as important a responsibility as monetary and economic stability, and indeed this is very much a return to where the Fed came from in the beginning. Remember, the reason that the Fed was created was to try to reduce the incidence of financial panics. So financial stability was the original goal of the creation of the Fed. So now, we sort of come full circle. But he did not forget the other goal, monetary stability. On this, he argued that markets have been confident that the Fed will keep inflation low. Inflation expectations have stayed low. And except for some swings up and down related to oil prices, overall inflation has been quite low and stable. At the same time, while we've kept inflation low, we've also made sure that inflation hasn't gone negative. And those of you familiar with the Japanese situation understand that's been a big problem for their economy now for quite a few years. We certainly want to avoid deflation. I talked about deflation also in the context of the Great Depression. So, monetary ease also guarded against the risks of deflation by making sure that the economy didn't get too weak. In sum, Mr. Bernanke offers the following conception of the three roles of the central bank in the economy. 1. Inflation targeting, in other words, macroeconomic stabilization. 2. Financial oversight. And 3. Unlimited crisis intervention. All important central banks now accept these tasks, though the Federal Reserve, with its dual mandate, would also state that its aim is to achieve the highest employment possible, consistent with achieving the inflation target. How, then, might one summarize post-crisis central bank orthodoxy, or as I will call it, the new orthodoxy? It comes in three parts. First, central banks still believe in seeking to stabilize inflation, a lesson the high-income economies learned in the inflationary era of the 1970s. Second, they seek a second set of instruments to achieve stability in the financial system as a whole. These instruments fall under the title of macro-prudential policy. Third, central bankers are strengthened in their role as lenders of last resort, but want to avoid rescuing insolvent institutions. So they need ways of resolving, that is, reorganizing the financial structure, or even closing, institutions, ways that won't trigger financial Armageddon. Financial institutions should, accordingly, not be allowed to become too big, too complex, or too interconnected to fail. This approach is, however, open to powerful objections. 3 are particularly important. First, this new orthodoxy gives enormous discretionary power to bureaucrats in managing the financial system in particular, which is the heart of the supposedly market economy. Second, the new orthodox doctrine does not resolve the confused relationship between the state and the private sector as suppliers of money. On the contrary, it reinforces that confusion. And third, the doctrine assumes that monetary policy can be targeted at price stability, while macro-prudential policy is targeted at financial stability. More important, it is assumed that they will not get in each other's way, with monetary policy sometimes undermining financial stability by encouraging excessive credit creation, and macro-prudential policy undermining monetary policy by halting credit creation. Not surprisingly, given the poor performance in the run-up to the crisis and the doubts about the workability of the new doctrines, many object to the emerging official post-crisis ideology. These objections have their roots in the work of important economists from the past: Knut Wicksell, Ludwig von Mises, and Friedrich Hayek, Henry Simon, John Maynard Keynes, and Milton Friedman, and Abba Lerner. This is a very old set of debates, but they are as relevant today as ever before. Alternatives to the new orthodoxy. The power of the financial system to create credit and money is enormous for both good and ill. The mixed public-private arrangement of today is certainly not the only way this system could work. The choice of alternatives is far from a purely technical matter. It has, inevitably, deep political implications. So, what are the alternative visions of financial, monetary, and fiscal systems? Let's now take a look at several. Knut Wicksell, on the market and natural rates of interest. The big lesson of recent experience is that private credit provision can be highly destabilizing even when inflation is under control. The new central banking orthodoxy described previously is, of course, an attempt to stuff the genie of financial sector-driven instability back into the bottle. The view that the credit system is destabilizing is one shared by post-Keynesians such as Minsky and Austrian economists such as von Mises. The man from whose ideas these very different strands descend is the great Swedish economist Knut Wicksell, 1851 to 1926, whose classic work, Interest and Prices, was published in 1898. In this, he started from the observation that banks were able to create credit-backed money, as explained in the quotation from the Bank of England previously. Given the existence of such credit-backed money, Wicksell argued, two interest rates operate in the economy, the natural rate and the money rate. The former cannot be observed directly. It is the real return on new capital as seen by profit-seeking entrepreneurs. The latter can be observed directly. It is the lending rate of the banking system. In Wicksell's theory, when the money rate is below the natural rate, banks expand credit to meet rising demand from business. What is driving business to borrow is their belief that the return on investment, the natural rate, is above the cost of borrowing from banks, the money rate. The demand for new lending then expands credit and money, in ways already discussed previously, and so drives the real economy and ultimately inflation upwards. When the money rate is above the natural rate, this process goes into reverse. Credit and money contract. There is then a risk of deflation. Since credit expansion and contraction are cumulative processes, with today's credit expansion or contraction influenced by yesterday's expansion or contraction, via their effects on activity and prices, changes in credit and money have powerful, real effects on the economy. Wicksell influenced both Austrian economists and Keynes, but in different directions. A contemporary descendant is the influential neo-Keynesian Michael Woodford of Princeton University, whose work provides support to management of expectations via inflation targeting, in line with contemporary orthodoxy. Woodford focuses on Wicksell's concern with achieving stable inflation. Other descendants include William Bill White, former economic advisor and head of the Monetary and Economic Department of the Bank for International Settlements, and Claudio Borio, deputy head of the Monetary and Economic Department and director of Research and Statistics at BIS. These economists focus more on Wicksell's insights into credit, insisting that deviations between natural and market interest rates may emerge in destabilizing credit expansions and contractions rather than in measured inflation or deflation, other than in the very long run. The problem, these economists emphasize, is that central banks have allowed the credit system to become excessively elastic. This is, they argue, why the incidence of financial crises has increased. The current orthodoxy, they note, is that macroprudential regulation will control such elasticity. But they question whether regulation can curb the impact of a monetary policy pushing in the opposite direction. Their conclusion is that monetary policy must lean against the wind of credit expansion. Bill White argues similarly that policy is now on a treadmill, with a succession of ever more desperate monetary policies designed to remedy the malign longer-term impacts of the last set of such policies. He is concerned that the result of the policies adopted in response to the post-2007 crisis will be even worse. All this occurs, argue such Wickelsians, because the money rate of interest has been kept below the natural rate for far too long. The latter group of neo-Wickselians argue correctly that inflation targeting, far from stabilizing the economy, may destabilize the financial system and so the economy in the medium term. Yet, while this diagnosis is persuasive, the policy recommendations are not. First, it's impossible to hit two targets, price stability and financial stability, with one instrument. Second, the natural rate of interest is unknown. Attempts to use the rate of economic growth as a proxy for the natural rate, as White does, are unpersuasive. That relationship would only hold in a long-run equilibrium. But the dominant feature of our economy is that it has not been in such an equilibrium. A world of fast growth and very low real rates of interest is a disequilibrium world. This is because of the once-in-a-century impact of the rise of China and other emerging economies on the world stage, what I have called the shifts in Chapter 5. Third, the extent of the needed leaning against the wind is unknown and unknowable. The links between monetary policy and asset prices are not subject to precise control, according to current knowledge. Fourth, it's unclear how a legal mandate upon the central bank to achieve both monetary and financial stability via monetary policy could be made operational. Finally, seeking to stabilize finance might destabilize inflation and inflation expectations, thereby making the real economy more unstable, not less so. The new Excellians have indeed identified a problem, but not put forward a workable solution. The conclusion I draw is that in an environment of rapid credit growth, monetary policy should be tighter than strict inflation targeting would suggest. But monetary policy cannot achieve two targets at once. Other instruments will indeed be needed to make the financial system less destabilizing, as the new orthodoxy would suggest. The Austrians on Bank Credit and Malinvestment. Wicksell greatly influenced the Austrian economists, Ludwig von Mises, 1881 to 1973, and Friedrich Hayek, 1899 to 1992. Both of whom played an important role in academic debates on money and finance in the 1920s and 1930s. They lost these debates in academic and policy circles partly for methodological reasons, their rejection of the growing role of mathematics in economics, but far more for political ones. The opposition to any policy response to the greatest crisis that had ever befallen capitalist economies, other than letting it burn itself out. Paradoxically, their defeat in academe liberated Austrian economics. It has become politically influential, principally in the U.S., where Austrian economics has become a favorite economic ideology of libertarians, and so parts of the modern Republican Party. Former Congressman Ron Paul is a devotee. The reason for this appeal is that, unlike the Chicago School, in which the late Milton Friedman was the dominant post-war figure, the Austrian economists see no case for a government role in managing the market economy, including even the money supply. Many contemporary Austrians favor a return to the gold standard. Naturally, they are opposed to every element of the new or old orthodoxy on monetary and financial policy. They are purist adherents of laissez-faire. This is why they have condemned the Federal Reserve's policies during the Great Recession. Instead, they see depressions as healing events. Von Mises followed Wicksell in his attention to the natural and money rates of interest, but he added a great deal of detail to the role of banks in a credit expansion. As the Spanish-Austrian Jesus Huerta de Soto explains, according to Mises, the amplification of any inflationary process via credit expansion will sooner or later, spontaneously and inexorably, reverse and provoke a crisis or economic recession in which the investment errors committed will be revealed, and massive unemployment will emerge along with the need to liquidate and relocate all the resources wrongly invested. To eliminate recurrent economic cycles, Mises proposes the establishment of a banking system with a 100% reserve requirement for demand deposits. Ironically, the great apostle of the free market wished to suppress the free market in the provision of money. In this way, he recommended, the ability of banking institutions to create credit and money would be ended by legal fiat, though the reserve backing would come from gold. Hayek argued that divergences between natural and money rates of interest would lead to distortions in the structure of production. Thus, if a positive gap opened up between the natural and money rates of interest, possibly because of the efforts of the central bank to expand credit, expected profits would rise, since the real returns on new investments, the natural rate, would be above the rate at which business could borrow, the money rate. And this would encourage a credit expansion, that is, false savings, via greater leverage in the banking system, and a move towards more capital-intensive, in Austrian terminology more roundabout, methods of production. The lower the cost of capital, in this case proxied by the money rate, the more capital-intensive will become the most profitable techniques of production. Such forced adoption of capital-intensive techniques is malinvestment. The bigger the divergence between the two rates of interest, the bigger the boom and the bigger the bust. In particular, Hayek blamed the Great Depression on the expansionary credit policies of the Federal Reserve during the 1920s. In the words of Mr. Huerta de Soto, Hayek views the Keynesian remedy for the Great Depression as nothing more than a temporary solution with adverse consequences. Indeed, any artificial rise in aggregate demand will severely distort the production structure and can only generate unstable employment. In later years, Hayek devoted his attention to the idea of privately issued money, rather than the 100% reserve-backed money of von Mises. In the debates of the 1930s, the Austrians lost the public argument on business cycle theory to the Keynesians, and, subsequently, the monetarists. They ceased to have much influence on ideas about macroeconomic policy for a long time. Both economics and politics explain this failure. The economic explanation was the scale of the slump. It was impossible to argue that no more was involved than the reversal of the malinvestment during the 1920s. Indeed, this theory is puzzling, particularly given that it comes from such passionate believers in laissez-faire. Why should business people be so misled by mistaken monetary policy? If business can be so wrong about this, what else might it be wrong about? Moreover, why should the reversal of malinvestment lead to a depression? It should lead instead to the scrapping of some capital along with a boom in more profitable investments. A far more plausible view is that the scale of the downturn in the Great Depression was due to a steep decline in demand, largely due to the banking and monetary collapses. This decline in demand also generated massive involuntary unemployment. The Austrian school's support for the liquidation recommended by U.S. Treasury Secretary Andrew Mellon and its opposition to any remedial intervention by government was, rightly, judged indefensible in the place where it counted, the electoral process. In the U.S., Franklin Delano Roosevelt became president. In Germany, Adolf Hitler became chancellor. What these two vastly different leaders shared was their rejection of laissez-faire. In the end of the 1930s, a defeated Hayek abandoned his efforts at business cycle theory, moving more to political philosophy and the economics of information, in both of which he made influential contributions. Today's adherents of the Austrian school, such as former Congressman Paul, tend to argue in favor of a return to 19th century political economy. The gold standard, with its direct link between the supply of money and the supply of gold. Abolition of the central bank. Ending of financial and other forms of regulation. Elimination of social safety nets, and so forth. If people with this set of views had been in charge in 2007 and 2008, the results would probably have matched those of the 1930s. That would have discredited them for another 2 generations. In the U.S., however, a frightened Republican administration was shortly followed by an activist Democratic one. This allowed Austrian economists and other libertarians to blame the disappointing aftermath of the crisis on those who sought to cure it. Indeed, in the U.S., it has become conventional wisdom that the Obama administration's stimulus program failed when it was just insufficiently large, partly because of fierce Republican opposition and partly because of what turned out to be false optimism among economists working for the administration. Given this mistaken view on what had just happened, Austrian liquidizationism may be tried in the next great crisis, with predictably dire results. Yet it is hard to believe that the 19th century gold standard could be successfully reintroduced into a modern democracy. This is not the only reason why the approach of the Austrian school has to be rejected. They are right to argue that the conditions leading to a crash are important, but their recommendation that the right response to the crisis itself is to do nothing does not follow from their correct view that significant mistakes caused it. Doctors don't refuse to treat someone who owes his heart attack to overeating, recommending that he just go on a diet instead. First, they treat him, and then, when he is better, he can go on a diet. Nevertheless, the Austrian school's critique of the official orthodoxy has value, even if their theory and policy ideas do not. First, the credit system is, as they remind us, destabilizing. Second, stable inflation does not guarantee economic stability. Third, booms will create malinvestment and excess debt, which will then have to be dealt with in one way or another. It is not surprising, therefore, that construction, finance, and debt itself all shrank after the boom ended. Finally, the idea that regulators will be able to fine-tune monetary policy on the basis of economic forecasts and safeguard the stability of the financial system on the basis of their analysis of systemic risk is rather optimistic. Indeed, we must assume at least a degree of failure. Henry Simons and the Chicago Plan. Mises concluded that the ability of private institutions to create debt-backed money out of thin air, as a byproduct of their lending, as discussed previously, needed to be brought under control via 100% reserve banking, that is, a system in which deposits are backed by central bank reserves 1-to-1. The Chicago School, another group of free market economists, came to the same conclusion in the 1930s for the same reason. They concluded that the bank-based monetary system, which we still have today, was itself unstable, and so destabilized the economy. The economists involved were hugely distinguished and respected. Frank Knight, 1885 to 1972, who pioneered the crucial distinction between calculable risk and uncertainty. Henry Simons, 1899 to 1946, author of the most complete version of the Chicago Monetary Plan. Irving Fisher, 1867 to 1947, the most famous pre-Second World War American economist. And, after the war, Milton Friedman, 1912 to 2006. Again, as with the Austrians, these free market economists concluded that the ability to create credit-backed money had to be ended if the market economy was to be protected from ruinous crises. The thrust of the plan, which was first proposed in 1933 at the trough of the Great Depression, was to give government the exclusive right to create money, thereby taking it altogether away from private businesses, that is, banks. All versions of the plan required 100% reserve backing of deposits. In other words, households and businesses would keep their holdings of deposits in banks, which would, in turn, hold accounts to the central bank or, possibly, hold government debt. Deposits would, therefore, fund the government. The economic argument is that only in this way would there be no banking crises. Banks could not fail. The philosophical argument is that a monetary system is both a social contrivance and a public good. Society should gain the reward from what society has created. The plan then proposed that the money supply, now under full government control, would expand in accordance with a rule, probably a target rate of growth based on expected growth of the economy, expected changes in demand for money, and an inflation target. If reserves backed deposits 100%, what would finance lending to the economy? This is the crucial question for all such schemes. The original Chicago plan proposed replacing traditional banks with investment trusts that issue equity and sell their own interest-paying securities. But, as we have learned from the emergence of the money market funds and the repo markets, which played a central role in the shadow banking system, such debt can once again become an attractive replacement for money, with lethal consequences for stability. Two alternatives were proposed, both of which aimed at eliminating this risk. Under one, recommended by Simons, all private property would take the form of currency, government bonds, corporate stock, or real assets. Thus, the investment trusts would take the form of equity or property mutual funds. Under the other alternative, banks would borrow from the government, not the private sector, to fund their riskier assets. The essential aim of the plan was to give the government a monetary monopoly. Private institutions would not issue money-like liabilities except when backed by government money. What would be the advantages? Fisher claimed 4. First, preventing banks from creating and then destroying credit and money in self-reinforcing cycles would eliminate the biggest source of instability in the economy. Second, 100% reserve banking would eliminate the possibility of bank runs. Banks would be completely safe. Third, if the government financed itself by issuing money at zero interest, rather than borrowing at interest, debt interest and net government debt would fall dramatically. Indeed, in almost all countries, government would become a net creditor. Finally, since money creation would no longer need private debt, the level of such debt would fall dramatically. Indeed, in the transition, the government could use the excess of the total supply of money over its own debts to fund a dramatic decline in private debt through buybacks. I would add to these benefits that the extinction of conventional bank-created money would almost certainly shrink the financial sector, reduce the aggregate incomes earned by bankers, and so improve the distribution of income. The fiscal implications alone would be dramatic. According to an important International Monetary Fund working paper on the Chicago Plan by Jaromir Benish and Michael Kumhoff, total bank deposits in the U.S. are around 180% of GDP. Assume the demand for money merely grows in line with nominal gross domestic product at about 5% a year. If it failed to do so, interest rates would rise and the economy might be pushed into deflation. So, each year the money supply would need to grow by 9% of GDP if it were to remain at 180% of GDP. This would fund about 40% of the federal government in normal years, allowing a dramatic reduction in taxes. Republicans should love that. To this should be added savings on government debt interest, on the assumption that these would not be interest-earning deposits, and the earnings on any money lent to the private sector. Also dramatic would be the implications for the operation of monetary policy. The central bank would have direct control over the money supply. It could be told to follow a strict rule, as the Chicago School proposed, which would include a precise inflation target. The central bank could set any interest rate it liked, including negative rates, up to the point that people preferred to hold cash instead of deposits. The stabilization of the economy would become a relatively simple challenge because the main obstacle to it would have been eliminated. Not surprisingly, the opposition of the banking industry forced abandonment of the Chicago Plan in the 1930s. Those who enjoy such an extraordinary privilege, in this case to create state-backed money at will, would not willingly give it up. But the idea of what is called narrow banking, an important part of the Chicago Plan, returns, quite understandably, in every generation. Minsky, though a post-Keynesian, also endorsed 100% reserve banking in 1994. The plan for limited-purpose banking proposed by Lawrence Kotlikoff of Boston University in his book Jimmy Stewart is Dead has close similarities to the Chicago Plan. On the political left, James Robertson, a British environmentalist, has gone further in his proposal that the central bank should create all money directly and hand it over to the government to spend as it sees fit. But from a monetary point of view, that is the same as 100% reserve banking. More recently, Andrew Jackson and Brian Dyson have endorsed a similar approach for Positive Money, a UK campaigning organization. The crucial point is that these proposals for replacing private debt-created money with government-created money are perfectly feasible and would bring substantial benefits, far less private debt and far less private indebtedness. The self-interest of private bankers would again be a significant factor in opposing such ideas, but there are also intellectual objections. Walter Bagehot opens his book Lombard Street by arguing that much more cash exists out of banks in France and Germany, and in all non-banking countries, than can be found in England or Scotland, where banking is developed. But that cash is not, so to speak, money market money. It is not attainable. But the English money is borrowable money. Our people are bolder in dealing with their money than any conventional nation, and even if they were not bolder, the mere fact that their money is deposited in a bank makes it far more obtainable. $1 million in the hands of a single banker is a great power. He can at once lend it where he will, and borrowers can come to him because they know or believe that he has it. Bagehot attributes British economic dynamism to the public's willingness to trust their money to risk-taking private banks. Yet we do not know that economic progress depends on the instability of a credit-creating banking system. Certainly the authors of the Chicago Plan and others in their intellectual tradition pose a profound challenge to the contemporary new orthodoxy that some combination of inflation targeting with skillful macroprudential regulation will allow the world economy to ride the financial tiger in reasonable safety. Unfortunately, while something as radical as the Chicago Plan may be a necessary condition for stability, it is unlikely to be a sufficient one. The market economy could still be unstable. Moreover, the gains for dynamism generated by a risk-taking private system might outweigh the risks to stability. The rational strategy is to make more changes now than the new orthodoxy suggests, which will be discussed in Chapter 7 in the conclusion, and plan to move to still more radical ideas if huge crises recur. But it would be too disruptive and risky to make a massive shift in the nature of our economies towards the Chicago Plan without first trying more limited reforms, albeit radical ones by the standards of the new orthodoxy. It would also be rational to encourage some, possibly smaller countries, to experiment with still more radical plans for eliminating banking as we know it. Indeed, so great has been the failure of the financial system that the idea of a monoculture of banking and financial systems governed by the same global rules seems inordinately foolish. We simply don't know enough to settle on just one system. Experiment is essential. The Chicago Plan, or variants upon it, is definitely an experiment worth making. Keynes versus Friedman on fiscal versus monetary policy. The economic debates of the 1930s bequeathed an agreement between John Maynard Keynes and his successors on the one hand, and the monetarists on the other, over one decisive matter: that aggregate demand matters. The economy does not automatically operate at full employment. Potential output does not automatically become actual output in a complex monetary economy. In these respects, Keynesians and monetarists are very much on one side, since they are both concerned about aggregate demand, and the Austrian economists are on the other, since they reject this concern altogether. A divide did emerge, however, between Keynesians and monetarists on which tools to use and how. That divide still exists today. Indeed, the debate over the relative importance of fiscal and monetary policies in the post-crisis period was among the most important debates of all. This is not true in normal times, when interest rates are significantly positive. In these circumstances, most, though not all, of the descendants of Keynes would agree with Milton Friedman and his successors that monetary policy can deliver the desired stability of demand. Important disagreements remain, however. First, Friedman's view emphasized not the price of money, meaning the interest rate, but its quantity. He was a quantity theorist in the tradition of Irving Fisher. He argued that what mattered was not the price of money, the rate of interest, but its quantity, the stock of money. Friedman believed that the rate of interest does not tell one whether monetary policy is loose or not. Only the rate of growth of the money supply does that. His underlying assumption was that, despite radical changes in monetary institutions towards a credit-based and away from a commodity-based monetary system, it is possible and desirable both to define what money is and control its growth more or less precisely. Furthermore, argue quantity theorists, if one achieved a steady rate of growth of the money supply, the growth of nominal demand would also be stable. There is, in other words, a direct relationship between the money supply and nominal spending in the economy. Second, Friedman argued that the best approach would be to follow a rule for growth of the money supply, rather than rely on the discretion of central bankers. If one did that, any short-term disruptions in the real economy generated by vagaries in the supply of money would be ironed out, leaving the underlying real economy to function as smoothly as it could. Monetarism's great successes were in the 1960s and 1970s, when naive Keynesianism blew up because it underplayed inflationary expectations and believed too confidently in macroeconomic fine-tuning. The assumed trade-off between unemployment and inflation broke down, whereupon Keynesian fine-tuning of the real economy via active fiscal and monetary policies became largely discredited and was subsequently abandoned. Of course, it was logically possible to have a Keynesian view of the role of fiscal policy in demand management, while accepting the crucial role of expectations. Nor was it essential for Keynesians to believe in macroeconomic fine-tuning. Given our ignorance, they could have believed in coarse tuning instead, namely the use of fiscal policy to guide the economy only in extreme circumstances. Similarly, it would have been perfectly possible to believe money is of great importance, but not pay much attention to expectations, while believing in a degree of fine-tuning. But, as a matter of historical fact, the Keynesians of the 1960s mostly downplayed inflation expectations and largely believed in fine-tuning. This opened up a vulnerable intellectual wing to the monetarist counterattack, which combined the role of expectations, the centrality of money, and the difficulties inherent in discretionary macroeconomic fine-tuning. When monetarism was tried in the 1980s and 1990s, it failed, since neither defining nor controlling the money supply proved at all easy. This then led to the pre-crisis orthodoxy of inflation targeting by the central banks, which relied on interest rates, not quantitative control over money. At the back of policymakers' minds was the notion of the natural rate of unemployment, proposed by Milton Friedman and Edmund Phelps, or, as it would be called today, the non-accelerating inflation rate of unemployment, known by the acronym NAIRU or NAIRU, or alternatively a zero output gap. This, then, was a kind of synthesis between Keynesianism and monetarism. Natural rate Keynesianism, implemented via active, indeed fine-tuning, monetary policy. This orthodoxy also broke down, first in Japan in the 1990s, then in the West after 2007, because of what both Keynes and Friedman both ignored: the tendency of the credit system to run riot. As Wickselians, Austrian school economists, and Minskians emphasize. After the crisis, much of the world found itself with close to zero nominal short rates. At that point, the debates revived. Both monetarists and most adherents of the contemporary orthodoxy argued that monetary policy could still work effectively, either by expanding the quantity of money or lowering the yield on other securities, particularly long-term bonds. One policy, it was thought, would achieve both those outcomes: quantitative easing, by which was meant the expansion of the monetary base. By using newly created central bank money to buy bonds, the central bank could, it was believed, both expand the money supply and lower yields. Let's now track what happened in the U.S. after 1980 with M2, the broadest measure of money the Federal Reserve publishes. M2 consists of currency held by the public, plus deposit liabilities of financial institutions, principally belonging to households. Also included with this would be the monetary base. This consists of currency, again, and the deposits of banks at Federal Reserve banks, that is, the central bank. The monetary base is the government-created money in the system. It is a liability of government. The rest of the money supply is the liability of banks. The monetary base is sometimes called outside money, and the bank-created money supply inside money. Until the recent crisis, virtually all M2 was inside money, a byproduct of the rapidly expanding lending activities of private financial intermediaries. The monetary base barely grew. In the early years of the crisis, however, lending to the private sector by financial intermediaries shrank. By expanding the monetary base, principally through quantitative easing, the Federal Reserve compensated for the cessation of bank lending to the private sector, thereby keeping M2 growing. This is exactly what Milton Friedman would have recommended. From the monetarist point of view, it was the obvious thing to do. Since monetarists are generally viewed as being on the right wing economically, it was amusing to watch the scorn with which many on the political right wing treated these actions by the central bank in the U.S. Keynesians argue that when short-term rates are close to zero, monetary policy is no longer very effective. Certainly, apparently reasonable monetary growth, measured by M2, did not generate a vigorous recovery, though it almost certainly stopped a far deeper recession. The difficulty, as we saw in Chapter 5, is that the economy suffers from a savings glut. Desired savings exceed desired investment, despite the extremely low interest rates. In the well-known expression, money is pushing on a string. Moreover, though the short-term rate may be near to or at zero, it is impossible to bring the long-term rate that low because of liquidity preference. At negligible long-term rates, the downside for holders is large, since investors would lose a fortune if yields returned to normal, and the upside negligible. So, people will not hold the long-term bonds if the yield falls below a certain level. If the central bank wanted their yields to go still lower, it would have to buy almost all of these bonds outright. In effect, it would find itself financing the government directly. A better solution, argue Keynesians, is to lower desired savings directly, while keeping rates of interest at zero. To do that, the government has to spend more itself or implement tax cuts that will encourage the public to spend more. This is the simplest and most direct way to revive the economy. Furthermore, such a fiscal policy will have no effect on short-term interest rates, and will raise long-term interest rates in countries with their own central banks only if it encourages confidence in a recovery. the risks of default, or more or less zero in this case. This debate between Keynesians and monetarists on the best macroeconomic policy response to a crisis is very much live, both within academe and more publicly. It will be a big part of the discussion in Chapter 8, where it will inform our analysis of the new orthodoxy in action. Minsky's instability hypothesis. Hyman Minsky, 1919 to 1996, fascinatingly, a post-Keynesian product of the Chicago School, developed one of the most comprehensive critiques of pre-crisis, and by implication, the post-crisis new orthodoxy too. As we saw in the preface, introduction, and Chapter 4, his crucial points were three. First, he believed that instability is an inherent feature of a dynamic capitalist economy, not just of the financial system. Second, he doubted whether any regulatory rules could contain this instability durably. And, finally, he believed that the combination of big government with the big bank, meaning the central bank, was the only way to contain the consequences of severe instability. While disagreeing, rightly, with the notion that inflation targeting could deliver stability, Minsky would have appreciated the need, stressed by Mr. Bernanke, for regulatory watchfulness, and with the efforts of the Federal Reserve to rescue the economy from the crisis. He would have emphasized that the economy is now in a depression mode, and will take a great deal of government-led effort to escape from a more severe crisis. All these are very important lessons to be considered further in Chapter 8. Lerner, Cartelism, and Modern Monetary Theory. A final school of thought, which is called Cartelism, from the idea that money is just a token, for which the Latin word is carta, argues that the conceptual failure of the contemporary monetary and fiscal orthodoxy is not that it gives too much room for central bank or government discretion, but that it gives far too little. Thus it goes beyond Keynes and most Keynesians. The essential idea is that the purpose of monetary and fiscal policy is to ensure full employment. In an economy based on freely floating fiat, that is, government-created or government-backed money, the government suffers from no fiscal constraint. It can always create money that residents have to accept. The constraints are only macroeconomic, particularly excessive inflation. Adam Smith made reference to the idea of state-created paper money, noting that the government of the British colonies in North America find it for their interest to supply the people with such a quantity of paper money as is fully sufficient, and generally more than sufficient, for transacting their domestic business. But the theory emerged in full form in 1895, the heyday of the gold standard, with the publication of Georg Friedrich Knopp's analysis of the role of the state in creating money. Taxation makes money valuable, he argued, since private citizens needed to pay those taxes. This, in turn, makes paper money acceptable in the economy at large. It's simply the most readily transferable of all possible credits, since the government is the most powerful and most permanent of all possible debtors, and all money is just transferable credit. Its value derives from the willingness of people to trust in it. This idea influenced Keynes and was taken up in Functional Finance, proposed by the influential post-Keynesian Abel Lerner, 1903 to 1982. Since the government can issue currency at will, the level of taxation and the extent of borrowing are tools to influence the economy. They have nothing to do with any need to finance the government, since it can fund itself by creating money. Thus, all forms of balanced budget household economics applied to the government are nonsense unless it has ceased to be able to create money, as has happened inside the Eurozone. In Lerner's words, government should adjust its rates of expenditure and taxation such that total spending is neither more nor less than that which is sufficient to purchase the full employment level of output at current prices. If this means there is a deficit, greater borrowing, printing money, etc., then these things in themselves are neither good nor bad. They are simply the means to the desired ends of full employment and price stability. So long as these policies do not generate excess demand, there is no reason to fear their inflationary effects. And this doesn't mean no constraint on monetary policy exists, but those constraints come after inflation and the associated risks of sharp declines in the value of the currency against other currencies. Today's proponents of this set of ideas call it modern monetary theory. An essential point is that the private sector can be a net accumulator of financial assets if and only if the government runs a deficit or the economy as a whole runs a current account surplus, that is, foreigners run a financial deficit. If the government runs a financial surplus in good times, as orthodox Keynesians propose, the private sector will, in the absence of a current account surplus, run a financial deficit. The latter deficit will need to be financed by the creation of bank credit, which may ultimately prove destabilizing. A crucial and unquestionably correct point in modern monetary theory is this: banks do not lend out their reserves at the central bank. Banks create loans on their own, as already explained previously. They don't need reserves to do so, and indeed, in most periods, their holdings of reserves are negligible. Only the central bank, by open market operations, government, by spending and taxation, or private individuals, by reducing or increasing their holdings of cash, can change the aggregate level of bank reserves. Nor is the amount of money that banks create relate in any direct way to reserves in the contemporary monetary system, as central banks have discovered. Reserves increased dramatically after the crisis, but lending did not. The amount of money that banks create is dependent only on how much they think they can profitably lend at the interest rates set by the central bank. Because the risk perceptions of banks vary dramatically depending on the economic climate, for which they themselves are, in aggregate, in large part responsible, their willingness to create loans will also vary dramatically from feast, a time of credit boom, to famine, a time of credit bust. If a bank needs reserves to meet settlement or cash obligations, today's central banks will freely supply them at the rate of interest it has determined. Thus, this rate of interest will then determine the rates at which banks lend. If the central bank engages in quantitative easing, that is, it creates money with which to buy assets from the public, it will increase aggregate banking reserves automatically. The central bank pays members of the public in return for the bonds it buys from them. Members of the public then deposit this money in their accounts at commercial banks, which then have increased liabilities to the public and a matching increase in deposits at the central bank. Those matching deposits are, of course, bank reserves. Moreover, to repeat, banks themselves can do nothing to lower the aggregate levels of bank reserves, since the only use of reserves is to settle accounts with other banks. Other businesses and households do not hold accounts at the central bank, so one bank's loss of reserves, meaning deposits, at the central bank, is always another bank's gain. It does not affect the total quantity of reserves outstanding. Of course, the government and central bank can change the quantity of reserves by buying and selling assets in the market. Similarly, the public can change the quantity of reserves by asking for cash instead of bank deposits. The banks, in turn, get the cash from the central bank in return for their reserves or by borrowing from the central bank, which creates the reserves. In brief, one should envisage the relationship between banks and the central bank as being identical to the one between the public and the banks. The central bank is the bank's bank. Modern monetary theory poses another fundamental challenge to the official orthodoxy. It argues that in an economy based on fiat money, the job of the central bank and government together is only to stabilize the economy. Moreover, these entities can always create the needed demand by spending the money they create. Of course, there is a constraint. Too much demand relative to supply will indeed generate inflation. But this will not happen just because of quantitative easing, unless its effect is to increase the overall supply of broad money faster than the public is willing to hold it. That has certainly not happened during this crisis, which is why the hyperinflation some feared has turned out to be an illusory danger. Deflation is a far greater risk. The reason not to give the government the power to use its ability to create money as a tool of stabilization in this direct way is not that it is technically difficult. It's rather that many view it, with reason, as politically dangerous, because it puts too much discretionary power in the hands of politicians whose estimate of full capacity output might be, dangerously, optimistic. The answer to that concern is institutional. Give the power to decide how much money to create to the central bank, but ask the central bank to do this directly via the creation of outside money, not indirectly via the expansion of inside money. Interestingly, the MMT view of monetary policy and the Chicago Plan are essentially the same, the difference being mainly the institutional setting within which the state creates money, rather than private banks. Conclusion. The people who have developed the critical perspectives outlined in this chapter differ on political values and so on whether the aim should be less state and more private or less private and more state intervention. They differ on whether policy should be guided by rules or discretion. They differ on whether the state should have an active role in managing the economy. They differ on whether money and credit are the sole source of instability in the economy. But on one point they agree: the balance between the role of the state as ultimate supplier of money and that of the private sector as actual creditor of almost all of the credit and money we use is highly destabilizing. We have made a pact with the devil. It is not a new bargain. On the contrary, it goes back many centuries. But we have recently been reminded that the dangers are huge. Moreover, the liberalization of finance seems to lead to crises almost automatically. Surely this strongly suggests a need for a new kind of system. Let us now turn to the twin challenges the authorities are attempting to address: getting out of the present malaise and restoring a stable and dynamic world economy. What, precisely, are they trying to do? Does it have a chance of working? And what else might be needed? These are the questions to which we turn. Chapter 7. Fixing Finance. We committed to reach agreement expeditiously on stronger capital and liquidity standards as the core of our reform agenda, and in that regard fully support the work of the Basel Committee on Banking Supervision, and call on them to propose internationally agreed rules to improve both the quantity and quality of bank capital and to discourage excessive leverage and risk-taking. It is critical that our banking regulators develop capital and liquidity rules of sufficient rigor to allow our financial firms to withstand future downturns in the global financial system. Communiqué of Finance Ministers and Central Bank Governors of the G20, June 5, 2010. Capital comes at a cost, both to banks and to the economy at large, in the form of foregone lending as institutions shrink to meet extreme capital-to-asset ratios. It's no surprise that loan levels in the U.S. and Europe have suffered over the past 5 years and will continue to do so with regulators' demands for ever higher levels of required capital. To tell banks they need more capital and then complain that some borrowers are not getting funding is a political statement, not an economic one. The incentives are obvious. When regulators set rules, they should not be surprised that banks naturally adjust to the incentives they created. Yet, too often, banks get blamed for making rational decisions based on the rules that have been set by their regulators. Frank Keating, President and Chief Executive, American Bankers Association, August 22, 2013. The breakdown of the financial system was so spectacular that the principal legislatures, policymakers, and regulators have indulged in an orgy of law and rule-making. A plethora of labels, Basel III, Dodd-Frank, Volcker Rule, Vickers, and Liikanen, have all become familiar to readers of the business press. Yet, what is behind all this? Will these reforms succeed? Will they cost too much? Is there something better we could do? In addressing these questions, the focus of the discussion will be on the attempt to rescue a system that, in its essence, will remain much like the one that went into the crisis. The aim is to tame the tiger of banking and finance, not turn it into another animal. Then, in the next chapter, the discussion will turn to the macroeconomic context, monetary reform, both domestic and global, and the rebalancing of the world economy. Closing stable doors. Among the most important consequences of the crisis was the decision to convene a G20 summit of the leading high-income and emerging countries in Washington in November 2008, and thereafter make this informal gathering the focus of global economic decision-making. This marked a shift from bodies dominated by a limited number of high-income countries, most recently the finance ministers and central bank governors of the G7, made up of the U.S., Japan, Germany, France, UK, Italy, and Canada, and the heads of government of the G8, which is the G7 plus Russia. It recognized fundamental shifts in global power. In consequence, it was the G20 that set the post-crisis reform agenda. The Declaration on Strengthening the Financial System of April 2, 2009, outlined commitments to do the following. Establish the Financial Stability Board to oversee global financial stability. Widen the scope of regulation to cover all systematically important financial institutions, markets, and instruments, with particular attention being paid to large and complex financial institutions. Oversight of hedge funds was also to be included. Strengthen prudential regulation, including by imposing more and better quality capital, ensuring firms build up bigger capital buffers in good times, and supplementing risk-based capital requirements with a simple, transparent, non-risk-based measure which is internationally comparable, properly takes into account of off-balance sheet exposures, and can help contain the buildup of leverage in the banking system. Ensure that compensation structures would be consistent with firms' long-term goals and prudent risk-taking. Improve standards for valuation of financial instruments, and make oversight of credit rating agencies more effective. This indicates the immediate regulatory response to the crisis. This, in turn, reflected a consensus that almost everything had gone wrong. Inadequate oversight, insufficient capital, regulatory arbitrage, irresponsible behavior, misleading accounts, and misleading credit ratings. Subsequently, the authorities added yet more objectives: structural change, altering the way banks are allowed to organize themselves internally; stress tests, assessments of the ability of banks to survive extreme conditions; resolution regimes, which are new legal mechanisms for reorganizing the finances of failing financial institutions; changes to market structure, meaning shifting trading from over-the-counter markets towards exchanges and clearinghouses; and reforms of regulatory structures. They were trying to close all the stable doors at once. So, what has happened with this complex agenda? Basel III. A first area of focus was reaching agreement on a new Basel III Accord after the failures of Basel I and II demonstrated by the crisis. Government bank capital, risk management, including management of market risk, macro-prudential regulation, and liquidity risk. Basel I, which imposed a minimum set of capital requirements for banks, had been agreed by the Basel Committee on Banking Supervision in 1988. Ironically, One of its main aims was to weaken the feared competition from undercapitalized Japanese banks, which then promptly failed in the financial crisis of the 1990s. The essence of Basel I was risk weighting of assets, with assets allocated to 5 risk classes. Ironically, and dangerously, these weights treated government debt as riskless and put AAA-rated mortgage-backed securities into the next least risky category. International banks were required to fund themselves with capital equal to 8% of their risk-weighted assets. But that meant far lower ratios of equity capital to assets if the risk weights of many of the assets that individual institutions held were themselves low. Basel II, initially published in 2004, was an extension of Basel I. It paid far more attention to market and operational risks, for example, than had Basel I, and also encouraged banks to use their own value-at-risk models. In the event, the crisis occurred before Basel II had been fully implemented. Basel III is now replacing Basel II, though it is very much the progeny of the 2 earlier accords. It still relies on risk weighting, for example, even though that approach failed in the run-up to the crisis, as noted in Chapter 4. On capital requirements, regulators agreed to raise common equity, plus retained earnings, to 4.5%, up from 2% in Basel II, and Tier 1 capital, including preference shares and perpetual subordinate debt, to 6% of risk-weighted assets. They agreed to add a further 2% in Tier 2 capital and a mandatory minimum 2.5% capital conservation buffer to give room before a firm fell to the regulatory floor. They also decided to add up to a further 2.5% of risk-weighted assets in a counter-cyclical buffer, and a further 1 to 2.5% extension of this counter-cyclical buffer for global systematically important banks, known as GSIBs. Together, this could bring capital, broadly defined, to 15.5% of risk-weighted assets for the GSIBs in good times. The hard minimum of broadly defined capital would be 8% of risk-weighted assets. In addition, Basel III substantially tightened oversight of the risk-weighting procedures adopted by financial institutions. This was partly because the latter had proved hopelessly over-optimistic prior to the crisis, and partly because different institutions applied radically different weights to the same assets. Because risk weighting is vulnerable to gaming by financial firms, policymakers also agreed to impose a leverage ratio without risk weighting. But the ratio under discussion among regulators in Basel has been a mere 3%. Basel III promotes macro-prudential regulation by introducing strong stress tests, estimating probabilities of losses over long time horizons, and calling on regulators to pay attention to the building up of systemic risks. It also made a number of significant changes to liquidity requirements. Finally, it demanded important changes in the structure and conduct of financial markets, better integrated management of market and counterparty risks, stronger capital requirements for counterparty credit exposures, and movement of trading in over-the-counter derivatives towards centralized clearinghouses. Some jurisdictions have gone, or are considering going, beyond these globally agreed minima. The U.S. plans to impose a 5% simple leverage ratio on bank holding companies with more than $700 billion in consolidated total assets. Ensure depository institutions that are subsidiaries of these holding companies must maintain a supplementary leverage ratio of at least 6% to be considered well capitalized. The 8 U.S. bank holding companies, Citigroup, J.P. Morgan, Bank of America, Bank of New York Mellon, Goldman Sachs, Morgan Stanley, State Street, and Wells Fargo, included in the globally agreed list of GSIBs, are affected by these U.S. rules, which are due to come into effect in 2018. Switzerland has told UBS and Credit Suisse, its 2 global systematically important banks, to raise their capital to 19% of risk-weighted assets, of which 9% can be contingent convertible bonds, or COCOs, designed to convert into equity once a preset trigger is breached. The UK's Independent Commission on Banking recommended that the UK's systematically significant banks be required to have a minimum loss-absorbing capacity of between 17 and 20% of risk-weighted assets, including bail-inable bonds. Resolution. A second area of focus has been resolution, particularly resolution of systematically significant banks. Resolution allows the authorities to reorganize the finances of troubled institutions by imposing losses on shareholders and creditors in an orderly way. Individual firms would, at the same time, need to develop their own resolution plans, so-called living wills. The aim of this effort is to eliminate the widely advertised threat of too big to fail. One of the arguments for ring-fencing subsidiaries with separate capital and bail-inable debt, which is debt issued under the clear understanding that it could, and probably would, be converted into equity if the issuing institution was deemed to need additional capital, is that it would make it much easier to resolve banks that get into trouble. Consider, for example, a retail bank with independently capitalized subsidiaries and the bail-inable debt required by the host regulators. The Spanish bank, Santander, or the UK bank, HSBC, might be examples of such federal institutions. Suppose a subsidiary got into serious trouble. Suppose, too, that the parent institution was unable or unwilling to rescue it. Then, the host regulator of the subsidiary could seize the subsidiary and resolve it by converting an appropriate portion of the bail-inable debt into equity. Indeed, with appropriate triggers, this could even happen without regulatory involvement. This is very much the process envisaged by the UK's Independent Commission on Banking. Now turn to the more difficult example of a global investment bank, such as Goldman Sachs or Morgan Stanley, or the investment banking subsidiaries of universal banks. Such banks have integrated global balance sheets and so cannot be resolved by host country regulators without causing global chaos. Far and away the best way to resolve such problems is via orderly resolution of the bank holding company by the home country regulator. The Federal Deposit Insurance Corporation and the Bank of England are cooperating in developing such a single point of entry, known by the acronym SPOE, approach. The aim is to concentrate the losses on shareholders and long-term unsecured debt holders of the parent holding company. To achieve this, the holding company would need to carry an appropriate amount of debt, distinct from the debt of its subsidiaries. The SPOE approach would reduce incentives for creditors and customers of operating subsidiaries to run, and for host country regulators to engage in ring-fencing or other measures disruptive to an orderly resolution of a failing global firm. Employee incentives. A third important area has been employee incentives. The aim is to better align the interests of employees with those of stakeholders, including the public at large. In 2010, the Committee of European Banking Supervisors finalized rules requiring 40 to 60% of the variable pay of bank executives to be deferred for 3 to 5 years and at least 50% of variable pay to be in shares. The Federal Deposit Insurance Corporation has introduced broadly similar requirements for American bankers. In 2013, the European Union imposed a maximum 1-to-1 ratio of bonus to salary. This rule is inevitably controversial. Some suggest it will drive banking outside the EU and raise base pay, thereby making pay more inflexible and creating unnecessary job losses in downturns, and reducing rewards for exceptional performance. But others counter that it will reduce incentives for one-sided risk-taking, thereby turning banks into the sober utilities they should become. Some have proposed going far beyond mere changes in compensation regime. In the UK, the Parliamentary Commission on Banking Standards has recommended that a criminal offense be established applying to senior persons carrying out their professional responsibility in a reckless manner, which may carry a prison sentence. Following a conviction, the remuneration received by an individual during the period of reckless behavior should be recoverable through separate civil proceedings. This draconian approach reflects a widely shared belief that the managers of banking institutions have taken little responsibility for the consequences of their decisions. Structural reform. A fourth area of focus has been structural reform, on which much has happened. The U.S. introduced the Volcker Rule, named after its promoter, Paul Volcker, redoubtable chairman of the Federal Reserve between 1979 and 1987. The rule generally prohibits a banking entity from engaging in proprietary trading or acquiring an ownership interest in, sponsoring, or having certain relationships with a hedge fund or private equity fund. The comprehensible aims of this rule are to reduce conflicts within firms between their own and their clients' interests, and to ensure that any form of implicit or explicit public subsidy is not employed in trading for their own account. The difficulty is that it is hard to distinguish proprietary trading from the essential service of market making. The rule was agreed in December 2013 and is due to go into effect only in April 2014. It is accordingly too early to tell whether it can be made effective, and if so, can also make a difference. The UK's Independent Commission on Banking, of which I was a member, concluded that the rule was not well targeted and would not work well. In the UK, the incoming coalition government established the Independent Commission on Banking in June 2010 under the chairmanship of Sir John Vickers of Oxford University, former Director General of the Office of Fair Trading. In September 2011, the Commission recommended that retail banking be ring-fenced from investment banking in a separately capitalized subsidiary. In the Commission's proposed arrangement, household and small business deposits would be held within the retail bank. Trading activity would be inside the investment bank, and large corporate deposits could be on either side of this ringed fence. The aims of these proposals were to help insulate domestic retail banking from external financial shocks, facilitate resolution of a banking group in difficulty, and make it more credible that the government would not back trading activities. At the same time, the Commission rejected the idea of a full split, rather than a ring fence, arguing that the diversity of businesses within a large group and the diversification of their assets might improve stability in a crisis. The UK government subsequently brought in legislation in line with the Commission's proposals, with the strong support of the Parliamentary Commission on Banking Standards. The Banking Reform Act based on these proposals was passed into law in late 2013. The ICB's recommendations were a response to the worrying fact that before the crisis, the assets of the UK's banking sector amounted to 5 times the country's GDP, largely because of the huge scale of its globally active banks. Indeed, the total assets of the UK banking sector in 2009 were not significantly smaller than those of the US banking sector. In the size of its banks relative to the economy, the UK was like Switzerland and the Netherlands. One of the aims of the ring fence was to protect domestically oriented banking from whatever might happen in the globally oriented activities. Reacting to the publication of the report of the Vickers Commission, the Internal Market Commissioner of the European Commission, Michel Barnier, established a high-level commission under the chairmanship of Irkki Liikanen, Governor of the Bank of Finland, to examine the possibility of a similar structural reform of banking in the EU. The Commission published its report in October 2012. Its central structural recommendation was that proprietary trading and other high-risk trading activities should be assigned to a separate legal entity if the activities to be separated amount to a significant share of a bank's business and are above a certain threshold. This would ensure that trading activities beyond the threshold are carried out on a standalone basis, and separately from the deposit bank. The long-standing universal banking model in Europe would, however, remain untouched, since the separated activities can be carried out in the same banking group. Hence, banks' ability to provide a wide range of financial services to their customers would be maintained. Thus, the Liikanen Commission's structural recommendation was almost a mirror image of that of the UK's Vickers Commission. The former recommended ring-fencing trading from the rest of the business. The latter recommended ring-fencing retail banking from the rest of the business instead. This would leave standard investment banking activities, such as mergers and acquisitions, initial public offerings, and corporate finance, outside both ring fences. Moreover, the Liikanen Commission's proposed ring fence was generously defined. Necessary, not sufficient conditions for considering a separation into a separate entity were that the tradable assets of a bank be 15 to 25% of total assets, or that those assets amounted to at least 100 billion euros. As of the time of writing in early 2014, it is unclear what, if anything, will come of these proposals. The attachment of important European countries, particularly France and Germany, to the universal banking model is powerful. Moreover, how these proposed reforms, if enacted, would fit with the UK's structural reforms, which will be largely in line with the recommendations of the Vickers Commission, remains unclear. Reform of regulatory institutions. A fifth and final important area has been institutional reform. In the U.S., the passage of the Dodd-Frank Act in 2010 established the Financial Stability Oversight Council, charged with overseeing the overall stability of the financial system. In the UK, the government rearranged the entire regulatory furniture, abolishing the Financial Services Authority created in 1997 by Chancellor Gordon Brown, on whom they wished to cast blame for the crisis, and put all prudential regulatory authority inside the Bank of England. As part of this upheaval, the government established a new Financial Policy Committee inside the bank, also charged with overseeing the overall stability of the financial system. Finally, the Eurozone crisis had also triggered a fundamental shift in regulatory responsibility, with oversight moving to the European Systemic Risk Board within the European Central Bank. In all these cases, the power of the central banks is set to increase, though this is least clear in the U.S., where responsibility for systemic oversight was not given to the Federal Reserve. But, given its institutional and intellectual strengths, the Fed seems likely to dominate the Financial Stability Oversight Council. A labor of Sisyphus. In brief, the authorities have responded to the crisis with a bout of frenetic reform. Unfortunately, the new regulatory regime is astonishingly complex and demanding. In a brilliant paper, Andrew Haldane and Vasilios Madouros of the Bank of England note the increasing demands of regulation on many dimensions. Among the most striking is the sheer volume of rulemaking. They write, "Contrast the legislative responses in the U.S. to the two largest financial crises of the past century, the Great Depression and the Great Recession. The single most important legislative response to the Great Depression was the Glass-Steagall Act of 1933. Indeed, this may have been the single most influential piece of financial legislation of the 20th century. Yet, it ran to a mere 37 pages. The legislative response to this time's crisis, culminating in the Dodd-Frank Act of 2010, could not have been more different. On its own, the Act runs to 848 pages, more than 20 Glass-Steagalls. That is just the starting point. For implementation, Dodd-Frank requires an additional almost 400 pieces of detailed rulemaking by a variety of U.S. regulatory agencies. As of July this year, 2 years after the enactment of Dodd-Frank, a third of the required rules have been finalized. Those completed have added a further 8,843 pages to the rulebook. At this rate, once completed, Dodd-Frank would comprise 30,000 pages of rulemaking. That is roughly 1,000 times larger than its closest legislative cousin, Glass-Steagall. Dodd-Frank makes Glass-Steagall look like a throat clearing. The situation in Europe, while different in detail, is similar in substance. Since the crisis, more than a dozen European regulatory directives or regulations have been initiated or reviewed, covering capital requirements, crisis management, deposit guarantees, short selling, market abuse, investment funds, alternative investments, venture capital, OTC derivatives, markets and financial instruments, insurance, auditing, and credit ratings. These are at various stages of completion. So far, they cover over 2,000 pages. That total is set to increase dramatically as primary legislation is translated into detailed rulemaking. For example, were that rulemaking to occur on a U.S. scale, Europe's regulatory blanket would cover over 60,000 pages. It would make Dodd-Frank look like a warm-up act. Cynics will be reminded of the remark in Giuseppe Tomasi de Lampedusa's Il Gattopardo, "If we want everything to stay the same, everything must change." They will conclude that this manic rulemaking is designed to disguise the fact that the thrust of it all has been to preserve the system that existed prior to the crisis. It will still be global. It will continue to rely on the interaction of vast financial institutions with freewheeling capital markets. It will continue to be highly leveraged, and it will continue to rely for profitability on successfully managing huge maturity and risk mismatches. But the new structure of regulatory oversight and rules displays something equally important: the breakdown of trust between authorities and finance. That was hardly surprising, given the huge costs of the crisis. Nevertheless, the authorities want largely to preserve a system they also mistrust. That is why the regulatory outcome has been so complex and insanely prescriptive, though that has also been affected by the complexity of modern finance itself and by lobbying. The question remains: will this complex regulatory effort deliver a financial system that is both robust and dynamic? In essence, after all, we need a financial system that will cope with inevitable shocks while not generating huge shocks of its own. Will these reforms provide it? In a word, no. The sheer complexity of the regulatory structure makes it virtually inconceivable that it will work. Nobody in charge of a bank is going to know and understand all the rules it is supposed to obey. Indeed, nobody is, but they in the regulatory bodies or the regulated institutions. Operating in such a regulatory quagmire makes it certain that institutions will end up operating contrary to the rules without meaning to do so. It will also create pervasive uncertainty. It is highly undesirable. To illustrate the problems beyond these crucial points about complexity and uncertainty, this chapter will look at two central issues: capital and macroprudential regulation. But it will first look at ideas for more radical reform. The case for radical reform. There is a simple and telling reason why, notwithstanding all the regulatory reforms, the system is bound to fail again and again. It is designed to do so. The reason for this, elucidated in chapters 4 and 6, is that the fragility is built in. The financial system makes promises that, in certain states of the world, it cannot hope to keep. The reason for this is that institutions finance long-term, risky, and often illiquid assets with short-term, safe, and highly liquid liabilities. The people who provide the funds regard their deposits and other loans as a very close substitute for, if not exactly the same thing as, money. But the assets held by the institutions to which they have lent are not in the least like money. They are subject to significant solvency and liquidity risks. At a time of trouble, providers of funds will panic. It always makes sense to try to be among the first to leave a burning theater, or even a theater that might be burning. In withdrawing their funds, providers will trigger what they fear. The assets held by the institutions will be dumped at fire sale prices, turning illiquidity into insolvency. For example, AAA-rated subprime asset-backed securities lost 2/5 of their initial value by February 2009, devastating the net worth of any leveraged business that held a large quantity of these supposedly safe assets. This is the world's Faustian bargain. Some, such as members of the Austrian school and the authors of the Chicago Plan, discussed in Chapter 6, argue for a drastic solution. Abolish it. Make term-transforming finance in general, and conventional banking in particular, illegal. Replace it with 100% reserve banks, which cannot fail, using the huge additional demand for reserves at the central bank to back the deposits of the public at commercial banks as a way to finance the government. Charles Goodhart of the London School of Economics, doyen of British analysts of finance, responds to such suggestions as follows. A problem with proposals of this kind is that they run counter to the revealed preferences of savers for financial products that are both liquid and safe, and of borrowers for loans that do not have to be repaid until some known future distant date. It is one of the main functions of financial institutions to intermediate between the desires of savers and borrowers, that is, to create financial mismatch. To make such a function illegal seems draconian. We permit many things that are far less than perfectly safe. Consider motor cars or aeroplanes. These are regulated, but not banned, because their benefits exceed their costs. That, as I noted in Chapter 6, is what that shrewd and practical observer, Walter Bagehot, believed about banking and the money markets. Yet we can identify two exceptional features of finance, as distinct from other examples of risky products and activities. First, it has huge negative externalities. That is, the irresponsibility of some can create a generalized panic and crisis. And, second, the economic and social costs of financial crises are enormous. In the UK, for example, the financial crisis has delivered the fourth worst fiscal shock in the last 200 years, after the Napoleonic Wars, the First World War, and the Second World War. Relative to the pre-crisis trend, it seems quite likely to cost something quite close to 6 times annual GDP. It might be much worse. In Ireland, the crisis has imposed a rise in net public debt of close to 100% of GDP. Professor Goodhart is right in saying there is a strong preference for a financial system that mismatches maturity, not to mention riskiness. But one must ask, at what price? The upheaval involved in moving towards anything similar to the Chicago Plan or Kotlikoff's updated version might be large. The same is true of plans to replace conventional banking with government-created money. It is understandable that few want to take the risk of embarking on such a contentious and complex reform. Bankers managed to see off the Chicago Plan even in the depth of the 1930s. Nowadays, their task would be far easier because the slump has thankfully been milder. A halfway house to a shift to the Chicago Plan does exist, however. It would consist of insisting that demand deposits, or maybe just insured deposits, would be backed by safe and highly liquid assets, central bank reserves, or short-term government securities. This is narrow banking. Such narrow banks could be separate institutions or parts of bigger ones. The problem with narrow banking, to which both the Chicago Plan and limited-purpose banking might be an answer, is that the fragility would migrate elsewhere in the system, as happened with shadow banking. The Federal Reserve had no plans for intervening in money market funds or wholesale markets, though the latter is where many of the most significant mismatches had migrated. Thus, if narrow banking were really to work, it would be necessary either to ensure that the fragility did not emerge somewhere else, previously unrecognized in the financial system, as the more radical proposals for reform suggest, perhaps by insisting that all of their finance took the form of equity contracts, or to make it credible that the central bank and government would never intervene to help the rest of the financial system if it fell into trouble. But such a promise is, as economists inelegantly say, time inconsistent. If someone had asked the Federal Reserve whether it would ever bail out AIG, the shadow provider of shadow capital to the shadow banking system, its answer would surely have been no. But that was before September 2008, and then suddenly, it was another world. It would be fascinating to see the Chicago Plan, or Kotlikov's limited-purpose banking tried. Even an experiment with narrow banking would be informative. But the difficulties involved in making such a transition would be huge. So, let's first consider less radical ways of buttressing a system that would still be much like our own. For that, we must begin with equity, the only, unquestionably loss-absorbing form of finance. A capital solution. A bank can fund its assets with two sources of funds, equity and debt. Depositors often believe that the money they have put into their bank belongs to them. In fact, it's just part of their bank's debts. Of course, they are a politically important part of a bank's debts. This is why deposit insurance has become universal. It's unthinkable that banks would be allowed to default on small deposits in a universal suffrage democracy. Indeed, when Iceland's banks got into such severe difficulty in 2008, the government imposed default on their foreign creditors, since the combined balance sheets of the banks, at 11 times GDP, were far too big for it to guarantee. But it protected domestic depositors. Elsewhere, in the worst of the crisis, blanket government guarantees turned not just the insured deposits, but almost all bank debt, effectively into public debt. In some cases, the creditworthiness of the state was put at risk in order to guarantee the debt of banks. Ireland is an extreme example of this unconscionable development. The debt taken on by the Irish state, merely to fund the bailout of the creditors of its banks, was around a third of GDP. The business model of banking. A cynic would say that the business model of banks consists of creating enormous quantities of explicit and implicit public debt, in the UK case, not far short of 5 times GDP, as a byproduct of their other activities. That is why one might view bankers as merely exceptionally highly paid civil servants. But creating implicit public debt is not the whole of the business model. The other, and closely connected, part is minimizing reliance on shareholders' equity as a source of funding. It is then easy to set a high target for the return on equity, unadjusted for risk. Before the crisis, that target used to be 15% or even more. Achieving that target was then used as a benchmark for paying out generous bonuses to employees. In a non-financial business, promising to raise the return on equity by increasing the ratio of debt to equity, that is, by increasing the leverage, is not seen as a wealth-enhancing strategy. It is a zero-sum speculative strategy. Indeed, one of the fundamental theorems in finance, known as the Modigliani-Miller theorem, after its discoverers, Franco Modigliani and Merton Miller, both winners of the Nobel Prize in Economics, is that the way a business is financed does not influence how valuable it is, apart from any tax benefits from leverage. Finance merely determines how risk is distributed among those who fund the business. Indeed, since bankruptcy is normally destructive, and high leverage makes bankruptcy more likely, well-established businesses generally avoid it. If British Petroleum, BP, had been as leveraged as a bank, the disaster in the Gulf of Mexico in 2010 would have bankrupted it. Higher leverage makes debt riskier, and so its cost higher. The expected return on equity rises, but this is compensation for the rising volatility of the returns. The investors who buy shares in businesses with risky funding models are those who like the combination of higher return with higher risk. When banks tell the world that their shareholders want the high expected returns they promise, they are probably right. But the shareholders are self-selected. People who would like an expected return of, say, 8% with low volatility would not now buy bank shares. When banks told shareholders they intended to earn 15% returns on equity, they were telling them they intended to run a risky business. They were also, as we know, telling the truth. There is, however, one reason why high leverage might be attractive to shareholders, even in the absence of government guarantees. Debt overhangs. In their important book on the perils of high bank leverage, Professors Anat Admati of Stanford University and Martin Helwig of the Max Planck Institute for Research on Collective Goods used the example of Kate, a woman who has borrowed $270,000 to buy a house for $300,000. Suppose she inherits $50,000 and uses that money to pay off part of her loan. She then owes $220,000. Now, the creditor is fully protected against loss if the house loses $80,000 in value, instead of the protection of $30,000 the creditor obtained from Kate's initial equity. But what does Kate gain from putting an extra $50,000 into the house? She gains nothing, unless her rate of interest is lowered. If she cannot obtain a reduction in the rate of interest she pays, Kate has no incentive to repay any of the loan because the benefit goes to her creditor, not to her. If she can find an investment with a higher post-tax return than the cost of her mortgage, she should put her money into that instead. If the value of her house rises, Kate will even have an interest in adding a second mortgage to limit her potential losses. Now, consider an extreme, but alas plausible, scenario for both house buyers and banks. Suppose Kate's house fell in value to $150,000. Her equity in the house would then fall from plus $30,000 to minus $120,000. If she were to put her inheritance of $50,000 into repaying the mortgage, she would still owe $70,000 more than the house was worth. On the assumption that this is a non-recourse loan, one where the creditor has no claim against her assets or income beyond whatever the house is worth, the only entity that would benefit from her putting in the extra $50,000 is the creditor, whose loss would be reduced by that amount. Kate would gain nothing. It would make more sense for Kate to put her $50,000 in a risky investment. If it came off, the money would be hers. If it did not, she would be no worse off than if she sank the money into her house, since this would only benefit her creditor. It does not matter to her, after all, whether her creditor loses $120,000 or $70,000. Her loss is still limited to the initial $30,000 she invested. So Kate would choose gambling for resurrection. It is what one would expect anybody with negative equity to do. This is also relevant to banks. These are businesses with next to no equity in good times, whose shareholders enjoy the benefits of limited liability. In other words, loans to banks, or any other company, are non-recourse. If the bank were to fall into negative equity, extremely likely to happen, in fact, given how leveraged they are, the downside would no longer matter to shareholders, since the losses fall on creditors or the government. So it would make sense to gamble on resurrection or go for broke. They can do this quite easily by taking on riskier loans and adopting riskier trading strategies. Yet banks also enjoy explicit and implicit guarantees from the state, as is true of some house buyers. This means that not only shareholders, as we have seen, but even creditors fail to benefit if the shareholders decide to put more equity into the business. The only people who benefit from there being more equity in banks are taxpayers and other outsiders. Thus, those engaged in the wider economy would be less likely to suffer the results of a contagious panic and a huge recession if banks were better capitalized. In this situation, what is the optimal amount of equity for shareholders to put in? The answer is as little as they can get away with. In the run-up to the crisis, that turned out to be amazingly little. Just before the crisis, the median leverage ratio, that is, ratio of debt to equity, in UK banks, that is, the value in the middle of the distribution, not at the extremes, was 50-1. In other words, the median equity, that is, the equity of the bank in the middle of the distribution, was roughly 2% of assets. And this means that the value of those assets needed to fall about 2% before the business was bankrupt. So the business model of contemporary banking is this: employ as much implicitly or explicitly guaranteed debt as possible, employ as little equity as one can, invest in high-risk assets, promise a high return on equity unadjusted for risk, link bonuses to the achievement of this return target in the short term, ensure that as little as possible of those rewards are clawed back in the event of catastrophe, and become rich. This is a wonderful business model for bankers. But how is it for the rest of the world? The evidence suggests executives fared spectacularly well, but even shareholders have fared poorly. For everybody else, it was a disaster. The solution seems clear. Force banks to fund themselves with equity to a far greater extent than they do today. A fragile business based on extreme maturity and risk mismatches, that is, long-term and risky assets funded by short-term liabilities and notionally safe liabilities, needs the capacity to bear large losses, particularly if failure is likely to cause a global economic meltdown. Much higher equity would protect creditors, remove debt overhangs, and eliminate the shareholders' incentive to go for broke. It would also make government promises not to save creditors more credible, since the failure of one institution would be less likely to bring down many others. A case for higher capital. So, how much capital would do? A great deal more than the 3% ratio being discussed in Basel is the answer. How can anybody seriously imagine that it is sensible to allow such important businesses and ones whose failure would cause such damage to operate with such a tiny equity cushion? A mere 3% decline in the value of its tiny assets would bankrupt the business. Well, before it reached that point, the bank would be unable to raise funds on market terms and would cease to be a going concern. If one wants to understand why such tiny equity slivers will not do, just look at the reported profits of the U.S. financial sector during the 2007-2008 crisis. The banking system was able to bear huge losses because it is so cyclical. Remember, too, that without government intervention, the losses would have been vastly bigger, as financial institutions went down like bowling pins. An important paper co-authored by David Miles, a member of the Bank of England's Monetary Policy Committee, recommended that bank capital be at least 20% of risk-weighted assets. Their fascinating analysis is based on the actual volatility of GDP for many countries over the past 200 years, and on the assumption that changes in the value of the risk-weighted assets of banks would be proportional to changes in GDP. It also assesses the present value of the economic costs of a financial crisis that would follow a large negative shock to the economy. This turns out to be at least 140% of GDP. The conclusion of their cost-benefit analysis is that leverage should be a half to a third of what is proposed now, which would imply a ratio of common equity to bank assets of about 10%. But the required equity could well be even higher. that depends on the chances of even bigger shocks and the benefits of a banking system able to survive them. The paper even argues that under certain not implausible assumptions, the right level of capital might be 45% of risk-weighted assets, more than 20% common equity. In their book, Admati and Helwig suggest a ratio of up to 30% common equity. There can be no exact science in this. Nobody knows, for example, how big the losses of banks might be in a future crisis, but it is worth stressing that fairly small underlying losses triggered the devastating recent series of financial crises in high-income countries. Future crises could easily be bigger. Nobody knows either whether higher equity would mean a, or even any, significant loss of economic opportunities, though lobbyists for banks suggest that much higher equity ratios would mean the end of our economy. This is wildly exaggerated. After all, banks are for the most part not funding new business activities, but rather the purchase of existing assets. The economic value of that is open to question. Moreover, the market would presumably generate alternative ways of financing good investment opportunities if highly leveraged bank lending were reduced. Finally, the degree of safety that is to be chosen is a matter of values. How much risk a society is willing to take is something it has to decide for itself. In making that decision, it also has to decide how much banking risk it can bear, which will depend on the size of the banking sector relative to the economy and the solidity of the government's financial position. In all, one might regard a leverage ratio of 10-to-1 as a reasonable maximum, and so an underweighted common equity ratio of 10% as a minimum. Moreover, it's also vital not to rely much on risk weighting. Andrew Haldane and Vasilios Maduros conclude, from an analysis of failure among 100 of the world's biggest and most complex banks in 2006, that simple weighted measures of capital appear to have greater pre-crisis predictive power than risk-weighted alternatives. Keep it simple, stupid, is as good a rule in regulation as it is in life. There is yet another reason for emphasizing equal weighting of all risks rather than complex risk weighting. The latter gives a strong competitive advantage to megabanks, able to manipulate complex models. It would be best, then, to rely first on a straightforward leverage ratio, but add to it for the big banks whose failure would cause the biggest damage. Risk-weighted assets can play a secondary role. That way one would have a belt and braces approach, a strong leverage ratio plus a risk-weighted capital ratio as a backup. There's no doubt that substantially greater capital, measured at market value, not on an accounting basis, would bring greater stability to the banking system. There is also no doubt that financial crises are spectacularly costly. Furthermore, there is no doubt that banks do not internalize those costs. Moreover, would a bank now happily lend to borrowers with just 3% equity in their business or home? Hardly. So why should governments permit institutions as important as banks to operate with such small equity cushions? The case for higher capital requirements seems overwhelming. It also has the great merit of being relatively simple, particularly if the capital that regulators rely upon most is common equity, with no risk weighting of assets measured at market value. Objections to higher equity capital. The demand for substantially higher equity capital is controversial. That is hardly surprising, since it would kill the lucrative business model of banking on the state. So what are the objections? There are 7. First, it is objected that higher equity capital would be expensive for banks because the money sits on banks' balance sheets and essentially can't be invested to bring in more profits. This is a surprisingly common blunder. Such comments show a confusion between liquid assets, such as government debt, which banks do indeed hold, with equity, which is just a way of funding the balance sheet, its advantage being that it is unambiguously loss-bearing. In other words, this reveals a fundamental confusion between the two sides of banks' balance sheets, their assets, which are what banks own, and liabilities, which are how banks fund themselves. Equity is a liability. It is a way of funding a bank, not an asset or investment owned by a bank. Equity in banks is an asset of shareholders. Second, it is objected, as I have just noted, that higher capital would be too costly to the banks. This objection is at least intellectually coherent, albeit wrong. The general answer is that it would cost nothing, except to the extent that it reduced the benefits to the bank of the tax deductibility of interest, which would not be a cost to society, or reduced the benefits to the bank of state guarantees of bank debt, which would be a gain to society. Otherwise, the effect of lower leverage in raising the cost of funds should be offset by a lower expected return on equity, because the volatility of returns would fall, and a lower cost of debt, because bank liabilities would be safer. In his co-authored paper, Professor Miles concludes from an empirical examination that a halving in the leverage of British banking from 30-1 to 15-1, assets over Tier 1 capital, such as common equity, retained earnings, and preferred stock, would raise the weighted average cost of all capital by a mere 18 basis points, or 0.18%. Of course, this would still leave leverage too high, but a move to 10-1 or far lower would not impose prohibitive costs. Of course, it would lower the return on equity, but such a reduction would be highly desirable. It would reflect a decision to make banks safer. Higher capital would only be bad for bankers, who could no longer make themselves rich by promising high risk-adjusted returns on equity with a straight face. Third, it is objected that demanding higher bank capital would damage the economy. As Frank Keating of the American Bankers Association argues in the opening quotation of this chapter, capital comes at a cost, both to banks and to the economy at large, in the form of foregone lending as institutions shrink to meet extreme capital-to-asset ratios. Bankers frequently argue that if their overall lending were restricted, business must suffer. But the loans on the balance sheets of banks are overwhelmingly not to business, but rather to households and other financial companies. In the case of the UK, for example, as of August 2013, 34% of outstanding lending from banks was to other financial businesses. 43% was to individuals, secured on dwellings. 4% was to other loans to individuals. 10% was to real estate and construction. And the remaining 9% was to all other beneficiaries, including to non-financial businesses, other than real estate and construction. Banks could reallocate their funds toward funding business if they wanted to do so, or found it sufficiently profitable to do so. This would also be desirable. Loans to other financial institutions are an indicator of the complex network of connections among banks, which exacerbated the panic in 2008-2009. Most loans to households and a large portion of the loans to business simply leverage up the property assets of the country, thereby creating significant fragility for at least questionable economic gains. The benefits of further rises in lending for home purchase, in particular, are therefore social rather than economic. Such lending widens homeownership, albeit at the price of imposing heavy mortgage burdens on young households. Moreover, recent work, notably at the Bank for International Settlements, indicates that increasing the financial development of the economy beyond a certain point lowers productivity growth rather than raises it. Many of the high-income countries seem to be beyond that point. Alan Greenspan has made much the same argument in a more sophisticated form when he said, "Any excess bank equity capital also would constitute a buffer that is not otherwise available to finance productivity-enhancing capital investment." In other words, equity, being scarce, should not be wasted on making banks safer. This is a puzzling argument. Remember that equity is not an idle buffer. It is merely another liability of banks, just like their debt, and so a safer and less crisis-prone way to fund lending. Furthermore, if more equity went to funding banks, then the leverage in other, today far less leveraged, businesses would rise as equity shifted towards banking. That would make the economy as a whole less vulnerable to waves of financial sector bankruptcy, but without affecting its overall wealth. After all, as Mr. Greenspan himself notes, consolidated, the net capital stock of a nation must equal the sum of the equity of households, businesses of governments, adjusted for the national's net international investment position. A nation's debt nets out to zero if one ignores claims on and liabilities to foreigners. Shifting equity from one sector would not change the total net equity or wealth of a society. Net equity claims of the public held via banks would increase, and net equity claims held via direct investment would shrink. That's all. In February 2014, 5% of the value of the U.S. stock market and 12% of the value of the UK equity market consisted of shares in banks. Assume that the total equity of banks had to rise threefold, and then other companies reduced their equity by borrowing, with the total value of the stock market remaining the same. Then, on the same date, the market capitalization of U.S. banks would be 19% of the U.S. stock market and 55% of the UK stock market. The former looks conceivable, the latter does not. But UK banks are global entities. The likelihood is that many of the shares would end up being held by foreigners. Indeed, the companies in the UK stock market hold so many foreign assets that looking at this as a national market is highly misleading. Nonetheless, it is unlikely that the world's shareholders would want so much of their wealth, net claims on the economy, to be channeled through and managed by a small number of very big banks. The likelihood, then, is that if equity requirements were raised, the balance sheets of the banks would be forced to shrink, and risk-taking would move outside the banking sector. In and of itself, this would be hugely desirable, though it would involve a significant transitional problem, and new institutional forms might need to be created for the finance of entities that could not borrow directly in the bond markets. Among other things, the revival of markets in securitized debt would be necessary, but, crucially, the risk-taking capacity of the society would not fall, because its total equity would not fall. During the possibly lengthy transition, it would be possible to raise the equity of banks other than by letting them shrink their balance sheets. The obvious way to achieve this would be to prevent them from paying dividends or buying back their shares until equity has reached the level needed to fund desired balance sheets at lower leverage. Yet it is of course possible, even likely, that today's huge stock of bank assets could not generate the returns on equity desired by shareholders at lower leverage. This would be because a previous subsidy, free implicit insurance provided by governments, which encouraged excessive leverage in the economy, is being withdrawn. The government might wish to use some of that now withdrawn subsidy to pay for deleveraging directly by promoting the write-down of excessive debt. A more subtle argument that Mr. Greenspan might be making is that if banks were to be still allowed to create leverage on the present scale, the total quality of economic activity would be greater than it otherwise would be. This would be true, however, if and only if the economy had redundant resources that could be mobilized in this way alone. But it would be possible to achieve the same effect by exploiting the ability of the central bank or the government to create money directly and spend it within the economy, or transfer it to citizens or residents to spend in the economy. Mobilizing redundant resources does not depend on allowing the banking sector to become massively and dangerously leveraged. In addition, if the problem with lower leverage is that bank loans would become more expensive to borrowers, the central bank can lower interest rates. at least when it's not up against the zero bound. Even in the latter situation, the government could lower the cost of bank loans by targeting subsidies rather than by permitting excessive leverage. Also, remember that crises due to excessive leverage impose enormous costs. For this reason, a study prepared for the Basel Committee on Banking Supervision concluded that the net economic impact of significantly higher capital standards was strongly positive because they could lower the incidence of crises significantly. Fourth, it is objected that illiquidity is a more important danger to banks than lack of capital. The response is well laid out by Professors Admati and Hellwig when they write, "If institutions are highly indebted, it does not take much of a shock for solvency concerns to arise. Such concerns can lead creditors to withdraw their money as soon as they can, causing liquidity problems for banks. Moreover, acting as lender of last resort becomes far easier for the central bank if it has no doubt about the solvency of the institution it is temporarily funding." Professor Goodhart makes the suggestion that a bank's capital requirements might be lowered as its liquidity position strengthens, or raised as it weakens. Thus, the closer it became to becoming a narrow bank, the lower its capital requirements would be. Fifth, it is objected that shrinking the balance sheets of banks must lead to a calamitous shrinkage of the money supply. This can be answered in part by ensuring that balance sheets do not shrink, by insisting on target levels of equity rather than ratios. But there are at least two other considerations. One is that it's hard to believe that the borderline between money and non-money is well defined in today's economy. This is why reliance on the quantity of money in monetary policy turned out to be so disappointing. The other consideration is that the central bank can create money by other means if it wishes to do so. One possibility would be to continue to purchase assets from the non-bank private sector, thereby raising the latter's holdings of cash and increasing the reserves of banks. In order to prevent this from leading to the shrinkage of bank holdings of other assets, the regulator would need to specify that the holding of central bank reserves does not count against a bank's capital. This obviously makes sense, since default by the issuer of a fiat currency is inconceivable. Sixth, it is objected that the combination of bail-inable debt, meaning debt that is contractually available for conversion into equity if required, with effective resolution regimes, is an adequate substitute for higher capital requirements, while allowing banks to continue to benefit from the tax deductibility of interest. There are at least two general problems with this. The first is that the lower the equity and the more plausible bail-in becomes, the more the bail-inable debt would have the characteristics of equity, in which case it would not be a cheaper alternative for banks, apart from tax deductibility. Second, the combination of resolution with bail-in of certain classes of debt generates the risk of a funding cliff. As banks approach the trigger point, willingness to buy such securities might dry up completely. This is why governments save the owners of hybrid securities, debt securities supposedly convertible into equity, in the crisis. They turned out to be useless as a way of creating equity for undercapitalized banks. The trigger of conversion of hybrid debt turned out to be time inconsistent, a promise the authorities did not dare to keep. Triggering conversion would be less of a problem if hybrids had very long maturities, but that would merely make them even more like equity, so why not just rely on equity? The most intriguing proposal aimed at getting round such difficulties is for the Equity Recourse Notes, or ERNs, proposed by Jeremy Bulow of Stanford University, Jacob Goldfield, formerly at Goldman Sachs, and Paul Klemperer of Oxford University. ERNs are a form of contingent capital that would start life as debt, but convert to equity payment if the issuer suffered large losses in market value. The market would trigger conversion, while the value at conversion would be tied to the share price on the date of issue. If, for example, an ERN were issued when a bank's share price was $80, the bank would be required to pay in shares on any subsequent date on which an interest or principal payment was due if its shares traded at less than 25% of the price on the issue date, in this case $20. The issuer would have the right, but not the obligation, to pay in shares if the stock were trading at a higher price than this. Moreover, the shares would be valued at the trigger price. In the example, if a payment of $100,000 were due to bondholders and shares were trading at or below $20, the bank would be required to pay out 5,000 common shares. That's $100,000 divided by $20. Finally, the conversion would take the form of payment when due. Whether any given payment is to be made in shares or cash is determined by the share price on the due date of the payment. In the example, if the share price were $18 on one payment date, but climbed to $22 on a later payment date, the bank would have to make the first payment in shares, but would have the option of making the second payment in cash. It is evident that this form of debt would become equity automatically if it were needed. That makes it an attractive form of bail-inable debt. But is it superior to equity, apart from the fact that it should benefit from the unjustifiably favorable tax treatment of debt? The answer is, maybe so, but not obviously. Proponents argue that ERNs have a number of advantages over equity. Thus, although ERNs are always equity in the states of the world that matter for protecting taxpayers, they remain debt in other states, and many also argue that equity is intrinsically more costly than debt, rightly or, more plausibly, wrongly. Again, since ERNs represent an apparently less radical, though also more unfamiliar, alternative to more equity, it might be possible to require significantly more capital in this form than in the form of common equity. Proponents also argue that with higher equity, riskier activities might migrate to other parts of the financial system. They suggest, as well, that people might believe banks with high equity are so much safer that management and regulators would become laxer and more accident-prone. Yet none of these arguments is decisive. The assertion is frequently made that equity is costly, but the reasons for this are never made entirely clear, if we leave aside fiscal and other subsidies. Furthermore, with higher leverage, the debt overhang problem continues. Shareholders would have less interest in running a bank prudently because much of the benefit of their doing so would accrue to creditors, including, surely, owners of ERNs. Again, if ERNs were seen as an onerous and costly regulatory requirement, as is inevitable, then the pressure for migration of risk to other parts of the industry would remain. To reiterate, if high equity ratios made management and regulators lax, so would ERNs. Indeed, they might be worse because owners of ERNs would have no managerial control over the bank before conversion into equity. There might also be enhanced instability as a bank's share price comes close to a trigger point. Moreover, the advantage of ERNs in halting a cash drain when a bank became distressed might be available to equity if the latter included a provision allowing a halt to payouts when share prices reached a trigger point. In all, while ERNs are clearly an excellent form of bail-inable debt, it is not clear they are superior to additional equity. In general, the simple beats the complex if it does the same job, and equity is simpler than complex hybrids. A seventh objection is that relying solely on leverage relative to total assets, rather than relative to risk-weighted assets, again, risks arbitrage, with banks choosing riskier assets since they would not be penalized for doing so and might, in this way, hope to meet their return on equity targets. Peter Sands of Standard Chartered has made this argument. But shareholders should only be interested in their risk-adjusted returns. If taking on more risk does not raise risk-adjusted returns, shareholders should flee. If it does raise risk-adjusted returns, it should have happened anyway. Moreover, with substantially higher equity, banks could take on more risk safely. Finally, the disaster came from what banks wrongly thought to be safe. Risk weighting is extremely unreliable because the samples from which the weights are derived are always too small or irrelevant. A similar objection arises over regulatory arbitrage. With high levels of equity imposed on banks, risk would migrate elsewhere, as happened prior to the crisis of 2007-2008. It would be extremely important, therefore, to ensure that the balance sheets of significant financial institutions are fully consolidated. It would be equally important to ensure oversight over the system as a whole to check where risks might be emerging. This is part of macro-prudential regulation, to which we turn in the next section. Raising the capital requirements of banks would certainly not fix everything. But if it were combined with significantly higher capital requirements still for the biggest and most interconnected institutions, it would take us a very long way in the right direction, in a relatively simple manner. Indeed, the higher the capital requirement, the less important changes in structure become. Mr. Haldane and Mr. Maduros add the possibility of taxing interconnectedness, which would seem to make much sense. But capital is key. A basic leverage ratio of 10-to-1 with conservation, countercyclical, and large firm buffers at top might lead to leverage ratios in good times of 6-to-1. That would be a vastly safer system. The many changes now underway do not do the simple thing that would render the financial system less fragile, make it far better able to bear losses. Indeed, so long as the system allows leverage of 30-to-1, these businesses are designed to fail. The belief that failure of a business can be managed smoothly and without systemic effects, with hybrid capital instruments, resolution regimes, and living wills, is naively optimistic. Being macro-prudent. Making sure that individual financial institutions, and particularly large global institutions, fund themselves with more equity capital is the most important way to make them, and so the system as a whole, more resilient to the inevitable shocks. But there is another equally important challenge, that of ensuring the resilience of the system as a whole. That is the task of a newly discovered regulatory activity, macro-prudential supervision, the official label for the job of regulating the stability of the financial system as a whole. So, can it work? First, here's some background. The fundamental assumption of orthodox policy prior to the crisis was that the combination of inflation targeting with micro-prudential supervision would deliver stability. Should it, by any chance, fail to do so, it would be better to be clean than lean, meaning it would be both easier and more effective to clean up a financial mess after it had emerged than use monetary policy to try to prevent it. This orthodoxy has taken a hammering. It's now generally agreed that it's hard to clean up after an asset price bubble accompanied by, or indeed caused by, a credit boom. So this is where macro-prudential policy comes in. The idea of macro-prudential regulation is to look at how the activities of the financial system as a whole are destabilizing the economy and so increasing risks for all financial institutions. This raises 5 big questions. 1. What is this regulation for? 2. Why is it needed? 3. How should it be done? 4. Who should be in charge? And 5. Will it work? The purpose of macroprudential policy. Macroprudential policy has two mirror image functions. 1. To protect the financial system from the economy, and 2. The economy from the financial system. In its former guise, macroprudential policy recognizes that a monetary policy designed to achieve price stability can encourage destabilizing developments in the financial system. The aim, then, is to prevent or at least reduce the undesirable consequences of such a development. In this guise, then, macroprudential policy is concerned with financial stability. It works by, for example, raising equity requirements of lenders or borrowers in a boom. In its latter guise, macroprudential policy is aimed at protecting the economy from the excesses of the financial system in both boom and bust. It works by actions that curb lending. Macroprudential regulation borders on microprudential regulation at one end and monetary policy at the other. In theory, targeting monetary policy at price stability and macroprudential policy at financial policy ought to work, at least in normal times. When interest rates are at the zero lower bound, however, the problem will be far bigger. With a badly damaged financial system, monetary policy works badly, if at all. So, fixing the financial system, a task for macroprudential policy, becomes a necessary condition for effective monetary policy. Alternatively, another macroeconomic policy, probably fiscal policy, needs to be employed. Moreover, if monetary policy has historically worked by creating destabilizing financial bubbles, as argued in Chapter 5, the new macroprudential policy might weaken the effectiveness of monetary policy, possibly making the zero lower bound a more frequent event. In short, the assumption that targeting monetary policy at price stability and macroprudential policy at financial stability will be easy is optimistic. The need for macroprudential policy. The argument for macroprudential policy is that a financial system in which individual institutions look sound may be unstable because of their exposure to and generation of common risks. Each institution may be diversified, but they will be vulnerable if all are diversified in the same way. Worse, being subjected to similar microprudential regulation makes it more likely that firms will end up being diversified in the same way and exposed to many of the same risks. So what are the common risks to which financial firms might be exposed? An obvious example is to the economic cycle, or worse still, the property cycle. A second set of shared risks will be the same funding markets. A third set of shared risks will be the same accounting rules, particularly mark-to-market accounting in a crisis. A fourth set of shared risks will be the same suppliers of insurance against shared risks. A fifth set of shared risks will be use of the same risk management models. A sixth set of shared risks will be the rating agencies. And a seventh set of shared risks will be the same regulatory standards implemented in the same way. A system becomes risky if all its members are significantly exposed to the same risk. Riskiness of the system as a whole is quite different from the perceived riskiness of individual institutions. National banking families become risky when all their members are risky in the same way. They become safer when their members are risky in different ways. Yet there is something more to it even than that. It's not only that members of the financial system are exposed to common risks, it's also that they generate common risks for one another and for the economy as a whole. Financial systems are not just absorbers of risks, but creators of risks. This, in essence, is why macroprudential policy is necessary. The implementation of macroprudential policy. Macroprudential policy needs to be as automatic and non-discretionary as possible. It's desirable, for example, to relate capital requirements of, or provisioning by, financial institutions to the rate of credit growth. The faster the latter, the higher the former. It will be crucial to ensure that not only institutions, but the mass of their borrowers can take large losses without too much difficulty. Similarly, it will be important to impose constraints in the form of charges or higher capital requirements on extreme maturity transformation, that is, the funding of ultra-long-term and risky assets with short-term and safe liabilities. Much of this can, in principle, be done automatically. But there are some things that cannot be done in a mechanical way. One of the most obvious is watching over regulatory arbitrage. If risks are migrating out of the formal system, regulators will need to remain very alert. Unfortunately, this is not the only area where discretion will be necessary. Another is being aware of the systemic risks created by regulation, particularly the tendency to force regulated institutions to take the same risks in the same way, and so become more homogeneous and thus more exposed to identical surprises. Monocrop economies are vulnerable to a disaster to that one crop. Similarly, mono-risk financial systems are also vulnerable to concentrated disasters. The responsibility for macroprudential policy. Given the close connection between macroprudential policy and monetary policy, the responsibility should rest with the central bank in conjunction with the prudential regulators. It's not clear whether or not a separate group should be responsible for macroprudential policy. The argument in favor of a separate official body is that it should include expertise not relevant to monetary policy, such as that of the prudential regulator. The argument against is that monetary policy and macroprudential policy will interact closely and frequently will be alternative ways of achieving the same objective. It will be desirable for countries to experiment with the alternatives of separation and integration. In any case, monetary policymakers will have to be very aware of what the macroprudential regulators are trying to do, since it will have a profound effect on the course of monetary policy. The effectiveness of macroprudential policy. Finally, will it actually work? Nobody knows. The idea that it might is an example of what Friedrich Hayek would have called the fatal conceit, the assumption of knowledge where it does not exist. On the other hand, the alternatives to trying all seem to be worse, having further huge crises or relying on the blunt instrument of monetary policy. But it also has to be recognized that the macroprudential regulators will be subject to political pressures, to conflicts with the direction of monetary policy, and to their own ignorance. It is a valiant but risky undertaking. That is why higher capital is so important. If crises will still happen, as Minsky argued, then the core of the financial system has to have the ability to survive, just as bridges need to survive hurricanes. Conclusion. The reaction to the crisis has included a host of ambitious regulatory efforts. Many are important, but two seem to be vital: raising capital sharply and making macroprudential regulation work. The former has definitely not yet gone far enough. It's all too easy to imagine shocks that would, once again, decapitalize the financial system. The case for reducing the leverage ratio to no more than 10-to-1 is overwhelming. The present situation in which banks are stuck to the state, like a Siamese twin, must not endure. It creates huge problems of incentive and so increases vulnerability to crises in the long run. Furthermore, macroprudential regulation, though certainly greatly helped by higher capital standards, must also be made to work. The most important element will be automatic adjustment to capital and liquidity standards over the cycle. At present, the financial system is designed to fail. Yet, strengthening it is only part of the answer. The other part is fixing the macroeconomic mess into which the world has fallen. That is the topic of chapters 8 and 9. Chapter 8. The Long Journey Ahead. There is a risk that synchronized fiscal adjustment across several major economies could adversely impact the recovery. There is also a risk that failure to implement consolidation where necessary would undermine confidence and hamper growth. Reflecting this balance, advanced economies have committed to fiscal plans that will at least halve deficits by 2013 and stabilize or reduce government debt to GDP ratios by 2016. G20 Communique, Toronto, June 27, 2010. There are some people who think we don't have to take all these tough decisions to deal with our debts. They say that our focus on deficit reduction is damaging growth, and what we need to do is to spend more and borrow more. It's as if they think there's some magic money tree. Well, let me tell you a plain truth. There isn't. David Cameron, UK Prime Minister, March 7, 2013. How do high-income countries restore their economic vibrancy? Is this possible, or does a new normal dictate miserable performance? Is the current policy approach right? And if not, what would be better? And where do emerging economies fit in? These questions are to be addressed in this chapter, which examines the global picture, and then Chapter 10, which will focus on the Eurozone. This chapter's focus is on one topic: how to restore a sustainable macroeconomic balance in high-income economies, and so in the world. This necessitates both moving out of the post-crisis slump and away from the extreme private sector savings glut revealed by today's low real interest rates and chronic global imbalances. It also necessitates doing both of these things without a return to accumulation of excessive private debt. This combination is going to be hard to achieve. We seem, in brief, to confront a nasty choice between an inadequate recovery and an unsustainable one. These are, of course, not the only economic challenges confronting high-income economies, let alone the rest of the world. Yet the immediate tasks of restoring stability to these economies and fixing the conditions that caused the instability are not only important in themselves, they are necessary conditions for dealing with those other challenges. The first part of the solution, discussed in Chapter 7, is making the financial system more robust. The second, to be discussed in this chapter, is overcoming the macroeconomic challenges of deficient demand, excessive debt, and global imbalances. The best way of thinking about this, also relevant to the Eurozone crisis, is in terms of flows, stocks, and reforms. The flow challenges are those of adjusting income and spending, and borrowing and lending to deliver full employment and growth in line with potential. The stock challenge is that of dealing with the overhang of private and, in some cases, public debt. The reform challenge is that of creating better balanced domestic and world economies, supported by functioning institutions that deliver stability and widely shared prosperity. At the end of these adjustments, balance sheets need to be sound, the financial system needs to be healthy, and spending needs to be consistent with high levels of economic activity and employment. It all sounds so simple. Alas, it is not. Far more likely is an enduring slump in high-income countries, at least relative to pre-crisis expectations. That would impose huge costs of investments unmade, of businesses not started, of skills atrophied, and of hopes destroyed. Should that fate be avoided, another temporary credit-driven boom might emerge, followed by another, and still bigger crash. Worst of all, in a world marked by domestic economic stresses and a global transition of power, a breakdown in cooperation might occur. This has to be avoided. So, how? To answer that question, the discussion will be divided as follows. First, it will show that this is indeed a large slump. Second, it will analyze the debate over austerity. Third, it will consider how to manage debt. Fourth, it will examine structural obstacles to growth. And finally, it will turn to complementary global adjustments and reforms. The slump. Chapters 1 and 5 have already looked at what has happened to the crisis-hit economies, and above all the costs in terms of output and employment. Figures 39 and 40 give a longer-term picture for the crisis-hit economies on which this chapter will focus, the US and the UK, with the Eurozone to be discussed in Chapter 9. In the US, a fitted quarterly trend growth rate is shown for 1950 to the end of 2007, just before the crisis hit. The trend growth for the U.S. economy was 3.4% a year over this lengthy period. The UK's trend growth over the 1955 to 2007 period was 2.8%. Moreover, deviations of actual growth from the fitted trends were fairly modest in both directions, in both the U.S. and the UK. Then came the post-2007 Great Recession. For the last quarter of 2013, U.S. GDP was 17% below the historic trend. The UK's reduction was smaller, at 14%, largely because it had been somewhat above trend levels before the crisis. These are gigantic shortfalls. Assume, optimistically, that the U.S. economy manages to grow at 3% a year from now on. Assume that the relevant real rate of interest for discounting future GDP is also 3%. Then, the cumulative present value of the lost U.S. GDP over the next century would be 17 times the GDP of 2013. If the discount rate were lower than the rate of growth, the amount of lost GDP would be still bigger. Such costs are greater than those of world wars. Indeed, both the U.S. and the UK managed to regain or exceed the pre-Second World War trend level and rate of growth after that conflagration was over. Thus, the long-run economic costs of wars, in terms of subsequent levels of GDP, have been far smaller than those of big financial crises. The collapse of financial systems and the need to deleverage impose enormous costs. Current estimates of output gaps, that is, the gap between actual output and the estimates of potential or full capacity output, are far smaller than the deviations from the trend shown in the figures. The reason for this is that estimates of potential output always follow actual output. In its November 2013 Economic Outlook, the Organization for Economic Cooperation and Development, the OECD, for example, estimated the U.S. output gap at 3% of potential output and the UK output gap at 2.5% in 2013. Substantial, but far smaller than the output shortfalls relative to trend in that year. For the pessimistic view that the potential level of output today has fallen far below the pre-crisis trend level of output, to be precise, about 14% below trend in the case of the U.S. and 11.5% in the case of the UK, one might suggest three explanations. The first is that the pre-crisis trend exaggerated potential, or at least sustainable, output. The second is that the crisis destroyed potential output. The third is that the OECD and other forecasters that have reached similar conclusions are far too pessimistic. The pre-crisis trend was exaggerated. It is easy to accept that the boom in credit and the measured output of the financial sector exaggerated both true output and potential output. One reason for this would be that it is easy for the extension of credit to be converted into incomes. If someone takes a flat fee out of a bad loan, it will appear as income in the national accounts. Yet there are arguments against the view that such spurious activity means that true, long-run potential output was vastly below actual output in 2007. The fact is that there was no rise in output above trend in the U.S. in the 2000s. Rather the opposite, in fact. Even in the case of the UK, output was only 4% above the long-run trend in the second quarter of 2007. Second, there was no sign in wage or price inflation of a huge excess of actual over sustainable output during the pre-crisis period. Third, if the story were essentially sectoral, and so not about the economy as a whole, one would expect falls in employment to be concentrated in crisis-hit sectors. In the U.S., employment in construction did decline by 26% between 2007 and 2012, while that in real estate fell by 11%. But employment in finance and insurance fell by only 6% against a fall of 4% in the economy as a whole. Employment fell by 7% in wholesale and retail distribution, 11% in media and related industries, and, astonishingly, 14% in manufacturing. In other words, the collapse in employment was across the board. This strongly supports the proposition that the output and employment declines were due to a collapse in aggregate demand. The crisis devastated potential output. The second explanation for the contrast between the huge shortfalls in output relative to long-term trends and relatively modest estimates of the current output gap is that the crisis has damaged potential output and its rate of growth. This is certainly correct. One can propose two explanations. The first is that the crisis damaged the financial system's ability to service the economy. The second is that the slump lowered both investment and employment. The long-term unemployed, then, become less employable. Note, however, that these costs were largely unnecessary. Stronger action to sustain demand could have reduced them substantially. Forecasters are too pessimistic. The third explanation is that forecasters are just too pessimistic. Yet one strong argument in favor of the forecaster's pessimistic position can be made: the stability of inflation. If there was a huge amount of slack, why has inflation not fallen further or even turned into outright deflation? There are two responses. The first, proposed by the International Monetary Fund, is that expectations are anchored by the inflation targeting of central banks. The second is that the principal determinant of inflation remains labor costs. But there is very strong resistance to nominal wage cuts, even in depressed economies. The case for action. Consider two policy alternatives: strong stimulus on the one hand, and austerity on the other. If one adopted the first strategy when a great deal of economic slack existed, the outcome would be a stronger recovery. If one were to adopt the stimulus strategy when there was no excess capacity in the economy, there would be inflation, current account deficits, or both. Now, turn to the second alternative, austerity. If there were economic slack, the economy would adapt to the policy by shrinking potential output towards its actual level, largely through shrunken investment. If there were no slack, the policy would deliver the predetermined outcome. In other words, austerity would become a self-fulfilling prophecy. So, if one were wrong to be optimistic, the cost would be an inflation overshoot, followed by a policy correction. If one were wrong to be pessimistic, the cost would be a permanently smaller economy. The former error is less damaging than the latter. The right risk to take, then, is stimulus, because the costs of greater austerity would be higher. Moreover, the likelihood is that in fact there is a great deal of slack after such huge falls in output. That reinforces the case for taking the risk of expansionary policies. How to stimulate economies. Countries with flexible exchange rates, such as the US and the UK, can employ both fiscal and monetary policies, one of these options, or neither. So, let us start by accepting arguments for some form of stimulus, before looking briefly at the arguments for using neither. the limits of monetary policy. Is it sensible to rely on monetary policy alone? Here are 4 arguments against doing so. First, one obviously needs to use the most effective policies available. The busts that follow prolonged credit booms are both very costly and very hard to remedy. One reason for this is that with interest rates at or close to the zero bound, the effectiveness of monetary policy is constrained, though not zero. Prolonged periods of ultra-low interest rates, together with quantitative easing and forward guidance, indications of low policy rates far into the future, have brought only a modest recovery. Thus, as of early 2012, neither the U.S. nor the U.K. had achieved rates of growth higher than before the crisis. The recovery had, accordingly, not even begun to close the proportional gap between actual output and the pre-crisis trend. Second, as Simon Wren-Lewis of Oxford University notes, the impact of unconventional monetary policy is quite hard to calibrate. Nobody doubts that a monetary policy capable of generating adequate growth of nominal demand exists. But when both the right way to carry out the monetary policy and its impact are so uncertain, caution must be advised. As John Williams, president of the Federal Reserve Bank of San Francisco, points out, with multiple policy instruments, the optimal strategy is to rely on the instrument associated with the least uncertainty and use alternative, more uncertain instruments only when the least uncertain instrument is employed to its fullest extent possible. When interest rates are close to zero, the least uncertain policy is quite likely to be fiscal policy. Third, aggressive monetary policy creates risks of its own. It may keep zombie companies alive too long. It may distort price signals, so creating wasteful investment. Above all, it may encourage another round of irresponsible lending and spending. Indeed, this is the argument made by some critics of such policies, including William White, former chief economist of the Bank for International Settlements, and Raghuram Rajan, now governor of the Reserve Bank of India. Finally, an aggressive monetary policy by the U.S., producer of the world's reserve currency, might be particularly destabilizing since it confronts other countries with a painful choice. Import U.S. monetary policy and risk domestic destabilization, or refuse to import U.S. monetary policy and risk exchange rate instability, or impose controls on capital inflows and so seek to separate the economy from global capital markets. Some economists go further by arguing that the aggressive monetary policies, particularly unconventional policies, risk causing high inflation or even hyperinflation. Austrian economists have long believed this must be the case. Some monetarists believe it too. Alan Meltzer of Carnegie Mellon University is an influential example. The argument is that the expansion of the monetary base must lead to a multiple expansion of bank lending, and so of the money supply, ending in high inflation. This is nonsense. Consider the misnamed money multiplier, the supposed relationship between the bank's holdings of reserves at the central bank and the money supply. The ratio of U.S. M2, the broadest measure of the money supply now published by the Federal Reserve, to bank reserves, doubled between 1994 and 2008, whereupon it collapsed when unconventional monetary policy began. By February 2014, the multiplier was only 4. Bank reserves rose from $95 billion in April 2008 to $2.7 trillion in February 2014. There was no multiplier effect on M2. Moreover, the central bank, not the banks, controls the quantity of reserves, with a little help from the public's desire for cash. It can create and liquidate reserves by buying and selling assets or by lending and withdrawing loans to and from the banks. Finally, the central bank can sterilize reserves by changing reserve requirements, and it can decide how onerous to make such requirements by determining the rate of interest it pays on reserves. If interest rates were to remain at zero, when a normal appetite for risk returns, credit and money would start to grow too fast. The economy would overheat, and everything would end up as critics fear. But the conditions that caused interest rates to fall to zero are the very conditions that prevent such a credit explosion. When the conditions change, policies must change, and we must assume they will. Yet even if the hysteria about hyperinflation is wrong, the objections to an exclusive reliance on monetary policy create a prima facie case for using fiscal policy. So why has it been widely rejected? The case against fiscal austerity. The starting point for any discussion of the role of fiscal policy is over the size of fiscal multipliers, that is, the ratio of the change in national income to the change in government spending that drives it. A widely shared conclusion is that at the zero-rate bound, these multipliers are likely to be 0.5 or so at their lowest, and more likely to be well over 1. The reasons why fiscal multipliers should be high in today's circumstances are as follows. Economic agents are far more likely than normal to be unable to borrow freely, and so spend now out of future income, which is what borrowing permits. Cutting public spending is likely to make many would-be borrowers less creditworthy, and so in a worse position to take advantage of the aggressive monetary policy, and many countries are tightening simultaneously. In 2012, J. Bradford DeLong of the University of California, Berkeley, and Lawrence Summers, then back at Harvard University after his period in the White House, added 2 other points. The first was that if shortfalls in output damaged potential output, an idea known as hysteresis, the case for expansionary fiscal policy would be stronger. Second, if real interest rates were low enough and multiplier and hysteresis effects strong enough, fiscal stimulus would even pay for itself. Deficits could be a free lunch. Yet, as we know, opposition to fiscal stimulus was strong. One justification for this was the classical view that the economy operates at full capacity at all times. If one believes that, the explanation for the sharp reduction in output during the Great Recession might be that the workers of the world decided to take a vacation, while only pretending they were unemployed. In other words, the equilibrium output capacity collapsed because people suddenly decided to withdraw their labor instead of being involuntarily unemployed. Yes, it does sound silly. That's because it is. Some economists argued for expansionary fiscal contraction. Thus, the confidence benefits of a return to sustainable public finances, particularly if achieved by slashing spending, outweighs the depressing effect on demand. Alberto Alesina of Harvard University and Silvia Ardagna of Goldman Sachs wrote the most influential paper arguing this case. Paul Krugman, the Nobel laureate economist and New York Times columnist, ridiculed it as belief in a confidence fairy. But the most influential criticisms came from the staff of the International Monetary Fund. First, they noted, the cases in which policymakers made an attempt to tighten fiscal policy were not necessarily those in which cyclically adjusted fiscal balances, on which Mr. Alesina and Ms. Ardagna relied, were cut. Second, they insisted, large spending-based fiscal retrenchments are contradictory, as are fiscal consolidations occurring in economies with a high perceived sovereign default risk. Third, they pointed out, the decline in private consumption and private investment is mitigated by a rise in net exports associated with a fall in the value of the domestic currency. Thus, it was not austerity that was expansionary, as claimed, but beneficial changes elsewhere in the economy, largely driven by depreciation of the currency. Not surprisingly, they added, this offsetting channel is less potent in economies with pegged exchange rates. Then, in 2013, Roberto Perotti of Bocconi University an early supporter of the idea of expansionary contractions, pointed out that depreciation and fast export growth had been offsets to fiscal consolidation in four widely cited European exemplars of expansionary austerity: Denmark from 1983 to 1987, Finland 1992 to 1996, Sweden 1993 to 1997, and Ireland 1987 to 1989. The IMF's World Economic Outlook of October 2010 added another possible offsetting channel: a fall in interest rates. The US, the Eurozone, the UK, not to mention Japan, are far too big to achieve export-led growth in the near term. Moreover, the US and the UK already enjoy rock-bottom interest rates. Only the crisis-hit Eurozone member countries can benefit from these. In brief, the decision to withdraw fiscal support for the recovery, taken at the G20 summit of June 2010, delivered a longer and deeper slump than necessary. It has also meant relying on a more uncertain tool, that of unconventional monetary policy, and abandoning a less uncertain one, that of fiscal policy. According to Alan Taylor of the University of California, Davis, UK GDP was 3% smaller in 2013 than it would have been if the austerity of 2011 to 2013 had been postponed. It is interesting to ask why countries that did have a choice to slow fiscal austerity or even expand deficits temporarily did not do so. In the U.S., austerity was the result of a political standoff between the two parties. But in the UK, it was a deliberate policy. An influential argument was that the UK had too much public debt, even though the ratio of debt to GDP has remained below its average of the past 3 centuries. Research by Carmen Reinhart and Kenneth Rogoff, both at Harvard University, and celebrated authors of This Time is Different, a justly influential book on financial and fiscal crises, supported the idea that public debt was becoming dangerously high, and so that an early shift towards fiscal austerity was both necessary and wise. Thus, in a paper published in 2010, they argued that growth was close to zero when the ratio of public debt to GDP exceeded 90%. Thomas Herndon, Michael Ash, and Robert Pollin of the University of Massachusetts at Amherst have provided a widely noted critique. They argue that the paper contained a coding error, data omissions, and strange aggregation procedures. After correction, they argue, average annual growth in advanced countries with debt above 90% of GDP was 2.2% between 1945 and 2009. This contrasts with 4.2% when debt was below 30%, 3.1% when debt stands between 30 and 60%, and 3.2% when debt is between 60 and 90%. A slower growth is indeed associated with higher public debt, but an association is not a cause. It's very hard to argue that high public debt caused the UK's slow post-crisis growth. After all, in the years immediately prior to the crisis, UK net public debt was close to its lowest ratio to GDP in the past 300 years. Thus, the higher debt today than before the crisis is a result of slow post-crisis growth. This is not to rule out two-way causality, but the impulse has mostly gone from private financial excesses to crises, slow growth, and high public debt, not the other way around. In assessing the consequences of high public debt for growth, one must therefore ask why debt rose in the first place. Again, the reasons why deficits are high and debt rising will affect the costs of austerity. After a financial crisis, an excess of desired private savings is likely to emerge, even with interest rates close to zero. In that situation, fiscal austerity will drive the economy into a recession, so limiting the government's ability to reduce its deficits and debt. So the issue is not only the direction of causality, but also the costs of trying to avoid high public debt in the aftermath of a financial crisis. In its April 2013 World Economic Outlook, The IMF noted that fiscal support for recovery had been exceptionally weak during this recession compared with previous ones. Not surprisingly, therefore, the recovery has been feeble. True, countries in the Eurozone that could not borrow had to tighten, in the absence of support from their partners. Others with room for maneuver, such as the US and even the UK, could and should have taken a different course. Because they did not, recovery has been weaker, and the long-run costs of the crisis almost certainly greater than was necessary. This is a controversial view, particularly since the UK economy grew by 2.8% from the fourth quarter of 2012 to the fourth quarter of 2013, and the US economy continued to grow once more from mid-2009. In the end, a crisis-hit economy will expand. By and large, modern market-led economies do not stop growing forever. So the question concerns a counterfactual. Would alternative policies, in this case less contractionary fiscal policies, have led to faster recovery and a stronger economy in the long run? We can never know for certain the answer to this counterfactual. But three arguments suggest that less contractionary fiscal policies would have been helpful in securing a stronger and earlier recovery. First, the recovery has been decidedly weak, as already pointed out previously. In the case of the U.S., the economy has grown consistently more slowly than the long-term pre-crisis trend. As a result, the shortfall of output relative to that long-term trend has grown year after year. It's possible to argue that this was the best that could be managed. But it's not evident why that should be so, given the persistently low unemployment and weak investment. No doubt some loss was indeed inevitable. But one as big as this in terms of both levels and rates of growth of GDP needs meticulous justification, particularly for a country that had exceptionally low short-term and long-term interest rates. It could certainly have borrowed and spent more if it had wished to do so. Again, in the case of the UK, the economy was still smaller in early 2014 than 6 years earlier, despite the upsurge in growth in 2013. True, this dismal performance, the slowest recovery on record, was partly because of the contraction in the output of North Sea oil. Nevertheless, the recovery had been very slow in coming. Moreover, the rate of growth still had not surpassed its historic trend. Furthermore, in the UK, too, short and long-term interest rates remained very low, even though the actual fiscal deficits greatly exceeded those planned by the incoming coalition government in 2010. It's hard, given these facts, to argue that policy in the US and the UK was the best that could be managed. Second, the decision to allow a more supportive fiscal policy until these economies had recovered strongly would have brought forward spending, particularly investment, to a time when idle resources were available, notably in construction. Shifting spending from a time when it would have crowded out other activities to a time when it would not have done so is exactly what a government, the economy's largest and longest-lived borrower, should do. Moreover, as Bradford DeLong and Lawrence Summers argued, using resources that would otherwise lie idle is not just a free lunch in that income might be higher now without lowering it in the future. It might even make the economy better off in every subsequent year by keeping people employed instead of jobless and businesses functioning instead of bankrupt. Third, by persisting with strong supportive fiscal policies until the recovery was well entrenched, the pressure on monetary policy would have been reduced. And this could have brought the benefit of not relying so much on a policy that amounts to manipulating asset prices and encouraging further borrowing. The risks of such an expansionary monetary policy, even if effective, are real. Furthermore, while not as unmanageable as some critics allege, exit from unconventional monetary policy, including massively expanded balance sheets and forward guidance, is sure to create bumps along the road. With a more expansionary fiscal policy, monetary policy could have been less extreme than it was. For all these reasons, the decision to tighten fiscal policy after 2010 was almost certainly premature and unwise. It would have been better to rely more on fiscal policy and less on monetary policy. Of course, by 2014, this debate had largely become an historic one. The choice had been made. Liquidationist folly. The previous discussion essentially assumed that battered economies needed policy support. The debate was over which policy should be employed: monetary, fiscal, or both. But some respectable organizations have argued that the right recipe is fiscal and monetary tightening. This has become the House perspective for the Bank for International Settlements and the Organization for Economic Cooperation and Development. These have called for monetary and fiscal tightening, even though economic growth has been weak, unemployment high, and inflation low. It has been hard to work out why this has seemed the right policy when it's so easy for government to borrow and inflation has been so low. It's hard to believe they think that Greece, Ireland, and Spain have been so successful that everybody should follow their example. Even if they did think that, they must also realize that the success of such crisis-hit economies depends on rapid improvement in their external balances. Such shifts are going to be far more difficult if big economies, particularly the U.S., pursue strongly contractionary economic policies. Fortunately for their own and other economies, American and British policymakers have not listened to such calls for across-the-board fiscal and monetary contraction, since that would have risked a far deeper slump. But partly as a result of this pressure, the policies actually chosen have not delivered sufficiently fast healing. However, it could have been worse, and next time, given the persistent strength of such sentiments, it could be. How to restructure debt. Since there is now more debt than can be easily managed, deleveraging has been the order of the day. Deleveraging can be achieved by growing out of debt, via a combination of real growth and inflation, or by paying down and restructuring debt. Deleveraging involves one, or often all, of these processes. How well the strategy of growing out of debt works depends on the relationship between rates of interest and growth. The lower the former, and the higher the latter, the better. And that's why financial repression, which is a deliberate reduction in the costs of debt by lowering returns to creditors, is common in a deleveraging episode. Aggressive monetary policy lowers interest rates and supports nominal incomes. This is why the decision of central banks to move the short-term interest rate to near zero was right. It is also one of the reasons why higher inflation would help. An aggressive fiscal policy can also help deleveraging. It does so by supporting nominal incomes, offsetting private sector financial surpluses, and even by directly subsidizing debt restructuring. Many insist one cannot get out of debt by adding more debt. It will tend to run a large financial surplus. Those who are over-indebted will spend less and so shift into financial surplus, but those who are not over-indebted will not suddenly wish to borrow more. In aggregate, then, the private sector is likely to move towards a surplus, which must be offset elsewhere in the economy, since, by definition, financial surpluses, which are differences between income and spending, add to zero across the economy as a whole once the foreign sector is included. The sector best suited to run the countervailing deficits in a crisis is the government. The response to the objection that it makes no sense for the public sector to go into debt in order to help the private sector deleverage is that the new debts will effectively be borne by different people. This, then, is a way of replacing bad debts with better ones. A vital element, however, is orderly debt restructuring. The government can help with this by subsidizing or supporting debt-for-equity swaps, particularly in housing finance. Given the way many banks behaved before the crisis, their shareholders should also pay, Robert Kuttner, an American commentator, justly complains that the same financial elites who instrumentally rely on Chapter 11 of the U.S. Bankruptcy Code to rearrange assets and shed debts warn of the shameful improvidence of families caught in a general downdraft of housing values. Yet, the U.S. has been relatively successful in deleveraging, with private debt back to levels as seen in the early 2000s relative to GDP. This is due to more growth, more restructuring, and more repayment than in most other high-debt countries. The McKinsey Global Institute notes that a standard path for deleveraging goes in two phases. In the first, the private sector reduces debt while the economy is weak, and the public sector runs large fiscal deficits. In the second, the public sector deleverages too. This is what happened in Finland and Sweden in the 1990s. As of late 2011, the U.S. was well on this path, with substantial reductions in private sector leverage. But, noted the McKinsey Global Institute, deleveraging in the UK and Spain is proceeding more slowly. The ratio of UK debt to GDP has continued to rise, and UK households have increased debt in absolute terms. In Spain, households have barely reduced debt ratios, and corporations continue to carry the highest level of debt relative to GDP in our 10-country sample, namely, the 10 biggest high-income economies. It could take many more years to finish an orderly deleveraging in the UK and Spain. In brief, what is needed to handle the debt overhang is a strategy for demand expansion, low interest rates, reconstruction of the financial system, and restructuring and reduction of non-financial debts. Of the big countries, the U.S. has come closest to this combination, though the others have been slowly and painfully following behind. Inevitably, creditors do not like the strategy of low interest rates and debt restructuring. Yet what they want, all borrowers to pay high interest rates, in full, and punctually, they cannot now have. If a boom has created more credit and debt than can be sustained, the stock of claims, the returns upon them, or both, must be reduced. The alternative is stagnation, and, at worst, the nightmare of debt deflation explained by Irving Fisher in 1933. Since that must be prevented, the alternative of debt restructuring is the inevitable and rational choice. Structural limits and secular stagnation. The challenges discussed in this chapter hitherto are those of sustaining demand and restructuring debt, the flows and the stocks, during a post-crisis recession. But many commentators argue this is beside the point. They insist that structural obstacles to sustained recovery are insuperable. This is partly because of slowing, if not collapsing, trend growth, and partly because of structural constraints on demand. Let's take a look at each one. Slowing growth. Underlying economic growth is indeed almost certain to slow in high-income countries. The principal reason is demographic, the aging of societies. Over the next 4 decades, the proportion of the population that is of normal working age will fall considerably, and the proportion of the population aged over 65 will rise substantially. In the U.S., for example, according to UN forecasts, the proportion aged 20 to 64 will fall from 60 to 54% between 2010 and 2050, whereas the proportion over 65 will rise from 13 to 21%. In a country that is aging more rapidly than the U.S., such as Germany, the proportion of people aged 20 to 64 will fall from 61% in 2010 to 50% in 2050, whereas the proportion over 65 will jump from 20 to 31%. In Japan, the forecast is even more extreme, with the population aged 20 to 64 down to 47% by 2050. Even if we assume that retirement ages will rise substantially, as they should, the impact on potential growth is evident. Not only will the labor force shrink absolutely in many countries, as the population falls, but the proportion of it that is young, flexible, and innovative will decline further. Moreover, age-related public spending on health and pensions also seems bound to rise in most high-income economies over the next few decades, unless there are extraordinary medical innovations or the rest of the population refuses to pay. With the labor force growing more slowly than previously, or even shrinking, growth is bound to slow, other things being equal. But the other component of economic growth, rising productivity, is even more important than demography in determining the rate of growth over the long run. It's also the principal determinant of incomes per head. Nobody knows what will happen to productivity over the coming decades, but some well-informed people have put forward reasonable arguments that it must slow. Among these are Robert Gordon of Northwestern University and Tyler Cohen of George Mason University. An important reason why the pace of innovation might be slowing is that many opportunities have already been exploited. The population of the high-income countries is already highly educated and highly urbanized. The economy has already exploited the most readily available natural resources. People have already enjoyed the fruit of many life and economy-transforming innovations, such as running water and sanitation, inoculation, electricity, chemicals, pharmaceuticals, the internal combustion engine, civil aviation, telephony, the computer, and the Internet. While nobody knows what is still to come, it would have to be impressive indeed to match this record of past achievements. Yet it should be stressed, this relatively pessimistic view is far from universally shared. Eric Brynjolfsson and Andrew McAfee of the Massachusetts Institute of Technology argue instead not only that the measured decline in productivity growth in recent years is a product of a failure to measure output correctly, but that at an age of accelerating technological progress is ahead of us, as intelligent machines and big data transform our economy and our lives. At this stage, the only sensible thing to say is that we don't know what promise of a more productive future new technologies hold, though it seems likely that if it is as dynamic as some expect, it will also tend to generate even bigger increases in inequality of earnings and incomes between digital haves and have-nots. If one takes these elements together, the growth rate of the high-income countries will be substantially slower in the future than it was even in the decades leading up to 2007, let alone the magnificently prosperous years from 1945 to 1975. Les Trente Glorieuses, as the French call those 3 decades of economic boom. This will have many difficult consequences. The distributional struggle will be more intense, and political stability less assured. The relative power of the high-income countries will shrink. The public finances will be more difficult to manage, and the beneficiaries of public spending, particularly the old, will find the resources at their disposal shrinking. Given all this, it becomes even more important to return to potential output as swiftly as possible, and then pursue policies likely to stimulate economic growth. Such policies will need to be heterodox, with a strong focus on supporting scientific research and risk-taking innovation. The high-income countries cannot afford years, even decades, of unnecessary stagnation due to inadequate demand. Weak demand. The second part of the structural argument comes down to the proposition that there exist longer-term constraints on demand. If so, the pump priming by governments and central banks will ultimately fail, since economies will return to their depressed state as soon as policy is reversed. This view fits with the analysis in Chapter 5 of longer-term reasons why demand in the high-income countries had to be supported by aggressive monetary policy and an ultimately unsustainable credit boom, particularly after the Asian financial crisis and the collapse of the stock market bubble of the late 1990s. The argument for secular stagnation made by Lawrence Summers is that demand has become structurally weaker over the past decade. Daniel Alpert's The Age of Oversupply is about much the same thing. The principal piece of evidence of secular stagnation is, as Mr. Summers also notes, the combination of rapidly growing credit at high asset prices with weak economies, even before the crisis hit. The first explanation for structurally deficient private sector demand in the absence of credit bubbles is rising inequality. A number of authors from different sides of the policy spectrum have made a direct link between inequality, structurally deficient demand, and credit booms. The Nobel laureate economist Joseph Stiglitz of Columbia University has argued, for example, unemployment can be blamed on a deficiency in aggregate demand, the total demand for goods and services in the economy, from consumers, from firms, by the government, and by exporters. In some sense, the entire shortfall in aggregate demand, and hence in the U.S. economy, today can be blamed on the extremes of inequality. Similarly, James K. Galbraith of the University of Texas in Austin argues, in rich countries such as the United States, we find that economic performance has become dominated since 1980 by the credit cycle. Financial booms and busts drive the performance of employment, and thus prosperity is associated with rising income inequality. Finally, Raghuram Rajan, now governor of the Reserve Bank of India, argues, recognizing the need to find new sources of growth, the United States, towards the end of Jimmy Carter's term, and then under Ronald Reagan, deregulated industry and the financial sector, as did Margaret Thatcher's United Kingdom. Competition and innovation increased substantially in these countries. Greater competition, freer trade, and the adoption of new technologies increased the demand for and incomes of highly skilled, talented, and educated workers doing non-routine jobs like consulting. More routine, once well-paying jobs done by the unskilled or the moderately educated were automated or outsourced. So, income inequality emerged, not primarily because of policies favoring the rich, but because the liberalized economy favored those equipped to take advantage of it. The short-sighted political response to the anxieties of those falling behind was to ease their access to credit. Faced with little regulatory and supervisory restraint, sometimes based on the faith that private incentives worked best in this best of all worlds, the financial system overdosed on risky loans to lower middle-class borrowers, aided and abetted by very low policy interest rates. What is interesting is the similarity of the underlying analysis among analysts with quite different ideological perspectives. Liberalization, particularly of finance, led to massive rises in inequality. This then generated structural deficiencies of demand, not to mention the disappointment of stagnant or declining real incomes for many people, which were papered over by a temporary credit boom. Once that collapsed, the government took the private borrower's place as borrower and spender of last resort. But the only way to restore demand in the private sector has been via ultra-expansionary monetary policies, with the disturbing longer-term consequences discussed previously. All this is a plausible internal complement to the analysis of external imbalances in Chapter 5. It explains why it has been so hard to offset the depressive effects on demand of external imbalances. Jeffrey Sachs, also at Columbia University, argues in his book, Price of Civilization, that the crisis is the result of a moral collapse in the American elites. Rising inequality, ineffective and unpopular government, out-of-control finance, and deteriorating external competitiveness are, in this view, symptomatic of a deeper social and ethical failure. Pumping up demand in the short run cannot deliver the longer-term prosperity the U.S. needs. This is surely correct. However, one could view such a policy not as a solution, but as, at best, a stepping stone to a renewed vision, or at worst, as a way of making the best of a bad job. Getting back to full employment through stimulus policies would not resolve the difficulties of the U.S., but it would reduce the immediate misery. One cannot let the best be the enemy of the good. Andrew Smithers of London-based Smithers & Company suggests yet another structural constraint. In the book, The Road to Recovery, he argues that the bonus culture distorts the behavior of corporate management, particularly in English-speaking countries, in a destructive direction. Above all, it focuses managerial attention on ways to raise reported earnings and share prices in the short run, since managers are unlikely to be in charge very long. Their goal is to cash out as successfully as possible and as quickly as possible. They can do this not only by using the earnings to buy shares in their own companies, but also by borrowing to fund yet more such buybacks. In the process, they leverage up their businesses, making them more financially fragile, and reduce investment, weakening long-term prospects. This is particularly true in activities that demand patience and long-term investment, such as large-scale manufacturing. One result of this behavior is of particular macroeconomic importance. It creates a structural financial surplus, which is an excess of retained earnings over investment, in the corporate sector, notably so in the U.S. and the U.K. In a healthy economy, the corporate sector would be a net importer of savings from the rest of the economy. After all, it's responsible for virtually all the investment, other than in human capital. If the corporate sector is profitable but does not invest, policymakers have two headaches. The first is that their economy's growth will be harmed. The second is that the savings surplus of the corporate sector will need to be offset by spending elsewhere if a slump caused by a savings glut is to be avoided. Until the crisis, the offsetting spending was in the construction of homes and in household and government consumption. Then, after house prices fell, and particularly after the financial crisis, the onus fell on the government deficit alone. The huge post-crisis fiscal deficit was not a surprise. It was a predictable and predicted event for those who understood the financial balances of the economy. This brings us to a fourth structural concern, already discussed at length in Chapter 5, the external sector. If the corporate sector runs a financial surplus, the remaining sectors must run deficits. But what happens if the external sector also runs a structural surplus, as seems to be the case in both the U.S. and the U.K.? Even in a deep recession, both countries have continued to run current account deficits, which means they remain net importers of savings from the rest of the world. This is happening for two interconnected reasons. Foreigners are running savings surpluses, as explained in Chapter 5, which they are sending to the capital importing countries. And, in the process, foreigners are also subsidizing their tradable industries and taxing those of the capital importing countries, via shifts in real exchange rates. In countries with structural current account deficits, domestic demand must exceed income in order to offset the export of a part of their demand to foreign producers of goods and services. If both foreigners and the corporate sector are running structural, or cyclically adjusted, financial surpluses, by which one means the surpluses that would emerge if output were as close to possible to what used to be called full employment, other sectors have to run deficits. Prior to the crisis, this task of running deficits fell both to households and government in the U.S. and the U.K. Since the crisis, it has fallen on the government alone. So what would happen if the government tried to eliminate its fiscal deficit too? If this is to be combined with high levels of economic activity, the offsetting changes must be expansionary. If so, one or some combination of three things must happen. A swing towards financial deficits by households, almost certainly driven by another credit boom. A swing towards financial deficit in the corporate sector, driven by a surge in corporate investment. Or a move towards structural surplus in the current account of the balance of payments, driven by a sustained improvement in competitiveness. Of these three possibilities, the first is undesirable. This leaves investment and net exports. Those concerned with structural constraints are right. The needed sustained improvements in investment and net exports are unlikely to happen swiftly. One can envisage policy changes that would help. It would be possible, for example, to redistribute incomes among households so that the need for excessive expansions in credit in order to intermediate between the haves and have-nots would substantially diminish. But since a large proportion of this intermediation is also between the old and the young, it would still not disappear. It would be possible, in addition, to change the corporate tax code to give a stronger incentive for investment and a reduced incentive for borrowing. But whether that would make a big enough difference either is open to question. Similarly, it would be possible to imagine changes in real exchange rates that deliver the shift in competitiveness that is desired. But there is no way for a single country to deliver this, so long as it has an open capital account and a monetary policy oriented towards domestic price stability. This is particularly true for a country that issues a reserve currency. It effectively loses control over its exchange rate. So this brings us to one of the biggest issues raised by the argument in this book, particularly in Chapter 5, Global Rebalancing. Global reform. One way out of the apparent demand trap would be via global rebalancing. The evidence at present is that high-income countries are no longer able to absorb the savings that would be generated by their private sectors if their economies were running at something close to full capacity and were also not experiencing an unsustainable credit expansion. This is why activity has been persistently weak and real interest rates low. Whether this is inevitable or the result of rising inequality and failures in corporate governance is unclear. Probably a bit of all of these. The condition of excess private sector savings still exists. So, if these excess savings are not to be absorbed in the fiscal deficit, to which we will return in the next section, the only alternatives are to eliminate them via a depression or export them. In brief, all the high-income countries would then become like Germany, and the rest of the world economy would become large net importers of capital. Let us think this through via simple illustrative calculations. Assume that the private sectors of the high-income countries wish to run financial surpluses, excesses of savings over investment, in normal times, that is, when credit is not exploding and asset prices are reasonably stable, of around 4% of GDP. Assume also that these countries wish to borrow their public debt back down from the relatively high levels of recent years. On the assumption that real economic growth is going to be about 1 to 2% a year, lower for Europe and Japan, and higher in the U.S., largely for demographic reasons, and inflation is also going to be around 2%, growth of nominal GDP would be 3 to 4%. If the public debt ratio in high-income countries is to trend back toward, say, 50% of GDP, the cyclically adjusted fiscal deficit needs to be 1.5 to 2% of GDP. This implies an aggregate, cyclically adjusted current account surplus, or capital account deficit, for the high-income countries of 2 to 2.5% of GDP. That's where the Eurozone seems to be painfully going under German tutelage, though it is, alas, achieving such a current account surplus at depressed output, not at potential output. But if the Eurozone adjustment planned by Germany towards more restricted domestic demand is to succeed, that's probably what has to happen. Japan has embarked on the path of Abenomics, with dramatically looser monetary policy and a substantial real depreciation. The latter is not an explicit objective of the policy. How could it be, since the overt adoption of a beggar-my-neighbor policy is a no-no for respectable high-income countries? But if one looks at the huge structural financial surpluses of Japan's corporate sector, in the neighborhood of 10% of GDP, and the desire to reduce the fiscal deficit, a large current account surplus seems inevitable. The fall in the exchange rate may ultimately help achieve this. In the US and the UK, such shifts also seem necessary if fiscal deficits are to be reduced substantially, while avoiding further credit bubbles. Of course, credit bubbles are the more likely outcome, but we are discussing a hypothetical world. The high-income countries together generate a little over 60% of global GDP at market prices and are currently close to aggregate external balance. But this is partly because of the slump. The full employment current account deficit of the high-income countries is probably now closer to, say, 2% of aggregate GDP. So, the needed swing in their aggregate current account balance would be 4 to 4.5% of potential, or full employment, GDP, to allow the desired fiscal deficit of 1.5 to 2% of GDP. Remember that an economy's financial balances must sum to zero. If the private sector surplus were 4% of GDP and the government's deficit were 1.5 to 2% of GDP, the foreign balance, that is, draft on foreign savings, would be minus 2 to 2.5% of GDP. This is equivalent to a current account surplus of 2 to 2.5% of GDP, since the countries in question would be exporting surplus savings, not importing them. Such an external surplus would be needed to allow the high-income countries to balance their economy's supply and demand at positive real interest rates, and at something close to full employment, without needing to rely on unsustainable credit and asset bubbles. A swing in the current account balance of the high-income countries of 4 to 4.5% of GDP to a structural surplus of 2 to 2.5% of aggregate GDP implies a swing of 6 to 6.75% in the current account deficit of the rest of the world and an actual deficit of 3 to 3.75% of GDP. If this were distributed evenly, it should be just about manageable, given that, taken as a whole, the rest of the world is where the best investment opportunities should be now. But such an even distribution is most unlikely. The chances are, instead, that a number of emerging economies would end up with very large current account deficits and rapid accumulations of net external debt. But we know from both experience and research that the accumulation of large quantities of net debt, particularly if denominated in foreign currency, is a harbinger of a crisis. Naturally, and wisely, given painful experience, the emerging and developing countries would be most unwilling to embark on an experiment with large external deficits merely to make the lives of the high-income countries a bit easier. Why, after all, should they take this risk? The answer to this rhetorical question might be that the availability of foreign savings should, in principle, allow emerging and developing countries to invest and consume more, raising the welfare of the population. But this only makes sense if the inflows are indeed properly used, and, in addition, the potential recipients of net capital inflows are adequately insured against the risks, particularly of a sudden reversal of inflows. No sensible economist would today, after so much painful experience, advise these countries simply to open their capital accounts to the world and ignore the risks of excessive inflows, asset and credit bubbles, distortions of the productive structure, particularly falling incentives for the production of tradable goods and services, and severe financial and economic crises. Nothing suggests that a change in the global balance of payments big enough to turn the high-income countries into large net exporters of capital is at all likely. Surplus countries do not want to give up being surplus countries. As noted in Chapter 5, a number of import countries have become highly export-dependent and have been willing to intervene massively in foreign currency markets to reinforce this orientation. Germany does not need to do so. It is nicely locked into the Eurozone with countries that are, by now, more or less permanently uncompetitive, a topic to which the discussion will turn in Chapter 9. But countries in East Asia, in particular, have often intervened in foreign currency markets to support their competitiveness. In theory, the Mutual Assessment Process, known by the acronym MAP, initiated by the G20 at the Pittsburgh Summit in 2009, should be doing something about this. Certainly China, the most important of the currency interveners, has let its currency appreciate considerably in real terms. But this may be difficult to sustain now that the economy is slowing sharply. Overall, there seems to be little chance that changes in policy will be large enough to reverse the current pattern of global imbalances. What needs to happen to make this desirable outcome, a large flow of net savings from rich countries to poor ones, even conceivable? We would need to look at a combination of policies. First, encourage less risky flows of finance. The most productive and least risky forms of finance are foreign direct investment and, to a lesser degree, purchases of equity. The obstacles to such flows need to be identified and overcome, wherever possible, by improving security of property in emerging economies. But it's also possible to consider far more imaginative forms of debt or quasi-debt finance, such as GDP-linked bonds, or bonds whose terms are automatically altered in the event of pre-specified contingencies. Institutions like the World Bank and the regional banks should be putting a great deal of effort into creating and marketing such novel forms of finance. Much progress has also already occurred in the development of local currency bond markets, replacing riskier foreign currency finance. This must be taken still further, with more innovation. Finally, there need to be procedures for managing bankruptcy conditions, not just for the public sector, but also for the private sector in emerging and developing countries. Second, increase insurance. The massive reserve accumulations by emerging and developing countries are, in part, self-insurance. This was a waste. Their people had to work hard to earn the dollars that the Federal Reserve so easily prints. But the insurance is valuable, even if excessive. It helped reserve holders to survive the crisis of 2008-2009 relatively unscathed. It's also possible that many emerging countries will conclude that their present reserves are quite big enough. An alternative to such huge reserves is a much bigger international monetary fund that offers far more unconditional finance. This means both more resources and more say for potential users. Alternatively, the emerging and developing countries could now go further in pooling their own resources. Third, create a global money. The most radical suggestion is the creation of a global reserve asset. The idea was recently presented by a panel of experts commissioned by the UN Secretary-General. In their report, they said, "The idea of an international reserve currency issued by a supranational bank is not new. It was broached more than 75 years ago by John Maynard Keynes in his 1930 Treatise on Money, and refined in his Bretton Woods proposals for an international clearing union. There currently exist a number of alternative proposals for a new global reserve currency, for how the system might be administered, how the emissions of the new currency might be allocated, and how the transition to the new system might be managed. Considerable international discussion will be required for the international community to decide the precise arrangements. However, this is an idea whose time has come." Needless to say, the U.S. will oppose this idea. Yet it is far from clear that the U.S. benefits from being the supplier of the reserve currency. On the contrary, the evidence from the recent crisis is that the consequences for financial stability in the U.S. are highly adverse. It seems likely that the Chinese government will have that view of a comparable role for the renminbi. It surely should do so. Maybe the possibility of a transition to the kind of monetary regime Keynes envisaged may now emerge. it's at least clear that the world of floating fiat currencies, one of which is a reserve currency, is highly unstable. The experience already forced a drastic shift in the policies of emerging and developing countries after 1997, as this book has noted. Now the owner of the monetary and financial dog has been bitten too. The system needs to be changed. If it is not, there is a good chance of a real currency war, not a phony one, as countries struggle to gain a share of chronically inadequate global demand. Monetary financing. You'd imagine that it proves hard to create the most desirable offsets to falling fiscal deficits, namely, surging investment and rising net exports from today's crisis-hit, high-income countries. This does not mean that the effort to solve the problem of deficient demand, evident since the 1990s, must fall. But since the effort to create another credit boom, particularly one focused on excessive leverage of the household sector, would be risking even more trouble down the road, we need to consider more radical options. Yet before pondering that possible outcome, let us return to another, even more radical possibility that would bring together our discussion of structural determinants of the private sector financial balances with the discussion of the Chicago Plan in Chapters 6 and 7, and of the balance between fiscal and monetary stimulus earlier in this chapter. If the choice is between letting the creation of money be the byproduct of irresponsible private lending, as was seen in the U.S. and Europe in the 2000s, or the byproduct of government spending, the latter would be a better choice. Indeed, that was the point made, rightly, properly, and persuasively, by Adair Turner, former chairman of the UK's now-defunct Financial Services Authority, in a seminal speech in early 2013. Lord Turner noted that Milton Friedman himself argued in an article in 1948 not only that government deficits should sometimes be financed with fiat money, but that they should always be financed in that fashion with, he argued, no useful role for debt finance. Instead of granting the private sector the right to create almost all the money in the economy, as a byproduct of often bad lending decisions, let the money be created by the state instead for its own use. Other economists have argued for such a policy in the event of crises, among them Keynes, with his celebrated suggestion that people be paid to dig up bottles full of pound notes, and Ben Bernanke when considering policy options confronting Japan in the early 2000s. This seems a solution to any long-term problem of structural demand deficiency. Instead of relying on private sector credit booms to generate a temporary return to full employment or accept a semi-permanent depression, let the government use its capacity to create money, already accepted when countries moved to floating exchange rates. This is not only what many in the Chicago School would have accepted, it's also the recommendation of those who believe in modern monetary theory. Meanwhile, control over the quantity of money to be printed would be left with the central bank, which would create the amount of money it deemed non-inflationary. The government would be forced to borrow to cover deficits beyond those funded by the central bank. But the aim would be to make the monetary expansion decided by the central bank a semi-permanent part of the assets of the commercial banks. As a result, the reserve requirements of banks would also need to be adjusted. The case for action. The crisis was a huge moment. Much of the political and financial establishment pretends that everything will soon return to the old normal, with a few regulatory changes and bashing of innocent beneficiaries of public spending. This is not going to work. There are reasons to believe growth will be slower in the future. That will make achieving better balanced economies even harder than it might be. But the big problem is that policymakers have permitted the crisis to do much more damage than it needed to do in the short to medium term, and have failed to ensure a path to a balanced economy in the longer term. They allowed stimulus, particularly fiscal stimulus, to diminish too soon. But more important, they have failed to tackle longer-term constraints on achieving balanced domestic and world economies. Once one thinks about these issues, it is evident that needed changes will be very hard to achieve. We have apparently become dependent on unsustainable credit booms. It is necessary to consider alternative ways of balancing demand with potential supply. Among such ways are radical domestic and global monetary reforms. Indeed, the world of floating fiat currencies and debt-backed money has been so unstable that radical reform must be on the agenda. It will not happen this time, but after the next crisis, its time will surely have come. So prepare now. How to do so will be discussed in the conclusion, but first, let us look at another important story: the future of the Eurozone. Chapter 9. Mending a Bad Marriage. They make a dessert and call it peace. Tacitus. It is an error to think that fiscal austerity is a threat to growth and job creation. At present, a major problem is the lack of confidence on the part of households, firms, savers, and investors who feel that fiscal policies are not sound and sustainable. In a number of economies, it is this lack of confidence that poses a threat to the consolidation of the recovery. Economies embarking on austerity policies that lend credibility to their fiscal policy strengthen confidence, growth, and job creation. Jean-Claude Trichet, interview with Libération, July 8, 2010. The euro has been a disaster. No other word will do. A project intended to strengthen solidarity, bring prosperity, and weaken German economic domination of Europe has achieved precisely the opposite. It has undermined solidarity, destroyed prosperity, and reinforced German domination, at least for a while. For all its cultural and economic achievements, Europe has a long history of catastrophic errors, which have usually been the result of blind arrogance and wishful thinking, bordering on insanity. In the year this book is published, the world is mourning the centenary of perhaps the most significant of all of Europe's follies, the First World War, which led, not inevitably, but ultimately, to the Second. Then, over half a century of patience, under U.S. protection, the Europeans brought forth upon their continent peace, prosperity, and partnership, only to succumb to a new, far less calamitous but even less necessary piece of arrogance: the idea that an irrevocable currency union among sovereign states with diverse economies and very different cultures could work smoothly. The crisis has made clear how foolish this view was. For all their mistakes in running the Eurozone, German policymakers and economists, to their credit, understood the risks. The only other larger European country to do so was the UK. Thoughtful Germans, particularly those working at the Bundesbank, realized that in the modern world, a currency is a product of a state and a polity. It must come after their creation, not before it. But other Europeans decided to put the cart before the horse by creating the monetary union before a proper union of states. The report of the Committee for the Study of Economic and Monetary Union, established in 1988 and chaired by Jacques Delors, President of the European Commission, contained no discussion of the political underpinnings of a currency union. It was instead merely a technical guide to the path towards it. Caught in the throes of its internal unification, for which it sought its partner support, and committed to the European ideal, Germans felt they could not reject this plan. The Maastricht Treaty, establishing a path to the currency union, was duly agreed in 1991, and, in the course of time, almost every member of the European Union sought to join. The rest is the history described in chapters 2 and 5. The contrast with the emergence of the American monetary union is extreme. As Professors Kevin O'Rourke of Oxford University and Alan Taylor of the University of California observe, the U.S. began with a secure political union from which exit is now unthinkable, and this provided a stage on which economic and monetary union could be slowly constructed. The U.S. National Constitution embodied key assumptions about the existence and permanence of the national debt, a key collective safe asset, and federal taxing power, ultimate central fiscal capacity, as well as the common currency and the Commerce Clause, truly free interstate trade. Onto this, after major crises, a banking union and an economically meaningful fiscal union were later grafted. In comparison, neither the Eurozone nor the European Union comprise a political union. Exit is conceivable from both and openly discussed. There is no central fiscal authority in either, nor any common debt, and there seems to be no appetite on the part of the creditor nations to go down that route. Recognizing these limits means that what is desirable for the Eurozone may not be feasible. 5 member countries, Greece, Ireland, Italy, Portugal, and Spain, fell into deep depressions, with extremely high rates of unemployment and soaring public debt. In Greece and Portugal, the youth unemployment rate has exceeded 55%. Not just a decade is being lost, but sizable parts of an entire generation. By early 2014, one could see signs of a feeble recovery, but unemployment is likely to remain very high until the end of the decade or even later. Cyprus even imposed capital controls in 2013, thereby establishing what everybody already knew. A euro is not a euro unless it is a physical note or a coin. A euro in a bank account in Cyprus is not necessarily the same thing as a euro in a bank account in Germany. The latter can be used freely as a means of payment at all times and anywhere. The former cannot. Trust in European institutions has fallen sharply. Extremist political forces are emerging in some countries. Resentment among the peoples of Europe is emerging everywhere. The post-war domestic and European settlement is fraying. Meanwhile, a stream of austerian platitudes and over-optimistic forecasts flows from those in charge. Europe is under the sway of the ideas of Heinrich Brüning, German Chancellor between 1930 and 1932, whose disastrous policy of austerity prepared the way for Adolf Hitler. Proponents thought eliminating multiple currencies would also end balance of payment crises. But credit crises and long-running traumas of external adjustment emerged instead. Proponents thought providing a single currency would ensure the beneficial integration of cross-border finance. But national banking crises emerged instead. Proponents thought the act of creating a single currency would eliminate the fear of breakup. But the survival of national politics ensured this remained a live question instead. Proponents thought that creating a currency union would bring the peoples of the Eurozone closer together. Crises divided them into contemptuous creditors and resentful debtors instead. This has been a march of folly. Think of the Eurozone as a polygamous monetary marriage, entered into by people who should have known better, in haste and with insufficient forethought, without any mechanism for divorce. Deliberately so, since the more unfeasible a divorce, the less credible it becomes. The groom came to the altar out of a sense of duty, not out of a strong belief in the monetary marriage. The bride did not understand what they were doing. Then came an irresponsible honeymoon when everybody seemed to be getting what they wanted. The brides were able to borrow freely at far lower rates of interest than ever before. Predictably, they went shopping. The groom went back to hard work, building up a hugely competitive export sector and a vast external surplus matched by growing claims on the debtors. Then came the crisis. The groom complained that the brides had wasted his money. The brides complained that the groom was forcing them into penury. So the marriage went very bad, in part because it always was a bad idea, but also because the honeymoon had been so irresponsible. Then, when the crisis came, everybody made big mistakes. Consider the possible outcomes: divorce, continuation of a bad marriage, or creation of a good marriage. Today, the members are dangling between the first two alternatives. The marriage is pretty bad, but divorce looks frighteningly painful. What is needed is to turn this into a good marriage. Action must, again, cover flows, stocks, and reforms. First, everybody must return to a reasonable level of prosperity. Second, the Eurozone must deal with the overhang of stocks of bad debt inherited from the recent or, in some cases, more distant past. Third, it must put in place reforms that make its future more prosperous and secure. It seems really unlikely that all this is going to happen. If so, the likelihood is either divorce, though probably only after a lengthy period of a truly bad marriage, or, more likely, an almost intolerably bad marriage forever. The discussion will begin with the legacy of the honeymoon. It will then look at what an enduring bad marriage might mean, and next, what a divorce might look like. Finally, it will examine how to achieve a good marriage, and whether that is even feasible. Honeymoon illusions. The strangest feature of the Eurozone story is that it was almost as if 3 fairy godmothers had attended the wedding. The first said, "You will all get exactly what you want." The second added, "After 10 years, you will then get your worst nightmares." The third concluded, "Yes, you will get your worst nightmares because you first got exactly what you wanted." So in those happy honeymoon years up to late 2008, countries that had previously suffered from weak public finances, high interest rates, and vulnerable currencies enjoyed some happy combination of low interest rates, fast economic growth, rising real wages, and growing current account deficits. They did not all have all of these things. Italy and Portugal did not enjoy fast economic growth, for example. But overall, this was a contented period. Meanwhile, Germany, and to a lesser extent some other northern countries, enjoyed rising competitiveness and net exports, partly because of access to the markets in the Eurozone, but also because the euro was much weaker than the Deutschmark would have been. Needless to say, the happiness of the borrowers and that of the lenders were two sides of one coin. Then the honeymoon came to an end, this time in the midst of a global financial crisis. Suddenly, market participants, policymakers, and the people realized they had made huge mistakes. Greek public debt was not as good as German debt. Current account deficits of around 10% of GDP and net external debts of close to 100% of GDP, as in Greece, Portugal, and Spain, were not sustainable, even in a currency union. Countries did not become rich by building houses potential purchasers did not want or could not afford. Economies did not become enduringly competitive by expanding their construction, property, and financial sectors. Countries would not remain competitive if they let their labor costs rise faster than those of the Eurozone's anchor country year after year after year. And it really did not make sense for countries whose industries were competing with those of China to allow their labor costs to rise faster than in countries like Germany, whose industries were complementary to those of China. In sum, it had been worse than 10 years wasted. It had been 10 years of travel in the wrong direction. That is why the crisis was so bad. The Eurozone was not constructed to cope with the mixture of economic, fiscal, and financial crises that emerged after 2008. But the position would not be quite so bad if people had not believed in it so much in the first decade of its existence. Living in a bad marriage. Economic processes are cumulative. Powerful forces can reinforce the success of some regions and the failures of others. Today, resources themselves do not matter that much, but network externalities matter a great deal. The factors that start driving economies in opposite directions may initially be accidental, but that will not matter in the long run. If a particular region has succeeded over time in bringing people together, skilled in a particular set of activities, created the physical, social, and cultural infrastructure that supports their work, built up the amenities they desire, and has gained the taxable wealth to reinvest in ever more of this, it can gain extraordinarily durable advantages. Think of the contrast between northern and southern Italy, Boston and Mississippi, Bavaria and Brandenburg, Manhattan and Detroit, or London and any other British city. The marriage trap. What has this to do with the bad Eurozone marriage? We know the vulnerable countries are suffering economic depressions and difficulties with debt likely to last many years. It would be extraordinary if their economies were to be back to their pre-crisis levels a decade after the crisis. It is also unlikely any of them would have unemployment below 10% of the labor force before, say, 2018. Some may have unemployment over 20%. It's still likely that at least one, and possibly more than one of them, are going to be forced to default on their public debt, with devastating consequences for confidence in the only governments these countries have. This is all bad. But one must also appreciate the longer-run costs of such disasters. Any able and enterprising young person will contemplate emigrating, and in the worst-hit countries many are already doing so. With depressed investment and an anxious younger generation, these countries may be eating their seed corn. At worst, they could enter a downward spiral of slumps, fiscal difficulties, emigration of the enterprising, a yet more unbalanced demographic profile, and back to worse slumps. If so, what we would be witnessing is not just a temporary Eurozone crisis, however extended, but the emergence of something like the old Mezzogiorno, Italy's poor southern region, but across whole countries, not just regions. Such a prognosis may seem alarmist, but it is conceivable. If we were to look at the Irish and Portuguese economies and how they expanded in 2013, we'd see that in neither case was GDP decisively above 2012 levels. Moreover, both economies were still about 7% smaller in late 2013 than at their pre-crisis peaks. Neither Italy nor Spain showed much recovery in 2013, while Greece languished in a deep recession. Note, too, that the unemployment rate consistently rose after the crisis in Greece, Italy, and Spain, and fell quite slowly from high levels in Ireland and Portugal. These are true depressions. Note again that the signs of improving competitiveness one can see, particularly in Ireland and Spain, is largely because of higher productivity. As Professors O'Rourke and Taylor note, nominal wages are still sticky downwards, as they have been in most high-income countries since the First World War. Among these countries, only Greece saw significant falls in nominal wages. To achieve that, the economy shrank by 25%. Moreover, if higher productivity and declining nominal wages are the route to competitiveness, employment has to collapse, thereby raising productivity directly and putting downward pressure on wages indirectly. The mechanism of Eurozone adjustment is simply that of the old gold standard. If we are to understand why adjustment is proving so hard, we need to look at what is happening in the Eurozone as a whole. The economy has, alas, been allowed to stagnate. Moreover, Eurozone annual headline and core inflation, minus food, energy, alcohol, and tobacco, were both just 0.8% in the year to January 2014. This is far below the European Central Bank's admittedly ambiguous inflation target, which is for rates of below but close to 2% over the medium term. It would be far better for the ECB to raise inflation above its medium-term target of 2%, rather than let it fall below it. Such a rise in inflation and inflation expectations could lower real interest rates and so encourage spending and growth. If very low inflation is bad, deflation is worse. It will raise real interest rates and the real burden of debt still further. The ECB has failed to do its basic job by allowing inflation to become too low and the economy too weak. Worse, the Eurozone is now probably just one adverse shock away from a deflationary outcome. Higher inflation would also make needed adjustments in competitiveness among economies quicker, given resistance to nominal wage declines. But the dispersion in inflation between creditor and debtor countries needed to accelerate the adjustment in competitiveness is not happening fast enough because the average level of inflation is too low. In the year to January 2014, core consumer price inflation was only 1.2% in Germany, against 0.9% in Italy, though it was negative 0.1% in Spain. Germany's core consumer price index rose by 6.7% between January 2008 and January 2014, against 9.3% in Italy and 5.3% in Spain. Thus, German core inflation is very low, forcing the countries seeking improvements in competitiveness towards deflation, which Greece had reached in the year to January 2014, and Ireland and Spain were close too, with the inevitable adverse results for the real levels of their euro-denominated debt. Adjustment is occurring, but by shedding labor. If the productivity improvements prove sustainable in the long term, newly profitable businesses should expand production using lower inputs of labor per unit of output. But it's going to take a long while for this to drive up employment in entire economies, particularly larger and less trade-dependent ones. All this sets the stage for debt deflation. Nominal GDP is depressed, and nominal interest rates on longer-term government bonds, though much lower than before the announcement of its outright monetary transactions program by the ECB in the summer of 2012, were still some 2 percentage points above German levels in early 2014. Baseline forecasts made by Zult Darvis in September 2013 for Bruegel, the Brussels-based think tank, suggest that Italy's ratio of public debt might fall from 130% of GDP now to 110% in 2028, while Spain's will rise further to 110% by 2020 before falling to around 95% by 2028. Both of these important countries are traveling along debt's knife-edge path, given their vulnerability to any spike in interest rates. The ruling of the German Constitutional Court in February 2014 that the outright monetary transactions program is inconsistent with the treaties establishing the monetary union, though not yet blocking it outright, might make it much harder to operate in practice. Markets might yet be shocked by this realization. Thus, default or a restructuring of some kind is certainly conceivable, which can only itself increase the risks of a spike in interest rates. Ultimately, debt manageability depends on the relationship between the growth of nominal GDP and the interest rate. The relationship between the two is delicately poised in the crisis-hit countries. They have low prospective growth of nominal GDP, at probably no more than 3% given these countries' necessarily ultra-low inflation if they are to regain competitiveness in a low-inflation Eurozone. And they still had long-term interest rates on public debt at 4% in early 2014. Any loss of confidence could cause this relationship to shift adversely, both quickly and dramatically. As Professors O'Rourke and Taylor remark, based on interwar experience, large public debts are difficult or impossible to stabilize when deflation is increasing the real value of the debt and slowing economic growth. The Baltic example. At this stage, some bright spark, seeking to counsel the desperate, will point to tiny Latvia, deemed a great success of the internal devaluation and austerity strategy. But this is largely an illusion. What is possible for tiny open economies without their own banking systems, and so no need to bail out the banks, and next to no government debt before the crisis, is impossible for others. All three small Baltic states, Estonia with a population of 1.3 million, Latvia with 2 million, and Lithuania with 3 million, enjoyed credit-driven booms prior to the financial crisis. In 2007, Latvia's current account deficit was 22% of GDP, Estonia's was 16%, and Lithuania's 14%. The domestic counterparts of the capital inflows were huge private sector financial deficits, 23% of GDP in Latvia, 19% in Estonia, and 13% in Lithuania. As usual, the booms flattered fiscal positions. Estonia's net public debt was minus 4% of GDP in 2007, Latvia's 5%, and Lithuania's 11%. Then came the four horsemen of financial crises: sudden stops in capital inflows, asset price collapses, recessions, and fiscal deficits. In response, the Baltics decided to stick to currency pegs and embrace austerity. A substantial rescue package was also negotiated for Latvia in late 2008, with support from the European Union, the International Monetary Fund, the Nordic countries, and others. Yet some doubted whether the program would work. Olivier Blanchard, the IMF's economic counselor, stated in June 2013 that many, including me, believed that keeping the peg was likely to be a recipe for disaster, for a long and painful adjustment at best, or more likely, the eventual abandonment of the peg when failure became obvious. He was wrong. According to the IMF, Latvia tightened its cyclically adjusted general government deficit by 5.3% of potential GDP between 2008 and 2012, to achieve a small surplus of 0.8% in the latter year. Over the same period, Lithuania tightened its cyclically adjusted deficit by 3.3% of potential GDP. The IMF does not provide these data for Estonia. But Greece's tightening was 15% of potential GDP between 2009 and 2012. How well has the strategy worked? Defenders point to recent rapid growth. Latvia's economy grew by 20% between its trough in the third quarter of 2009 and the fourth quarter of 2013, but it shrank by 24% between the fourth quarter of 2007 and its trough. In the fourth quarter of 2013, Latvian GDP was still 9% below its pre-crisis peak. This is no better relative to the pre-crisis starting point than Ireland, Italy, Portugal, and Spain. The other two Baltic states have done better, returning where they were in the first quarter of 2008 by the fourth quarter of 2013, though also after huge slumps. These huge recessions do matter. For Latvia, the cumulative loss from 2008 to 2013 added up to 89% of the country's pre-crisis annual output. On the same basis, the loss was 43% for Lithuania and 39% for Estonia. Unemployment has been falling, but it was still 12% of the Latvian labor force in December 2013, despite heavy emigration. In brief, Latvia, worst hit of the Baltic countries, suffered one of the biggest depressions in history. Moreover, it cannot be a model for far bigger economies, such as Greece, Ireland, and Portugal, let alone Italy and Spain. The Baltic states have four huge advantages in pursuing a strategy of combining economic expansion with fiscal contraction. First, according to Eurostat, Latvian labor costs per hour in 2012 were a quarter of those of the Eurozone as a whole, 30% of those in Spain, and 50% of those in Portugal. Given the potential for further rapid rises in productivity and its integration into the Scandinavian economic system, Latvia did not need a big real depreciation to become competitive. Second, these are very small open economies. The more open the economy, the larger is the portion of output not dependent on recession-hit domestic spending. This makes external adjustment a more potent alternative to domestic stimulus than in larger economies. Between 2007 and 2012, Latvia's current account deficit shrank by 21% of GDP. The same absolute adjustment would amount to just 0.3% of Italian GDP. external markets will hardly notice Latvia's adjustment, but they would certainly notice a comparably large Italian one. Again, Latvia's population shrank by 7.6% and Lithuania's by 10.1% between 2007 and 2012. That has to flatter the unemployment picture, which is still pretty dreadful. If Spain and Italy had lost the same proportion of their populations, there would have been 11 million economic refugees. Such a massive movement of people from collapsing economies could hardly be a politically or socially viable part of the contemporary European settlement. Third, since foreign-owned banks play a central role in the Baltic economies, the banking system survived the economic downturn and fiscal stress. But today, at least, Italy and Spain have a domestically owned banking system. Finally, the Baltic states embraced their European destiny as an alternative to falling back into Russia's orbit, and they have prospered as a result. Their peoples have reason to prefer painful adjustment to appearing to waver in this political commitment. Other crisis-hit countries also have reasons for the commitment to Europe, but to a lesser extent. The Baltic states, and particularly crisis-hit Latvia, are not a model of expansion driven by fiscal contraction. The fiscal contraction itself was indeed contractionary. Subsequently, they were able to combine a colossal external adjustment, greatly facilitated by their small size, with restoration of growth, though joblessness has remained high and emigration has been huge. Latvia is not a plausible model for others, particularly for far bigger countries. The idea that we should view every economy, let alone many economies taken together, as if they were small, open economies that did not interact with one another, is an intellectual disease. It's why the Eurozone policymakers are happy to ignore demand. It's also why the adjustment process has been so grim. One can argue that Latvia is the model for tiny countries, but it's crazy to think it's a model for Europe as a whole. Turning the Eurozone into a bigger Germany. Germany thinks of itself as the model on which the new European economy should be built. But the German model, that of an open, export-dependent economy, works only because other countries are its mirror image. Germany has always used shifts in its external balance to stabilize the economy. A rising surplus when domestic demand is weak, and the reverse when demand is strong. Germany's economy may seem too big to rely on a mechanism characteristic of small and open economies. It has managed to do so, however, by relying upon its superb export-oriented manufacturing and ability to curb real wages. In the 2000s, this combination allowed the country to regenerate the current account surplus lost during the post-unification boom of the 1990s. Between 2000 and 2007, Germany's current account balance moved from a deficit of 1.7% of GDP to a surplus of 7.5%. This, in turn, helped bring modest economic growth despite feeble domestic demand. For this approach to work, a large export-oriented economy needs buoyant external markets. Within the Eurozone, domestic credit booms drove demand in several countries. As noted in chapters 2 and 5 previously, after the financial crisis, capital inflows halted and private spending collapsed, creating huge fiscal deficits. The mistaken consensus swiftly emerged that this was a fiscal crisis. In truth, except in the case of Greece, it was a financial crisis with fiscal consequences. But crisis-hit countries had to tighten their fiscal positions, despite their deep recessions. Unfortunately, the Eurozone's healthier countries also hewed tightly to the stability mantra. So they, too, tightened fiscal positions. The IMF has forecasted that the Eurozone's cyclically adjusted fiscal deficit will have shrunk by 3.2% of potential GDP between 2009 and 2013, ending up at just 1.1% of GDP. The European Central Bank also continues to show next to no interest in spurring demand and is allowing inflation to fall far below target. Unsurprisingly, Eurozone demand is becalmed. That leaves external adjustment. According to the IMF, by 2018, every current Eurozone member, except Finland, will be running a current account surplus. The Eurozone as a whole is forecast to run a current account surplus of 2.5% of GDP. Such reliance on balancing the domestic economy via external demand, that is, using an external imbalance, a current account surplus, to offset an internal imbalance, a shortfall of domestic demand relative to potential output, is exactly what one would expect of a Germanic Eurozone. This has, after all, been the macroeconomic policy of Germany for most of the past half-century. If one wants to understand how far the folly goes, one must study the European Commission's work on its macroeconomic imbalances procedures. Its features are revealing. Thus, it takes a current account deficit of 4% of GDP as a sign of imbalance, yet, for surpluses, the criterion is 6%. It can hardly be an accident that this happens to be Germany's surplus. Above all, and amazingly, no account is taken of a country's size in assessing its contribution to imbalances. In this way, Germany's role is brushed out. Yet its surplus savings create huge difficulties when interest rates are close to zero. The omission of Germany makes the Commission's analysis of imbalances indefensible. Imbalances are a systemic issue, not a country-specific one. What matters is the scale of the imbalances relative to the Eurozone economy. In this broader context, Germany's surpluses are crucial. The implications of the attempt to force the Eurozone to mimic the path to adjustment taken by Germany in the 2000s are profound. For the Eurozone, it makes prolonged stagnation, particularly in the crisis-hit countries, probable. Moreover, as it starts to work, the euro itself is likely to appreciate, so increasing risks of deflation and undermining the austerity-driven increases in net exports of vulnerable countries. Not least, the shift of the Eurozone into surplus is a contractionary shock for the world economy. The Eurozone is not a small and open economy, but the second largest economy in the world. It's too big, and the external competitiveness of its weaker countries too frail to make big shifts in the external accounts a workable post-crisis strategy for economic adjustment and growth. The Eurozone cannot hope to build a solid recovery on its mechanism, as Germany did in the buoyant 2000s. Once this is understood, the internal political pressures for a change in approach will surely become overwhelming. Europe will not become a bigger Germany. It's foolish to believe it ever could. The political challenge. The difficulty is not only that the economic outcomes have been so terrible, but that a complete separation has emerged between the national level of accountability and the Eurozone level of power. Democracy has been nullified as politicians of foreign countries, or more precisely of one foreign country, and their official lackeys dictate to sovereign nations not just temporarily in a period of crisis, but indefinitely. This structure cannot hold, and if it can, it should not. Fear of divorce. If the bad marriage is miserable, and in the long run probably unsustainable, only two alternatives remain: divorce or a good marriage. A good marriage is one in which the partners stay together not because they are frightened of the consequences of leaving, but because they would prefer remaining in it to any conceivable alternative. Indeed, faced with the initial choice, but knowing all they now know, they would still tie the knot. So what might a divorce look like? Here, the first question is, what would happen if just one country tried to leave? The second, is what would happen if a comprehensive breakup occurred. Managing partial exits. One can envisage two possibilities: a disorderly exit and an orderly exit. A cessation of external official funding, perhaps because a country refused to abide by an agreed program, might trigger a disorderly collapse. The government of the country in question would default. The European Central Bank would argue that the banks of the country in question no longer possessed acceptable collateral, which would prevent it from operating as a lender of last resort. Comprehensive bank runs would occur. The country would impose exchange controls, introduce a new currency, redenominate domestic contracts, and default on external contracts denominated in euros. These defaults would be by both the public and the private sectors. Chaos might break out. Unpaid police officers and soldiers would be unlikely to keep order. Looting and rioting would occur. A coup or civil war would become conceivable. Any new currency would be sure to depreciate sharply. Inflation would soar. In the medium run, however, order would presumably be restored in some way, even at enormous cost. In time, after a huge devaluation, the economy would probably thrive, as happened to the East Asian economies after their post-crisis devaluations in 1997 and 1998. The devaluation would help adjust the current account radically, generating a strong growth impulse over time. Of course, the government might make a mess of this opportunity. Indeed, after a crisis of this magnitude, irresponsible populism is all too likely. The consequence would then look a bit like Argentina 10 years after its default and devaluation. An agreed or so orderly departure would end up in much the same place, but much sooner. Outsiders would support the banking system and pay beneficiaries of public spending during transition to a new currency. And that should limit unrest as well as reducing the currency collapse and inflationary upsurge. In either case, a big challenge would be to manage the contagion. An exit, particularly a disorderly one, would surely trigger bank runs and capital flight from other members. It could also cause collapses in the prices of financial and other assets. A flight to safety, to Germany or beyond the Eurozone, would occur. A decisive response from the Eurozone would be required to halt the contagion. The ECB would need to act as a lender of last resort on an unlimited scale, replacing money taken out in bank runs. Interest rates on sovereign debt would need to be capped. Above all, the commitment to keep the rest of the Eurozone together would have to be reinforced. The Eurozone either is an irrevocable currency union, or it is not. If countries in difficulty leave, it is just an exceptionally rigid fixed currency system. So, any departure would have a destabilizing effect. People would trust in the Eurozone's survival even less, and the economic benefits of the single currency would dwindle. The least destabilizing exit would be by a creditor country, notably Germany, as George Soros has argued. But even this would be highly destabilizing. Exit could never be a surprise in a law-governed society. In the run-up to the exit, there would be flight into German financial assets, which the German authorities would have to manage in conjunction with the European Central Bank from which they intended to exit. Agreeing rules on conversion would create prolonged and profound uncertainty, which would spread to other creditor countries likely to follow Germany's lead, notably Austria and the Benelux countries. After introduction of the new currency, or more probably reintroduction of the Deutschmark, German financial institutions would suffer losses on their holdings of euro-denominated assets. German manufacturing would be hit. The credibility of Germany's commitment to the European project, the core of its post-war political identity, would be shattered, and its relations with important partners, notably France, put into limbo. Comprehensive breakup. Suppose the Eurozone members agreed to break the whole structure up instead of watching the departure. be it orderly or disorderly, of just a few members. In principle, it would be possible to divide every euro and redenominate every euro contract into the component currencies, weighted as they were when they joined the euro. But this would mean telling the citizens of, say, Germany, that their euro accounts and euro claims suddenly contained a substantial proportion of French francs, Italian lira, Spanish pesetas, and all the rest. This would be very unpopular. German citizens would surely feel cheated. In fact, governments would want to redenominate domestic money and contracts in their restored national currencies. Individual countries' experiences would vary, depending upon their exposure to foreign trade and financial interlinkages. But inflation would soar in the devaluing debtor countries. In creditor nations, deflation would be likely to set in. Inflation should erode the debt mountains of peripheral nations, provided they were promptly redenominated in the new domestic currencies. The value of the foreign assets of core countries would fall. Their new currencies would soar relative to erstwhile partners, and their economies shrink. It would be painful for all. The mechanisms at work would be both powerful and disorderly. Runs, the imposition of illegal exchange controls, legal uncertainties, asset price collapses, unpredictable and unknowable shifts in balance sheets, freezing of the financial system, disruption of central banking, collapse in spending and trade, and enormous shifts in the exchange rates of new currencies. Further government bailouts of financial systems would surely be needed at great cost. Big recessions would also worsen already damaged fiscal positions. Such a chaotic breakup would also trigger legions of lawsuits. The sad truth is that an orderly breakup is a contradiction in terms. The very notion would create too much instability while being discussed and agreed among so many countries. Worse, it's the sort of thing that could only happen in a crisis. It would be born of crisis and generate bigger ones. The EU would be cast into illegal and political limbo, with its most important treaties and proudest achievement in tatters. It is impossible to guess at the result of such a profound change in the European order. Winners and losers. There would be no winners from a comprehensive breakup. But it is a good guess that creditors would be even more damaged than debtors. Export-dependent Germany might find itself suffering much the same longer-term fate as Japan, if not even worse. As noted previously, Germany's financial system would be damaged as the value of its external assets tumbled, while its manufacturing industry would surely shift much of its activity into neighboring countries, just as Japan has shifted much of its production into its neighbors, particularly China. Germany would emerge as a wealthy but stagnant rentier economy and society, earning a living off its foreign assets and, still more, its know-how, rather than off its domestic production. And this ignores the consequences of isolation from its neighbors and partners, the very fate that its wisest leaders have sought to avoid since the end of the Second World War. Neither as economic nor, still less, as political partners, could Russia or China give Germany what a thriving EU gives, a secure and predictable place in the world, and the company and support of those who share its values. The achievement of a unified, peaceful, and democratic Germany, anchored in a prosperous EU, is not to be cast aside lightly, or indeed at all. All wise German leaders know this, and all the evidence we have is that the German people agree, as indicated by their consistent choice of pro-EU and pro-Euro politicians. Global dangers. These perils are not of concern to the Eurozone alone. Taken as a whole, it's the world's second-largest economy with the largest banking system. The risk that a bigger Eurozone upheaval would cause a global crisis is real. Moreover, beyond that, a stable Europe is among the greatest achievements of the post-Second World War order, and surely the finest triumph of American statecraft. It cannot and must not be thrown away. However bad an idea the Eurozone might have been, breakup would be worse. Towards a good marriage. So if the marriage is bad, and divorce terrifying, the challenge is to turn the bad marriage into a good, or at least a tolerable, one. And considering what would need to happen, one must start by recalling what critics knew in the early 1990s. Namely, this is not a natural economic union. The economic forces driving these economies apart are far greater than in other federal monetary unions because of their economic diversity, while the institutional and political underpinnings of the union are far weaker because of their political diversity. What needs to be done in the Eurozone is to discover a set of practices and develop a set of supporting institutions that do enough to manage the diversity among its economies while not demanding too much of the diversity among its polities. Can this be done? We do not know. Can we define what needs to be done? Yes, we can. The limits of Eurozone integration. If we compare the Eurozone with the most obvious economy in terms of scale, political values, and level of development, we end up looking at the U.S. But as one would expect, given not just its lengthy history as a united country, its common language, shared legal traditions, and mobile population, the U.S. economy is far more integrated than that of the Eurozone. U.S. internal trade is bigger, relative to GDP, and U.S. labor mobility is far greater. Yet perhaps even more important is the fact that the U.S. offers two insurance mechanisms for its states. It also offers a critical background condition. The background condition is that breakup is not an option. Fear of secession will not generate flight from a state's liabilities, be they government or private. The Civil War resolved that question. Fortunately, nobody would go to war to keep the Eurozone together. Unfortunately, this also means that the risk of breakup cannot be eliminated. The first of the U.S. insurance mechanisms is a federal tax and spending system, which ensures not only an important offset to economic shocks, but also that individuals and businesses can survive even the bankruptcy of a local or state government, relatively unscathed compared with what default means in the Eurozone. The second, and possibly even more important insurance mechanism, is support for the financial system from the U.S. Treasury and Federal Reserve. It is horrifying even to consider what would have happened in 2008 if responsibility for managing the collapse of the U.S. financial system had fallen to the state governments of New York, South Carolina, or California, all homes of huge financial institutions. Adjustment of income and spending. The immediate challenge confronting the Eurozone is adjustment. The vulnerable countries need to achieve internal and external balance once again, sustainable external accounts, sustainable fiscal positions, and full employment. The reason why the process of adjustment has been so painful is only partly because the exchange rate has been removed as an instrument, but even more because it is so asymmetrical. Indeed, it's not clear that the vulnerable countries can live with creditor countries that run such huge, persistent current account surpluses. If Germany and other surplus countries were to earn those surpluses in trade with economies outside the Eurozone, the result would probably be an appreciation of the euro. That would once again undermine the competitiveness of the vulnerable economies. In effect, the current account surpluses of creditor countries are sucking demand out of vulnerable countries. It makes little sense to insist that the latter become more competitive if overall demand does not expand. This is a zero-sum game. Building the future of the Eurozone on such a game is folly. This has important implications. One is that the ECB must do more to promote demand in the Eurozone. It should be willing to use unconventional policies. It should also target a higher rate of inflation to facilitate needed adjustments in relative prices. Aggregate inflation of 3 to 4% a year would not be a disaster. A nominal GDP target for the Eurozone would also make a great deal of sense. Another implication is that the Eurozone's new imbalances procedure must bite. The most important contributor to the Eurozone's internal imbalances is Germany. It needs to find a way to reduce its current account surplus. If it does not wish to use fiscal policy, let it try something else. It would also help if the Eurozone's internal capital flows did not take the form of debt in general, and bank debt in particular. Banks have played far too big a role in the Eurozone's finances. A move towards greater reliance on capital markets would help, though care would have to be taken to avoid the disaster of shadow banking in the U.S. Financing adjustment. Symmetrical adjustment is essential, but so is the financing of economies in difficulty. The well-understood reason for this is that private financing usually turns around faster than any economy can adapt, creating unnecessarily deep and socially costly collapses. Such financing is going to be even more important in the absence of a flexible exchange rate. In the Eurozone, the role of financier of last resort falls to the ECB. Yes, the creation of the European Stability Mechanism, together with funding and intellectual input from the International Monetary Fund, provides a backstop. But what members of the Eurozone, particularly Italy and Spain, needed most during the worst of the market panic was insurance against illiquidity in their markets for government and bank funding. They lacked what the UK and the US possess: a supportive central bank. Indeed, as Paul de Grauwe, now at the London School of Economics, has argued cogently, the panic in financial markets, the threat to national banking systems, and the inability of governments to fund themselves were due to the failure of the ECB to ensure liquidity in debt markets, a responsibility the Federal Reserve met during the crisis. The main reason weak banks ended up in a terrifying embrace with weak states, two drunks holding each other up, is that it was widely believed that the ECB would allow liquidity crises in the markets for government bonds to turn into sovereign defaults. Governments do not offer collateral, so government debt markets are always lifted by their own bootstraps. The willingness to lend depends on the perceived willingness of others to do so, now and in the future. Such markets are exposed to self-fulfilling runs, and so need a credible buyer of last resort. That is the central bank. The UK has such a central bank. Eurozone members do not. In effect, they borrow in a quasi-foreign currency. Note that if the ECB succeeded in stabilizing government bond markets, it would automatically stabilize banks as well, since fears of sovereign defaults drove worries over insolvency of banks. The capital needed to protect the European banking system from defaults by important sovereigns does not exist. It's ridiculous to suppose that sovereigns can provide insurance against their own default. Yet, since there is no good reason for a well-managed Eurozone to suffer illiquidity-driven defaults, the answer is to stop them at the source. The ECB had the firepower to do this and finally did it via its OMT program in the summer of 2012, with remarkable success, enormously easing the pressure on the two pivotal, vulnerable countries, Italy and Spain. It is a tragedy that it did not do this earlier. Yet even the OMT program might fail if put to the test. The ECB's promise to offer unlimited but conditional support is inherently contradictory, as noted in Chapter 2. It's easy to imagine circumstances in which the ECB would feel unable to help, because elected politicians refuse to meet the conditions imposed upon them. Unfortunately, the circumstances in which this conflict happened would be ones of extreme crisis. One must hope it never comes to this. But it could. Financing must not be so generous that it prevents adjustment, but rather gives adjustment the time it needs. The stress on governments and credit markets in vulnerable states is quite large enough, despite the ECB's interventions, to ensure this, as shown by the massive shifts in current accounts, weak economies, and high rates of unemployment. Worse than that is neither morally justifiable nor practically needed. Debt restructuring. Adjustment, financing, and growth are the start of what is needed to put the Eurozone economy back on track. Together they would handle the flow problems, those concerning flows of incomes and spending, including the balance of payments. But there is also a stock problem, the overhang of private and public debt from past mistakes. The lower the interest rates paid, the easier debt is to handle. Nevertheless, the vulnerable countries are all going to end up with very high public debt, which it will take a very long time to reduce to manageable levels. Moreover, we now know from experience that if they are to use fiscal policy to cushion recessions in the future, they need low debt burdens. More fundamentally, members of the Eurozone do need to have relatively low levels of public debt because they are semi-sovereign countries locked inside a currency union without access to their own central bank or a solid demand for their sovereign debt as a safe asset. A credibly one-off debt restructuring might be necessary in a number of cases, notably Greece. This would certainly create problems, notably for the banks. It might be necessary to restructure bank debt as well, as has happened in Iceland and Cyprus. But the long-established practice of protecting bank creditors at the expense of taxpayers must be ended in any case. It is unconscionable. An alternative to the nuclear option of debt restructuring would be agreement on lower interest rates and much longer maturities, supported by the creditor countries directly via ECB involvement or both. Since, as argued in Chapter 5, the creditor countries bear a full share in the responsibility for the mess, they should expect to bear a full share in its resolution as well. There is another alternative, rapid economic recovery, but that will depend on the speed of the adjustment. Reforms. Let us assume that the Eurozone does manage the adjustment, financing, and restructuring needed to put the economies on a sounder footing. What else is needed if it is to be a minimally viable currency union among otherwise sovereign countries? Here is what must happen and what must not. First, the Eurozone must have a proper banking union. It is now clear that vulnerable countries are unable to provide the backstop for their banks that has hitherto seemed normal. This is why a banking union, similar to that already achieved by the U.S., is vital. It requires several elements. An effective resolution regime for all banks, however large, that will impose losses on bail-inable debt smoothly. Go back and listen to Chapter 7 for an explanation of this concept. Because of the difficulty of doing this, the case for much higher capital ratios, also presented in Chapter 7, is particularly strong for the Eurozone. These semi-sovereign countries need banks that can stand on their own. Such a banking union will require strong central regulation and supervision, and, in particular, strong macro-prudential regulation, at least to try to prevent the sort of runaway credit booms that led to such disasters. The Eurozone has gone quite a long way to meeting these conditions in its Agreement on Banking Union of March 2014. Yet if a banking union is to work, there must exist an adequate supply of unimpeachably safe assets, thereby breaking the doom loop between the sovereigns and their banks. Relying on the debt of just a few countries, principally Germany, is inadequate, particularly since Germany wishes to lower its public debt relative to the economy. For this reason, there has to be an adequate supply of Eurobonds, bonds for which the Eurozone states are jointly and severally liable. As a collectivity, the Eurozone could certainly support Eurobonds up to, say, 60% of the GDP of each member state, and so of all of them together, leaving members on their own in financing debt above that level. The Eurobond market on that scale would bring huge advantages. It would be the second biggest bond market in the world, and so very liquid. Finance would accordingly be cheap. It would give banks a safe asset, and it would give the ECB ideal collateral, and so the possibility of operating unconventional monetary policies, such as quantitative easing, quite easily. Turning a substantial portion of existing bonds into Eurobonds would sharply reduce current anxieties. It would make restructuring the remaining debt much simpler, since it would not threaten the credibility of a substantial proportion of outstanding debt. Second, with banks holding Eurobonds, it would be far easier to restructure remaining public debt, making the no bailout clause credible. A no bailout rule is far simpler than the undemocratic attempt to operate an economically arbitrary and hard to measure and interpret restriction on structural or cyclically adjusted fiscal deficits, as implemented in the Treaty on Stability, Coordination, and Governance in the Economic and Monetary Union signed in March 2012. This not only calls on governments to run budget deficits of less than 3% of GDP, but also requires them to run structural or cyclically adjusted fiscal deficits of less than 1% of GDP if debt is under 60% of GDP, and 0.5% if it is over 60%. These rules are to be enforced through domestic legal procedures. But what sort of procedure can implement an inherently imprecise economic concept, such as the structural fiscal deficit? Precisely because it makes more economic sense than just focusing on the existing fiscal deficit, it is also even less amenable to legal interpretation. Even more important, in a currency union, fiscal policy is the only national stabilizer left. It should not be lightly abandoned in favor of such arbitrary rules. The Eurozone needs to abandon this discipline union approach, replacing it with a more effective no bailout clause. Third, the ECB needs to become a true modern central bank, determined to underpin stability in the Eurozone economy. Demonstrably, it has failed to do this. The changes in fiscal and banking arrangements outlined previously would be a big help, but it may ultimately be necessary to change the treaty to give it more freedom of maneuver in exceptional circumstances, including the ability to finance governments directly. That might become obvious if, as is possible, the OMT is tried at some point and turns out not to work. Finally, the proposals outlined previously evidently presuppose a form of fiscal union. Not in the form of ongoing fiscal transfers, but in the form of collective backdrops for the banking union as well as of Eurobonds. Over time, it will probably be necessary to transfer a part of the fiscal responsibilities of member states to the center. It will also be necessary to generate some capacity for fiscal stabilization policy at the center. Why the road ahead is hard. A small Eurozone that contained Germany and its long-standing partners, together possibly with France, would have surely worked. But the broader and more dysfunctional Eurozone actually created has bequeathed huge and long-lasting depressions and resentments. It is dividing Europe rather than uniting it. It has, as critics warned, become a bad marriage. Yet, divorce, as this chapter has argued, is a very tough option too. The economic and political consequences could prove devastating. Fear of these dire consequences might keep the parties together indefinitely. But locking parties together in a marriage that makes everybody miserable merely because divorce would be even worse would be a horrible outcome for Europe. A far better outcome would be to turn it into a good marriage instead. The Eurozone has definitely not achieved that. Yes, the will to improvise during the crisis was remarkable, but what happened was just enough, almost too late. The British would call it muddling through. More fundamental changes will be needed to achieve a good marriage. The obstacles to success are three. First, with the best will in the world, making a currency union work well is bound to be difficult, particularly in view of the great differences in the economic structure of these countries, in their economic culture, and their politics. Second, the divergence in economic ideology remains substantial. Yes, Germany is powerful enough to impose its views for the moment, but that doesn't mean they are universally accepted. Nor does it mean they will be universally implemented. Germany may be the hegemon, but it is not all-powerful. Third, the peoples of the Eurozone do not like one another very much at the moment, and, more important, they do not identify with one another very much either. Since politics remain national, democratic legitimacy undermines cohesion. This is bad now. It could get even worse. The obstacles to creating a good marriage are indeed high, but perfection is unnecessary, since economic arrangements are always imperfect. What is needed is rather a good enough system. For the marriage to strengthen Europe, rather than weaken it, the Eurozone must generate symmetrical adjustment, debt restructuring, and further fundamental reform, including of its fiscal arrangements. The adjustment needed and the reforms required both go beyond what Germany is today prepared to contemplate. But Germany's insistence on retaining its huge external surplus, on keeping inflation so low, on national responsibility for bank debts, and on ever tighter fiscal discipline will not work. The Eurozone needs to become something different. The question is whether it can reach a more successful and balanced resolution of its failings before it is too late. Conclusion. Fire next time. But this long run is a misleading guide to current affairs. In the long run, we are all dead. Economists set themselves too easy, too useless a task, if in tempestuous seasons they can only tell us that when the storm is long past, the ocean is flat again. John Maynard Keynes, from Tract on Monetary Reform, 1923. Of all the many ways of organizing banking, the worst is the one we have today. Mervyn King, from Banking, from Bagshot to Basel and Back Again, 2010. Since 1980, the world has suffered 6 globally significant financial crises. The Latin American debt crisis of the early 1980s, the Japanese crisis of the 1990s, the tequila crisis of 1994, whose epicenter was Mexico, but which also affected many parts of Latin America, the East Asian crisis of 1997 to 99, the global financial crisis of 2007 to 2009, and the Eurozone financial crisis of 2010 to 2013. This list leaves aside many national crises, the 2001 crisis in Argentina, for example, and significant regional crises, including the Scandinavian crisis of the early 1990s. Indeed, one authoritative source estimates there were 147 banking crises between 1970 and 2011. Driven by trade and foreign direct investment, economic globalization has produced impressive results, notably the successful integration of China and to a smaller degree India, into the world economy, together with large reductions in mass poverty in these and other emerging and developing countries. Nothing in this book contradicts these wonderful results. But financial crises are not among those wonderful results. On the contrary, they are a plague. Indeed, it is far from clear that the globalization of debt-creating flows, particularly those generated by banks, has brought much, if any, benefit to the world economy, as opposed to those who work in the financial industry. Most frightening is that the crises seem to have become bigger and more globally devastating over time. The last two, the global and Eurozone financial crises, struck the core of the world economic system, affecting economies that generate not much less than half of global economic product, if we treat the Eurozone as a single whole. The emerging and developing countries managed the consequences relatively well, but that story is not over. It may well turn out that the ways in which these economies responded to the crisis, particularly fiscal loosening and credit expansion, have wrought substantial, longer-term fragilities. High-income countries had the monetary and fiscal resources to prevent this crisis from becoming a complete economic meltdown. But they were also compelled to adopt extreme measures, notably many years of close to zero short-term interest rates, huge expansions in the balance sheets of central banks, and fiscal deficits that had previously only been seen during world wars. Moreover, as shown in chapters 2 and 3, their recessions were still deep, and the recovery was weak. The full consequences of the measures taken cannot yet be known. Moreover, the events leading up to the crisis and the crisis itself have bequeathed a large overhang of private and public debt. It's unlikely that the high-income countries could cope with another such crisis within the next decade or two, without large-scale defaults in the private or public sector, either openly or via inflation. It might indeed be the fire next time. This is a desperate situation. Keynes was right. Hopes and fears for the long run must not be the enemies of decisive action in the short run. In the 1930s, policymakers tried to do nothing, or, worse, imposed austerity with dire economic and political consequences. As was argued in chapters 8 and 9, policymakers must deal with the problems they confront, but they must also do what they can to prevent them recurring. The ever-rising scale of the crises, combined with the ever-increasing desperation of the measures used to combat them, tells us that something is seriously amiss, as Mervyn King, then governor of the Bank of England, argued just after the height of the crisis. Somehow the interaction between liberalization and globalization has destabilized the financial system. Why has this happened? What is the legacy? What is to be done? And why does it really matter? These are the questions addressed in this final chapter. What happened? If we look at the debate on what happened, we find several explanations. A global savings glut and associated global imbalances, an expansionary monetary policy that ignored asset prices and credit, an unstable financial system, and naive, if not captured, regulation. This list reminds us of the story of 4 blind men who are asked to tell an audience what is in front of them. One says it is a snake, another a snail, a third a pull rope, and the last 4 trees. The answer is an elephant. What we have here is just such an economic elephant. All of the explanations have validity. Above all, they fit together. Our story would go not in 7 ages, but in 7 stages. Here, then, is the story of shifts and shocks, told in this book. Unstable credit. Our liberalized financial system is a credit, debt, and leverage-creating machine. The banks are at the core of this activity, but not on their own. The creation of credit, debt, or leveraging is inherent in banks' on-book lending, but also, to varying extents, in the originate and distribute model of securitized finance, in the strategies of private equity and hedge funds, and not least, in the markets for derivatives. Our public-private credit-backed monetary system is explosive in good times and implosive in bad ones. During the explosions, it creates excessive confidence, credit, and leverage, not to mention excessive behavior, legal, shady, and downright illegal. During the implosions, it creates panic, collapsing credit, deleveraging, and hunts for scapegoats and villains. It was ever thus. Indeed, contrary to the views of many academic Panglossians, informed observers have long known this. But it seems that, given contemporary information and communication technologies, modern financial innovations and globalization, the capacity of the system to generate complexity and fragility surpasses anything seen historically in its scope, scale, and speed. Fortunately, the willingness and ability to respond has also increased. But it was still a close-run thing in 2008 globally, and after 2009 in the Eurozone. Without the policy response, the outcome would have been worse than the 1930s. It may also be impossible, financially or politically, to repeat this response in a similar situation, at least in the relatively near future. The reaction of emerging countries. Emerging countries learned the truth about financial markets from their painful experiences in the 1980s and 1990s. Many then decided to protect themselves against the vagaries of international finance by accumulating foreign currency reserves and relying on export-driven credit rather than credit-driven economic growth. Let others create those debt mountains this time, they decided. And so those others, predominantly a few high-income countries, notably including the U.S. and the European emerging countries, did just that. Big time. This shift by emerging economies looked shrewd. After all, the high-income countries had a substantial advantage in managing financial crises. Their financial institutions were at the core of the global financial system, and they issued the world's principal reserve currencies. These countries could print their way out of the worst of a crisis, a luxury unavailable to almost any internationally open emerging economy. To be safe, an emerging economy needed an impregnable external position. When the crisis hit, China had built one as a result of its massive accumulations of reserves, huge current account surpluses, and exchange controls. It used its position to great effect in 2008 and 2009, though the resulting credit boom created symptoms of financial fragility. The global savings glut. Thus, developing countries shifted into substantial aggregate current account surpluses, led by the emerging colossus, China. Similar shifts into current account surplus, by definition a surplus of income over spending or savings over investment, occurred in high-income countries, notably Germany. The Japanese private sector has run an enormous savings surplus ever since the collapse of its bubble economy in 1990. As commodity prices soared in the 2000s, yet another group of savings surplus economies emerged, namely the commodity exporters, particularly the oil exporters such as Saudi Arabia and other states of the Persian Gulf. In a number of high-income countries, not least the U.S., the non-financial corporate sector also ceased to need funds from outside. On the contrary, with rising profits and a weak desire to invest, the non-financial corporate sector became a net supplier of savings to the rest of the economy. Finally, there was a huge shift in the distribution of income inside many economies, notably, including high-income countries, from wages to profits and, within wages, from those at the middle and bottom towards the top, partly due to globalization, partly due to technology, partly due to financial liberalization, and partly due to changes in social norms, particularly corporate governance. The net result of all these changes was a marked rise in propensities to save relative to propensities to invest, and so long, low-term real interest rates in a world economy characterized by rapid economic growth. This, then, was the global savings glut to which Mr. Bernanke pointed, rightly, in the early 2000s. It might just as well be called a global investment dearth. In the short run, ultra-low real interest rates will raise the prices of long-lived assets, particularly real estate. In the longer run, a savings glut will generate secular stagnation, a situation in which the equilibrium long-term real interest rate is negative, as was the case after 2008 and might have been the case in the run-up to the crisis, as Lawrence Summers, former U.S. Treasury Secretary, has argued. Global imbalances. In the terminology used in Chapter 5, a host of countries achieved internal balance by pursuing external imbalance, or, more precisely, by exporting excessive savings via current account surpluses, which is the same thing in a different language. If some countries export excess savings, others must import them. The only way to import excessive savings is to run a current account deficit. But if this is not to depress output and so cause internal imbalances, domestic demand must rise. Now consider the options of central banks confronted with this internal imbalance caused in large measure by external imbalances. What can they do? The answer is promote domestic spending to offset the contractionary forces. This is what their mandate tells them to do. Keep output near potential, and so keep inflation on target. But in the aftermath of the collapse of the equity bubble in 2000, this no longer worked via higher corporate investment. On the contrary, non-financial corporations were part of the problem of excess savings, not part of the solution. In some cases, the need to close pension fund deficits also contributed to the financial surpluses of the corporate sector. So something else had to be found. That turned out to be investment in residential housing and higher household spending. Happily for central banks, at least in the short term, the fall in global real interest rates was what Hyman Minsky called a displacement event, the beginning of a runaway credit boom. House price rises set these credit booms in motion, above all in the U.S., but also in a number of other high-income and emerging countries in the western, southern, and eastern periphery of Europe with elastic credit. So, central banks had something to build upon. Financial deregulation. Central banks were pouring petrol on the flames because they wanted a blaze. The increasingly liberalized financial sector was only too happy to burn. Its richly rewarded participants found the borrowers they needed among foolish and ill-informed households. They found the purchasers of the securities they created among foolish and ill-informed investors, some of whom even turned out to be perversely rewarded parts of their own organizations. Fraud and near fraud, not to mention massaging of the data to show a prettier picture than was justified, while the rating agencies, for example, exploded. As a byproduct, household borrowing and spending soared and the financial sector boomed. The result was not just too much debt, but debt of doubtful value and, no less, massively increased leverage in the financial sector. Median leverage of UK banks, for example, rose from 20-to-1 to 50-to-1 between 2000 and 2007. Regulators, politicians, and the economists who advised them were either unaware of the full extent of the dangers or were unable or unwilling to act to reduce them, partly because they were captured by the interests of the regulated, partly because they were intimidated or seduced, but above all, more so because they were prey to the very same cognitive errors. Crisis management. This had many elements: lack of preparedness, lack of understanding of what was happening, particularly the multiple ramifications of contagion, political, intellectual, and bureaucratic resistance to taking effective action soon enough, the unavoidable difficulties of handling a crisis that required cooperation across borders, and particularly the Eurozone's political and institutional lack of preparedness. In all, given the difficulties, the disaster was handled far better than it might have been. It did not become a plunge on the scale of the 1930s. The collapse was halted and turned around, but it still left deep scars, prolonged recessions, and, at the time of writing, in 2014, failure to regain pre-crisis growth rates of either production or productivity. Post-crisis management. The shift to fiscal austerity in 2010 and the subsequent weak recovery left monetary policy as the principal tool with which to achieve recovery. In countries with cyclically adjusted current account deficits and a desire for a cyclically adjusted balanced budget, the cyclically adjusted private sector financial balance has had to go into deficit. In other words, the private sector had to end up spending more than its income, and so borrowing more. The way to make this happen was to restart the private sector's credit machine. And that is what the central banks have been trying to do. The belief that government borrowing is the illness for which private borrowing is the cure has survived all that has happened. The chances are good that reliance on this surprisingly durable piece of conventional wisdom will lead to another, and still bigger, crisis. Conclusion. The kernel of the story, then, is one of the interaction between global macroeconomic forces and an increasingly fragile, liberalized financial system. But it would be wrong to see the causality as going one way. Into this complex set of relationships always come asset price bubbles, and both monetary and fiscal policies. The idea that in such a world the central bank can target prices of goods and services while assuming that credit and the financial sector, which both creates and deals in debt, will be stable, is hopelessly naive. This, moreover, is not the end of the story. It's easy to believe that the scale of the current rescue operation might lead to bigger crises down the road, as critics argue. Huge sums of liquid finance, nearly all of it preserved by support from taxpayers during the crisis, now move around the world, most of it managed by agents, rewarded for achieving short-term gains. What is the legacy? It is too soon to tell what difference the crisis that began in 2007 will make to the world. That partly depends on whether the afflicted economies make a strong and balanced recovery. Unlikely though this seems, it is possible. Yet some legacies are already evident, as the introduction has discussed. The economic and financial costs of misbehaving financial systems are revealed to be huge. How big the costs of these crises will end up being is still unknowable. But in the cases of the U.S. and the U.K., the fiscal costs are of roughly the same scale as a world war, while the present value of the economic costs could be even greater, since economies often recover more strongly after wars than after financial crises. In crisis-hit Eurozone countries, the costs would be greater. Obviously, some part of the pre-crisis GDP level was unsustainable. But, as argued in Chapter 8, the view that such enormous losses were unavoidable is unconvincing. Policymakers had choices over how long they let the aggregate demand falter, and so over how bad the long-term effects would be. Research at the International Monetary Fund has suggested, for example, that the more expansionary the immediate macroeconomic policies, the smaller are the long-term losses in output. Yet another legacy is the mountains of private debt, mostly generated before the crisis, and public debt, generated after it. The lower the prospective economic growth, the more policymakers will rely on those four horsemen of post-crisis apocalypse: austerity, inflation, financial repression, and debt restructuring. Since the crisis itself has damaged animal spirits, the likelihood is that trend growth will have been lowered for this reason alone. Moreover, while policymakers may want to drive the economy via another credit boom, they may find it hard to do so, even in the short term. As important as the legacy of debt are the monetary consequences. Central banks have become unprecedentedly active players in the economies of all high-income countries, not excluding the Eurozone, where the ECB has been the decisive actor. If the contemporary monetary system is a public-private partnership, it became much more public and much less private after the crisis. Moreover, the role of the central bank as a creator of money and its role in supporting the financial system has become widely known. What has been learned cannot be unlearned. Again, the economies of the high-income countries are considerably smaller than they were expected to be in 2006, whereas the economies of emerging economies have continued to grow quickly. This shift has accelerated the transition in relative economic weight. Moreover, the high-income economies have not only become relatively smaller more quickly than expected, but, more importantly, have found their credibility as effective managers of their economic affairs grievously damaged. Unavoidably, the crises have also bequeathed some big questions about finance and the world economy. One such set of questions is how far the financial system should be integrated across frontiers. Another set of questions is how to end the global savings glut and associated imbalances. China has grasped the urgency of this point, but Germany, and possibly also Japan, have not done so. An important implication of attempts at reform is the need to take a new view of global institutions, particularly the International Monetary Fund. The same need exists in the Eurozone. The attempt to resolve its problems by turning the Eurozone into a bigger Germany is going to prove unworkable. If this is not understood, and it is not, as yet, where it matters, further crises seem certain. Finally, the crisis has destroyed much of the orthodoxy that dominated monetary and financial policy before it occurred. Naive confidence in the stability of a deregulated financial system has vanished, perhaps for a generation, except in particularly secluded corners of the academic world. Trust between the authorities and the financial system has collapsed. The result will be a more regulated financial system than during the glad morning of financial liberalization during the 1980s, 1990s, and early 2000s. Unless something extraordinary happens, such as election of a Tea Party president and Congress in the U.S., this seems unlikely to change. The new orthodoxy rests on the old inflation-targeted monetary policy, plus more financial regulation and macro-prudential supervision. But this approach might well fail. If so, greater radicalism will be needed. What is to be done? The answers to this question come over two time dimensions, the shorter and the longer terms. They come in two linked categories, macroeconomic and financial, and they need to be assessed on a spectrum of alternatives. Our discussion now considers four along that spectrum. The first is new orthodoxy, the post-crisis policy consensus in the high-income countries of North America and Europe. The second is liquidationism, a return to 19th century free market capitalism. The third is beyond the new orthodoxy, more radical ideas than those of the current orthodoxy, but within the broad framework of that approach. And the fourth is radical reconstruction, principally, though not solely, of the monetary system. What becomes clear is that the best way forward is a pragmatic amalgam of these apparently distinct approaches. None embodies all wisdom. Let's take a look at each one. Short-term recovery of crisis-hit economies. The immediate challenge has been to engineer a recovery in the crisis-hit countries, all of which have ended up far below trend levels of output, and most of which were well below pre-crisis peak output levels in 2013. Achieving this involves fixing three closely interconnected things: the financial system, the overhang of private debt, and the inadequate demand. In some cases, notably in Southern Europe, it has also been necessary to promote greater market flexibility. In neither the U.S. nor the U.K. were these reforms so important, since supposed rigidities were not a credible obstacle to recovery. The post-crisis new orthodoxy was to tighten fiscal policy once evidence of stabilization and some recovery emerged in 2010, and so rely on monetary policy. As argued in Chapter 8, this policy has created significant dangers. It might not work well given the debt overhang. If it worked, it might begin another unsustainable credit-cum-asset price boom. But for some reason, policymakers regarded this reliance on monetary policy as the cautious option, despite the obvious risks of relying predominantly on monetary policy and so on relaunching the credit cycle. The new orthodoxy also included recapitalization of the financial sector and real, but modest, increases in capital requirements for banks. The financial sector and markets that have emerged from this approach are, however, in essence the same as the ones that went into the crisis. Banking has even been further concentrated in a remarkably small number of banks. The official list includes just 29 globally significant international banks. It's not clear that these are all too big to fail, but it is highly unlikely that such banks could be resolved smoothly in a significant crisis, partly because they are still too interconnected to fail. Moreover, these institutions remain the beneficiaries of significant explicit and implicit subsidies from central banks and governments. The new orthodoxy also generally failed to bring about a rapid restructuring of private debt. Outside the financial sector, though, particularly in the U.S., bankruptcy procedures resulted in significant reductions in household debt after house prices crashed. In the U.S., the new orthodoxy generated a recovery that was feeble by historical standards, but not too bad for an economy hit by a financial crisis, particularly one far too large to gain much from export-led economic growth. In other crisis-hit countries, the economic rewards were far slower in coming. The UK's austerity program, launched in 2010, removed fiscal support for recovery, and, together with the falling output of North Sea oil, adverse shifts in the terms of trade and rising domestic prices of imports, resulted in economic stagnation for a further 3 years. The outcome was far worse in crisis-hit parts of the Eurozone, where the approach taken was close to liquidationism. In brief, the short-term record of the new orthodoxy was far from a catastrophe, but it could have done far better. In particular, it failed to provide adequate support for demand, partly because of premature fiscal tightening. A widely promoted alternative to the new orthodoxy has been liquidationism, reliance on the free market without fiscal or monetary policy support. This approach has limited support among academic economists, but substantial support among active participants in financial markets, including some successful speculators. Friedrich Hayek recommended this approach in the 1930s, as, famously, did U.S. Treasury Secretary Andrew Mellon. In 1933, Irving Fisher explained the dangers of debt deflation, which can lead to much misery and, at worst, the replacement of democracy by authoritarianism, of the left or right. Under German influence, the Eurozone's policy doctrine borders on liquidationism, though the Eurozone Central Bank has been relatively aggressive and some fiscal support has also been granted. As discussed in Chapter 9, the chosen policies consist of fiscal austerity, asymmetric adjustment of competitiveness, with virtually all the adjustment falling on deficit countries, and limited assistance with recapitalization of banks in crisis-hit countries. The ECB is handcuffed by exaggerated fears of inflation, notably in Germany, and so is resistant to the idea of quantitative easing or other controversial policies, such as significantly negative interest rates. Unfortunately, deflationary liquidationism is sure to be a part of the adjustment process in a currency union with ultra-low overall inflation. Thus, if inflation remains low in the competitive economies, deflation is needed in less competitive ones. Not surprisingly, therefore, the Eurozone's policies have generated deep and prolonged recessions in the crisis-hit countries. How might policymakers go beyond the new orthodoxy but in the opposite direction to liquidationists in addressing the short-term challenges. The alternatives would consist of more aggressive fiscal and monetary policies, together with forced recapitalization of banks and far more rapid write-downs of doubtful debts. An important element of monetary policy would be temporarily higher inflation, aimed at generating negative real interest rates. Such policies would generate far stronger recoveries. A yet more radical short-term alternative exists: helicopter money. In other words, the government would send money to taxpayers, financed by the central bank. When people deposit this new money in their bank, they would obtain a deposit, and the check would simultaneously obtain a deposit at the central bank. What would make this policy different from conventional quantitative easing is that the new reserves would be permanent. Otherwise, when the central bank wished to tighten, it would find monetary policy ineffective because bank reserves were no longer scarce. It is the ability of the central bank to make reserves scarce that allows it to set short-term interest rates. The central bank would then have to offer interest rates on the new reserves instead. That would make such reserves more like standard short-term government borrowing. To avoid this, the central bank needs to raise reserve requirements, in which case only reserves above that new requirement would be relevant to monetary policy. This would, of course, be a step in the right direction of the Chicago Plan for 100% reserve banking, discussed in Chapter 6. It would also be a tax on the banking system that would, presumably, be passed on to customers. Forcing people out of banks into other forms of saving, better suited to bearing risks, would be one of the aims of this policy. Some will argue that the time for focusing on short-term recovery has passed. This is wrong. Given the scale of the slumps, policy should seek to generate many years of above-trend growth, as argued in Chapter 8. In the U.S., for example, it would take 10 years of economic growth at 4% to return the economy to its pre-crisis trend. In the UK, it would take close to 5% growth over a decade to achieve the same thing. The risks of inflation would rise if expansionary policy were aggressive, but the ability to expand output might prove far greater than pessimists suppose. The long period of low or even no productivity growth suffered since the crisis might, with expansionary policies, be followed by a period of above-trend productivity growth. In the cases of the U.S. and the U.K., GDP and GDP per head both went back above their pre-Great Depression trends in the post-Second World War period, despite the vast output losses of that time. The U.S. fully recovered its long-term trend level and rate of growth of GDP per head at purchasing power parity, which was 1.9% a year from 1870 to 2007, after the Great Depression and the Second World War. Since the 2007-2009 crisis, however, it has been below that rate. The UK did far better than recover its growth trend after its desperately poor interwar performance. Trend growth of the UK's GDP per head was a mere 1% a year from 1870 to 1950. From 1950 to 2007, it jumped to 2.3%. Since 2007, the growth rate has looked more like the pre-Second World War trend. This had not changed by 2014 despite the recovery, since productivity growth remained worryingly absent. Thus, even when financial crises cause huge recessions, financial crises need not leave permanent marks on the level of output, even though it will take a substantial number of years to return to the prior trend. But to achieve such a positive result would require fiscal and monetary policies of the type risked during the Second World War. Huge fiscal deficits combined with monetary policies aimed at keeping both short and long-term interest rates extremely low. That is beyond anybody's peacetime imagination, just as it was during the 1930s. As a result, it now looks as though crisis-hit economies might never regain pre-crisis trend levels of output or even their pre-crisis rates of economic growth. long-term health, challenges to crisis-hit economies. Putting the crisis securely behind the high-income economies is the immediate challenge. Then comes the search for healthy and sustainable economic growth. The problems with the new orthodoxy become far more evident when we start looking at longer-term horizons. One obvious difficulty is that the application of today's orthodoxy would probably not have prevented the financial and economic crisis the world experienced after 2007. A core element of the new approach is macro-prudential regulation, as discussed in Chapter 7. Yet think about the following counterfactual. Suppose policymakers had indeed succeeded in raising the capital requirements on lenders, borrowers, or both during the early to middle years of the first decade of this century. Suppose, too, they had succeeded in reducing the scale of the asset price bubbles, credit expansion, investment in construction, and financial sector leverage. They would then have slowed the rise in private spending and so generated a weaker economy, higher unemployment, and lower inflation. How would the policymakers have responded? Given their mandates, the most likely response of central banks would have been to lower interest rates still further, to encourage more borrowing, thereby undermining the efforts of the macro-prudential regulators. This conflict between the macro-prudential regulators and the monetary policymakers is precisely what one has seen in the UK in 2014. In other words, given the drivers of the savings glut, or if one prefers, given chronic demand deficiency, and so the threat of secular stagnation, internal balance, meaning demand growing in line with potential output, would only occur in high-income countries, taken as a group, if credit and broad money grew significantly faster than nominal GDP. Under current conditions, the price of attaining macroeconomic equilibrium seems to be monetary and financial disequilibrium, unless some other radical change is made elsewhere in the world economy. Other important longer-term elements in the new orthodoxy are higher capital requirements and worked-out resolution regimes for failing institutions. Both are important. The question, however, is whether either has been taken to a point of workability. My answer is that capital requirements are still too low, as noted in Chapter 7. There is still too much reliance on inherently fallible risk weighting, which is highly vulnerable to gaming by insiders, and the ability of the authorities to resolve systemically significant institutions in a crisis remains uncertain. Nevertheless, a combination of macro-prudential policies with somewhat higher equity requirements and other changes should make the financial sector and the economy at least somewhat more resilient. Supporters of free markets would insist that the answer is to rule out any form of bailout and let the chips fall where they may. Such is the influence of this position that, in the U.S. at least, another TARP, which was the acronym standing for Troubled Asset Relief Program, seems worryingly unlikely, even if it were at some point essential. The disillusionment with a rescue that restored profitability to finance, but not a vibrant economy to ordinary people, is understandably influential, though the rage ignores the damage to ordinary people that would have been inflicted by a financial meltdown. Some even argue that there should be no central bank able to act as lender of last resort. The logic behind the no bailout position is that it would make everybody more prudent. There are, however, difficulties with this position. Among these is the fact that financial crises are not necessarily the product of expectations of a rescue. Almost certainly, more important are false beliefs about the uncertain future. The belief in the middle of the last decade, for example, that house prices would rise forever, that the securitized financial assets discussed in Chapters 1 and 4 would always find willing buyers, and that crucial funding markets would always remain liquid. Of course, the existence of insurance creates a degree of rational carelessness about such risks, which is why it must always come with substantial risk of loss and regulatory oversight. As important, the chain of bankruptcies triggered by an unchecked financial crisis harms the innocent along with the guilty, and sound parts of the economy with the unsound. It was such secondary effects, mass bank failures, collapse of the money supply, soaring real rates of interest, and debt deflation, that turned the post-1929 stock market crash into the Great Depression. In the same way that we have fire services and fire standards to prevent a fire in one building from becoming another Great Fire of London, so we now have regulatory standards, central banks, and, in extreme cases, government-financed backstops to prevent the failure of a few institutions from turning into another Great Depression. Moreover, rescue facilities, particularly if limited in scope, should not encourage excessive financial imprudence, because those who make bad decisions still suffer harsh penalties to their finances, their reputations, or more often both. Yet, liquidationism is still quite correct on one thing. Shareholders should never be rescued. There should also be a clear order of conversion of debt into equity in a well-defined resolution regime that allows financial institutions to continue to function. Only in extreme circumstances should a government rescue be contemplated. But in democracies, governments will always respond to the public's desire for basic security. Outright collapse of the core financial system cannot be permitted. If pure liquidationism is unnecessary, unworkable, and unbearable, the new orthodoxy is also insufficient. Additional steps are needed in 6 areas. The first is making the financial system even more resilient than under current plans, as Chapter 8 argues. The most important elements of such reform are higher capital requirements and more bail-inable debt. Unfortunately, there is a trade-off. The higher the financial institution's equity capital, the less necessary bail-inable debt would be. If, for example, the leverage of a bank were not to exceed, say, 4-to-1, the need for bail-inable debt might disappear, greatly simplifying the regulatory task. Also important is proper funding of regulatory bodies and investigators of criminal misbehavior. This is not just a matter of guarding against malfeasance before the event. It is also a matter of giving the population at large a sense of justice after it. If the guilty go unpunished, it becomes far more politically difficult to do what is needed to rescue the innocent. The second area is deleveraging the economy. The simplest way would be to eliminate the tax deductibility of interest. Some argue that this would reduce levels of real activity, since a great many people are unwilling to take equity risks. If so, an alternative would be to make a standard tax deduction for the cost of equity. In that case, the tax treatment of debt and equity would be more equal. A properly constructed tax on land value would also help. This would not only be just, since it would appropriate to society gains that are generated by the investment of others, including the state, not by the effort of the individual beneficiary. It would also play a powerful role in ameliorating the speculation in land values that lies at the heart of each and every property-related credit boom. The third area is wider reform of corporate taxation and governance, to reduce the accumulations of excess savings. Incentives to accumulate financial claims inside the corporation are quite likely, though not certain, to lead to an increase in the excess of desired savings over investment, a big problem during a global savings glut. One solution would be to abolish corporation tax and attribute all corporate income to shareholders. This would encourage higher distributions of profits. Alternatively, shareholders could offset corporate tax against their own individual tax payments, as was done in the advanced corporation tax system of the UK prior to 1997. It would also be possible to raise corporation tax while increasing investment incentives. Again, the effect would be to encourage distribution of any profits over and above those needed for investment. In addition to these changes, as Andrew Smithers has argued, there is a powerful case for attacking the bonus culture, which leads management to underinvest in capital goods and overinvest in share buybacks. The fourth area is changes in financial contracts. The idea would be to create debt contracts that automatically adjust to circumstances. Index-linked debt is an example. The nominal value depends on the rate of inflation. Similarly, the nominal value of mortgage debt could be indexed to house prices. If house prices rose above a certain amount, lenders would share in the gain, and, similarly, if house prices fell, lenders would share in the losses. Such contracts might be an attractive way for investors to gain from rising house prices without having to put together portfolios of houses. They would also reduce the need for foreclosures. The fifth area is income redistribution. Rapidly rising inequality is one reason why rapid credit growth is needed to generate adequate demand in high-income countries. If so, income could be redistributed through the tax system to people who would actually spend it. The French economist Thomas Piketty recommends substantially higher taxes on very high incomes, as well as a global wealth tax beyond the land tax alone. This is unquestionably too ambitious, but movement in these directions is desirable and should even be possible. Not least, that would be a way to force the winners from globalization and technological innovation to provide some compensation to the losers. The final area consists of policies aimed at raising the longer-term rate of economic growth. Obvious policies to consider are support for scientific research, support for research and development, support for relevant education, greater incentives for investment in the private sector, tax reform, willingness to use the public sector balance sheet in order to raise investment, particularly in infrastructure, and development of new financial institutions designed to support small and medium-sized businesses. Perhaps the most important area of financial innovation is public-private partnerships in national or regional developed banks. Perhaps the most important area of tax reform is a shift from taxes on effort, that is, work, to taxes on bads, such as pollution, including carbon emissions, and taxes on wealth, particularly but certainly not exclusively on land. What I have called beyond the new orthodoxy, while highly desirable, also remains within the context of the current conventional wisdom. The ideal way to go beyond it, at the national level, would be to adopt something closer to the Chicago Plan or similar radical monetary proposals for safe deposits and direct creation of money by the central bank. In other words, the monetary system would be built around 100% backing for standard deposits. Meanwhile, other intermediation would be done either on a mark-to-market basis or with substantial equity requirements. Investors would have to accept substantial risk if they desired high returns. It would remain important to avoid the emergence of a shadow banking system able to destabilize economies. Thus, it would be crucial to curb excessive credit creation and maturity mismatches outside the banking system. That would continue to require regulatory oversight. But if the payment system were unquestionably safe, regulators might be able to be more relaxed than in the past about failure elsewhere. Long-term health. Challenges for the Eurozone. Now turn to the challenges specific to the Eurozone. The crisis has raised questions about the longer-term institutional preconditions for a workable currency union. In accordance with the views of Germany, the reformed Eurozone is designed as a system for imposing discipline upon wayward countries. It is a discipline union. As currently designed, management of the Eurozone eviscerates national economic sovereignty over almost all important areas of economic policy, but rejects notions of collective insurance, at least in principle. In essence, then, member countries are free to do precisely as they are told. The Eurozone has achieved an almost complete separation of responsibility for deciding policy from political accountability for its consequences. The tension between the desire of people for a say in how they are governed and the reality of how power is exercised in the Eurozone surely guarantees a huge political crisis at some point in the future. Moreover, these external disciplines are also bound to be of varying effectiveness, since some countries are so much more equal than others. It is unlikely, for example, that the envisaged discipline would work on France, let alone Germany, should either get into serious difficulties with private debt, public debt, or, more likely, both. That might also happen. As Piketty notes, Germany was the country that, more than any other, drowned its public debt in inflation in the 20th century. Currently, a return to those bygone ways seems inconceivable. But, particularly in view of the rapid aging of the German population and the low birth rates, it is not inconceivable that some large negative economic shock could make inflation seem less undesirable at some point in the future, even to Germans. In the history of the Eurozone, a liquidationist alternative existed, to which a number of commentators, especially in Germany, return. It is the no bailout concept enshrined in the original Maastricht Treaty. In practice, however, the financial, economic, and political pressure for bailouts became overwhelming once the crisis hit. Such bailouts have come in two ways: open support from member governments and the IMF, and much larger and more tacit programs of support from the ECB. The option of a complete refusal to recuse countries or banks that fell into trouble would have created waves of defaults and almost certainly a breakup of the Eurozone. Creditor countries did not want the Eurozone to break up. That would have created costly adjustment problems for themselves, big losses for their own banks, and huge losses of export competitiveness. It was far less embarrassing and less damaging to bail out their overexposed lenders indirectly, not to mention sustain the existence of the Eurozone, via support for the debtors. Exposed bankers were obviously enthusiastic about this rescue. Moreover, emergency support was always a way to ensure, or seek to ensure, that the cost would be borne by the hapless taxpayers of crisis-hit countries. Meanwhile, governments of crisis-hit countries were prepared to promise almost anything to avoid sovereign banking or sovereign-cum-banking defaults. This was partly for good reason, given the huge primary fiscal deficits and current account deficits bequeathed initially by the crisis. To be cut off from financing overnight would have imposed huge adjustment costs. Thus, extreme liquidationism failed. The situation in the future will not be different. Yet in some ways, liquidationism, alas, also succeeded. Crisis-hit members are caught in an extreme demand shortage. Their governments have to tighten their fiscal position, while the private sector is dependent on borrowing from banks no longer able to gain ready access to foreign funds. The countries are forced to follow the German model of the early to mid-2000s by moving towards an external surplus, but in less auspicious external circumstances. This requires a big improvement in competitiveness, driven by wage suppression and rising productivity, or, more bluntly, mass unemployment. The standard tools of liquidationism, depressions, mass bankruptcy, and mass unemployment, are needed to deliver this outcome. The Eurozone might even be described as structurally liquidationist. It is easy to understand why people argue that one should let the medicine work unchecked, however bad the side effects. It is like chemotherapy, a cure that comes close to killing the patient. But this liquidationism is also tempered in practice, making its results slower and the treatment not quite as brutal as it would otherwise be. Yet did member countries really bargain for such a liquidationism light? Might it then be possible to temper the liquidationism, while also avoiding the onerous limits on sovereign discretion of the Eurozone's new orthodoxy? Yes. The most important requirement of all is a far more symmetrical adjustment, what one might call an adjustment union. Thus, after a crisis, inflation would rise in the surplus countries, offsetting the falling inflation of countries in external deficit. The way to achieve this would be for the ECB to embrace unconventional measures such as quantitative easing, negative interest rates, and even temporarily higher inflation targets. QE could be done by purchasing bonds of all Eurozone governments in proportion to their share in the Eurozone economy or in the capital of the ECB. Another requirement is still better insurance against economic disaster. The ECB is doing some of this job by providing insurance for sovereigns, though the workability of its OMT program in support of sovereign bond markets is still unknown, since it has not yet been tried. The advantage of greater formal insurance for banks or sovereigns via joint backing of deposit insurance funds, backup funds for bank recapitalization, or even a measure of shared bond insurance, is that this would limit the scale of the catastrophes that afflict crisis-hit countries. The disadvantage is that such mechanisms delay needed adjustment. Permanent subsidization of uncompetitive economies would certainly be a dreadful outcome. The Eurozone might then turn much of the northern Mediterranean into something like the Italian Mezzogiorno. The challenge is instead to devise effective mechanisms for emergency support, while promoting adjustment and competitiveness rather than preventing it. A final element should be conscious promotion of equity flows, rather than lending, and in particular bank lending, across borders inside the Eurozone. In the absence of a true banking union in which banks operate symmetrically across the entire Eurozone, bank lending should be actively discouraged and equity flows encouraged. For the Eurozone, radical reconstruction would mean moving in one of two opposite directions, though one could imagine both happening for different countries. One direction would be a move towards federal union. The banking system would then have a federal backstop and access to safe, federally issued debt, Eurobonds of some kind. There would be a shared fiscal system and a shared treasury. It need not be large, but it would be large enough to provide insurance for the banking sector and for member states. Yet such a federal state was impossible at the time of the negotiation of the Maastricht Treaty in 1990 and 1991. The sense of mutual responsibility needed to create such a federation appears, if anything, even more absent today. The alternative radical direction would be the opposite one, towards a degree of disintegration. This would mean abandoning the idea that capital market integration is always desirable, or even, for some members, giving up the euro itself. Given the inability to create and sustain a Eurozone-wide financial system with a Eurozone-wide fiscal backstop, a logical alternative would be to segment the financial system and so permit national governments and/or national central banks to impose controls on capital flows. By accident more than design, the exchange controls adopted by Cyprus after its banking crisis would show the way. It is particularly important to curb cross-border funding of banks as part of country-oriented macroprudential regulation. Of course, this would be a violation of the explicit goals of the Eurozone, but attempting to achieve this has not worked too well. It might be more sensible to accept that even inside a currency union, finance should be domestically focused and managed. Of course, the logical extreme of such a course is a breakup of the Eurozone itself, notwithstanding all the risks. In brief, under German influence, the Eurozone has sought to introduce a combination of more discipline upon sovereigns, a discipline union, with liquidationism, but a liquidationism only imposed on the crisis-hit countries. This is an undesirable and possibly even unworkable solution, which has imposed huge costs on the peoples of some member countries. Something different has to be tried. Far and away the most important change would be a move towards more symmetrical adjustment, a proper adjustment union, in other words. The ECB should work to achieve that by trying far harder to sustain Eurozone inflation at 2% at the least, if not higher. It is worth noting, after all, that West German and subsequent German inflation averaged close to 3% even under the Bundesbank. It's also essential to provide a bigger and better temporary backstop for crisis-hit countries and banks than is now envisioned, though permanent subsidization of weak economies would be a disaster. Finally, losses need to be borne by creditors as well as debtors. The former are just as guilty as the latter. A truly federal union, though the logical complement to a currency union, is unavailable. A sensible alternative, therefore, would be partial segmentation of the financial sector, with much more emphasis on cross-border equity flows and far less on the integration of banking. Controls on cross-border debt flow, especially banking flows, might even be viewed as necessary conditions for survival of the Eurozone, rather than, as now, be deemed incompatible with it. Should such controls and a bigger safety net be ruled out, then sometime after the crisis is over, consideration might be given to a partial breakup of what has proved an enormously costly arrangement. Maybe some of the creditor countries should leave first. Long-term health. Global challenges. Now turn to the twin global challenges. The first issue is the future of globalized finance. The second is the future of global capital flows, or, more broadly, of the balance between demand and supply at both national and global levels. The aim of the new orthodoxy is to preserve a globally integrated economy, including an integrated global financial system, while recognizing the threats to stability created by such a globalized economy. In the case of finance, the attempt to contain some of the adverse consequences of integration is driven by risks to fiscal solvency and, more importantly, to domestic economic stability. In response to such fears, proposals for ring-fencing domestic banking from global finance make powerful sense. This is particularly true for countries that are host to banking systems with huge assets and liabilities relative to domestic banking and the domestic economy. This might be called the Iceland trap. But it was also relevant to the Netherlands, Switzerland, and the UK. A similar concern is raised by reliance on short-term foreign funding rather than domestic deposits, which was important for Ireland, Spain, and the UK. Macroprudential policy is designed to ensure domestic financial and macroeconomic stability, regardless of what happens in the world economy. Thus, in these important respects, the reaction to the crisis has, quite properly, been one of disintegration. This reflects the obvious truth that unless regulation and the supply of fiscal backstops is to be much more global, finance should be far less so. Would anything important be lost in the process of diminishing the global integration of banking? Not obviously. At the same time, global agreement on regulatory standards is designed to preserve as much of the integrated global finance of the pre-crisis era as possible. Again, there has been some success with this approach. The result of all this effort is a complex balance between national responsibility and global finance. Not surprisingly, almost everybody is dissatisfied. The global outcome on macroeconomics is also evolutionary. The resources of the International Monetary Fund were increased in response to the crises, but they remain only a little over 10% of the stock of global foreign currency reserves. The need for countries that do not produce a reserve currency to insure themselves via reserve accumulations remains strong, and so is the urge to limit current account deficits. Again, the so-called Mutual Assessment Program of the G20 leading economies may have had some influence on securing a better balanced global adjustment process, but it's a small step towards a more rational net flow of capital. Again, liquidationists offer an alternative to the new orthodoxy. Eliminate controls on cross-border finance, abolish international financial organizations, and go back onto gold. Many in this camp would also abolish fractional reserve banking. This would reduce backing of bank deposits to the supply of gold and increases in the supply of money to whatever mining would produce. To understand how absurd this is, note that the global stock of bank deposits amounted to $54 trillion at the end of 2010, while the value of the world's total stock of gold, including jewelry, at prices at the end of 2013 was about $6 trillion. Full gold backing of the broad money supply would require at least a tenfold rise in prices. This would redistribute global wealth in favor of gold speculators and miners. Why would anybody want to do that? Moreover, this assumes that jewelry would be converted into monetary gold. Otherwise, the price would need to be more than $20,000 a troy ounce. Realistically, gold backing of bank deposits is infeasible. A more plausible possibility would just be gold backing of notes. But the more limited the backing of the money supply, the greater becomes the risk of uncontainable panics. Backing for banks would have to come for some form of government liability. This would then become a gold exchange standard, which proved highly unstable after the First World War. The international gold standard is just a particularly rigid form of fixed exchange rate arrangement. If one wants to understand the problems of such arrangements, in modern circumstances, one need merely look at what happened in the 1920s and 1930s, and more recently in the Eurozone. Fixed exchange rates are a recipe for instability. For small open economies with flexible labor markets, such as Hong Kong or the Baltic states, this may be better than the instability generated by floating exchange rates. For larger economies, the idea that the exchange rate should dictate monetary policy is less sensible. It's also inconceivable that the U.S. would follow such a rule. It did not do so after creation of the Federal Reserve in 1913, even though the dollar was notionally tied to gold until 1971. In brief, the idea that the world will go back to gold-backed money, or the International Gold Exchange Standard, is a fantasy. It will not happen, and, given the disasters it created after the First World War, it should not either. There are two other directions in which the world economy might go. The first is towards far greater segmentation of the world's financial system. This would be a consequence of varying national preferences about the sort of financial system each country, or groups of countries, wanted. Imagine, for example, that a country decided to adopt far higher capital requirements, or far more onerous restrictions on the payment of bonuses than others. It is likely, at least in the short to medium run, that this would lead to regulatory arbitrage, attempts to get round the rules by going offshore or in other ways. Authorities would surely respond by seeking to restrict access of foreign-based finance to the domestic market. That, in turn, would lead to segmentation of the global financial markets. In such a world, investment banking, and particularly trading in global markets, might become the prerogative of banks whose home authorities have confidence in their ability to regulate and back them wherever they operate. The consequence would surely be a decline in global market liquidity. But it could also be argued that market liquidity is a dangerous illusion. An illusion because it is sure to disappear when it is most needed. Dangerous, too, because confidence in the ability to dispose of unwanted assets encourages inadequate research by investors into the quality of assets they are buying, over-reliance on rating agencies, excessive confidence in risk models, overextended agency chains, and so markets whose liquidity is built upon pervasive ignorance. Global financial integration has value, not least because it allows investors to diversify their risks more widely and businesses to obtain their funding more cheaply. But it doesn't have an overriding value, particularly if it generates wasteful spending or increased economic instability. The same is true for flows of capital. Over the period prior to the crisis, capital flows in huge net quantities from countries that generated vast surpluses, China, Germany, and others, to countries that, it turned out, could not use it productively. The result was excess, waste, and crises. Much of the flow of surplus funds was the result of deliberate interventions in foreign exchange markets and consequent accumulations of foreign exchange reserves. Yet transferring the excess savings of the Chinese into the wasteful consumption of Americans made no sense. Generating a huge financial crisis as a result was worse than senseless. John Maynard Keynes stressed the concern that huge current account surpluses might prove incompatible with macroeconomic stability in the years leading up to and then at the Bretton Woods Conference in the summer of 1944, which laid the ground for the post-war international monetary system. But the U.S., the dominant surplus country of the time, ensured that next to no constraints were imposed on the surplus countries. The same has effectively been true inside the Eurozone. As is normally the case, adjustment is imposed solely on deficit countries. The U.S., as issuer of the world's reserve currency, is not forced to adjust in the same way, since it faces no constraint on financing. The rest of the world will accept the dollars it creates. It is possible to imagine mechanisms that would force symmetrical adjustment, beyond more robust naming and shaming by the IMF and other outside entities. Countries might impose tariffs or other trade measures on exports from surplus countries. Alternatively, they might tax foreign holdings of domestic assets, particularly government bonds. Finally, they might intervene in currency markets, but all such ideas run into substantial difficulties. First, what would be the trigger for such action? Would it be estimates of exchange rate undervaluation, the scale of current account surpluses, or the size of reserve accumulations? Second, who would determine that what was happening was unacceptable? Would it be an international organization, the IMF or the World Trade Organization? Or would it be the affected country or countries? Third, who would ensure that the action taken was proportionate, in scale or duration? Fourth, would it be possible to obtain the acquiescence of powerful surplus countries, particularly China? Fifth, what could be done within a currency union? This would really not be at all easy. If the IMF had far bigger resources available to support countries in temporary difficulties, emerging and developing countries would not need to accumulate such huge reserves. Such insurance might encourage countries to accept larger current account deficits, particularly ones that have already accumulated large reserves. Alternatively, the swap arrangements among central banks might be extended to a greater number of qualified recipients, including more central banks in emerging economies. A still more radical approach would be to encourage net capital outflow from high-income countries in order to finance greater investment in low-income ones. Governments in the former might have to insure some of the risks. There would be losses, but they might still be smaller than those incurred in importing what turned out to be wasted foreign capital. Finally, if attempts to rebalance global accounts on a durable basis failed, it might be necessary for high-income countries to accept large fiscal deficits as a counterpart of higher public investment. Provided the investment brought sufficiently high returns, this should also be a stable solution. There exist two more radical proposals that go partly in opposite directions. They are also parallel to the most radical alternatives for the Eurozone, which consist of either moving to a federal union or breaking up the Eurozone, in whole or in part. In the global case, the most radical outcomes would be the creation of a global money to replace the national monies, principally the dollar, currently used as anchors of the system, or a partial breakup of the open world economy. Justin Lin, the Chinese former chief economist of the World Bank, argues that the expected move from dominance of the U.S. dollar as a reserve currency to a multi-currency system, with the euro and the yuan playing a bigger part, is just as likely to prove destabilizing as stabilizing. True, competition among currencies should impose greater discipline on the Federal Reserve's monetary policies, but sudden swings in preferences among different currencies might generate substantial instability. Professor Lin's suggestion, which harks back to the plans for Bancor, a global currency Keynes proposed at the Bretton Woods Conference in 1944, is for a new global currency that he calls paper gold, or P-gold. P-gold would, Mr. Lin suggests, be produced according to some rule, possibly a constant rate of growth, as suggested by Milton Friedman. The creation of the new currency and issuing central bank would, suggests Mr. Lin, be governed by an international treaty. Crucially, national currencies would have fixed, but adjustable, pegs against P-gold. The well-known trilemma that a country cannot simultaneously enjoy monetary policy freedom, absence of exchange controls, and fixed exchange rates means that countries would then either lose monetary policy freedom, except when they choose to adjust their pegs, or have to impose exchange controls. But experience with adjustable peg currency systems, in the absence of tight exchange controls, shows they can be highly destabilizing. That was the lesson of the crises in the exchange rate mechanism of the European monetary system in the early 1990s, and again of the Asian crisis of 1997-98. An additional disadvantage of this proposal is that from time to time, panic would shift liquidity preferences dramatically. The envisaged treaty-bound monetary rule would then either impose a massive shortage of safe global liquidity, or the issuance would have to rise to accommodate the crisis-led increase in demand. But that would mean the creation of what amounts to a global central bank. There is no possibility of agreement on such an arrangement in the absence of some kind of a world government. If it were agreed, the world would have created many of the difficulties of the Eurozone. For such reasons, many, probably the vast majority, of countries would reject the plan, certainly including the U.S. and the Eurozone. If it were accepted, there would also need to be pervasive exchange controls. Ironically, that would then lead to the same outcome, indirectly, as the other possible path for reform of the global financial system, towards limits on financial integration. This would free countries to adopt the monetary and financial systems they prefer, or pursue the monetary policies they want. Such disintegration might still seem unthinkable, yet the world might be no more than one or at most two huge crises away from such a radical deconstruction of globalized finance. The financial opening of the past 3 decades might yet go into reverse. The evolutionary approach being taken to reform of the global financial and monetary systems is unlikely to prevent further crises. Further financial disintegration and greater discipline over global imbalances will almost certainly be needed. Beyond that, there exist radical ideas for new global currency arrangements that would also provide more discipline, yet there is no chance of their being adopted. If so, the obvious alternative is to give up on full global financial integration. In the context of the current global monetary system, which largely reflects continued national sovereignty, financial integration has proved highly destabilizing. It might have to be sharply curtailed. The challenge of radical reform. The world is not going to go back to a 19th century free market. The ultra-limited state is unacceptable to universal suffrage democracies, even if one believed it desirable. I do not. Provision of social insurance and public consumption is a legitimate function of a wealthy state. The world is, instead, going to try the limited reforms of what I have called the New Orthodoxy. The question is, how far should it go beyond this? That partly depends on what sort of recovery emerges. But it also depends on how much risk societies will be prepared to take. Some argue that we do not need to protect ourselves even against huge global crises if they only occur every 80 years or so. But that is far too insouciant. For decades after the Great Depression, finance was caged by extreme caution and tight regulations. The global system we know today began to emerge at most 40 years ago. Since then, it has generated huge credit booms and massive crises, culminating in the advanced economy financial crisis that began in 2007. It seems a good bet that this will continue, if not firmly and powerfully checked, until governments are no longer able to prevent some kind of fiscal or monetary collapse. Thus the insouciant position that we should largely let the pre-crisis way of running the world economy and the financial system continue is grossly dangerous. We also know it is possible to run economies without financial crises. That is what happened between 1950 and the mid-1970s in high-income countries. The reason there were no crises is simple. Finance was caged. The advanced economies also did very well at that time, though that was partly because of the exceptional opportunities afforded to the technologies and markets first developed in the 1920s, 1930s, and 1940s. We don't know how much we would lose if we made a bigger effort to curb finance, and in particular, to separate more fully the core monetary system from our risk-taking financial system, as radical proposals suggest. The chances are that the economic losses would be small, if not actually negative. The social and political losses and gains are even harder to determine, but they, too, might be modest or, even more likely, highly negative. The evidence suggests that more finance equals more development, but only up to a point. Today's high-income economies seem to be well beyond that point. Leveraging up existing assets is just not a particularly valuable thing to do. It creates fragility, but little, if any, real new wealth. What I call the New Orthodoxy goes in the right direction, but not far enough. This approach, an attempt to get a bigger recovery now, followed by far bigger reforms of the financial system and of the management of the global and Eurozone economies, is the least we need. That means more aggressive use of fiscal policy and radical monetary policies in the short run. It also means far more equity capital in financial institutions, as Anat Admati of Stanford University and Martin Hellwig of the Max Planck Institute argue. It should also mean more symmetrical adjustment in the Eurozone and a more balanced global monetary system, buttressed by stronger insurance mechanisms. Is this going to happen? Very unlikely is the answer. But it should. It's the least we need to do to lower the probability of still bigger crises in the future. The ideas of the Chicago Plan for monetary and financial reform, or similar radical rearrangements, are, as Mervyn King argues, also intellectually compelling. He writes, "Another more fundamental example of reform would be to divorce the payment system from risky lending activity, that is, to prevent fractional reserve banking. In essence, these proposals recognize that if banks undertake risky activities, then it is highly dangerous to allow such gambling to take place on the same balance sheet as is used to support the payment system and other crucial parts of the financial infrastructure. And eliminating fractional reserve banking explicitly recognizes that the pretense that risk-free deposits can be supported by risky assets is alchemy. If there is a need for genuinely safe deposits, the only way they can be provided, while ensuring costs and benefits are fully aligned, is to insist such deposits do not coexist with risky assets. A system that is based, as today, on the ability of profit-seeking institutions to create money as a byproduct of often grotesquely irresponsible lending is irretrievably unstable. The monetary system is not the only reason stability destabilizes, as Minsky argued, but it is probably the most important. Far too much credit and money are created in good times, and then far too little in bad times. The complex public-private partnership that underpins today's monetary and payment systems also forces public institutions to stand behind the irresponsibility and even malfeasance of private ones. It is little wonder bankers are irresponsible. They know that bank debt has a good chance of being treated as if it were public debt. Indeed, in several crisis-hit countries, bank debt has been treated as more sacrosanct than sovereign debt. Ordinary taxpayers are being forced to suffer in order to save a banking system that has brought them only excess and ruin. This is intolerable. Indeed, a form of debt slavery. Just ask the Irish. Beyond these direct fiscal effects are the vast fiscal and economic costs of the busts. No industry should have the capacity to inflict economic costs that may even surpass those of a world war. Happily, it is possible to imagine a system based on full government creation of transactions money, along with a number of different legal and institutional treatments of the public's investments. The latter would be backed by assets that are explicitly risky. Those risks would then be clearly borne by final investors, not ludicrously undercapitalized intermediaries. Today, nobody has the nerve to try such a radical scheme. But it would be wonderful if some countries dared to experiment with such a reform of today's inherently unstable financial and monetary systems. Indeed, the need for more experimentation and more diversity of experience seems to be one of the big lessons of past failures. Too many countries are being forced to adopt much the same arrangements under the pressure of orthodoxies imposed by global institutions under the control of a limited number of hegemonic powers. That should end. Why this matters. Why, finally, does this matter? The answer is that financial crises do more than impose huge costs. They have bigger and more insidious effects. We face big challenges in maintaining the supply of global public goods as the world integrates. But these challenges will not be managed successfully if we do not first overcome the legacy of the crisis. Moreover, all this must be done at a time of transition in global power and responsibility from a world dominated by Western powers to one in which new powers have arisen. Inevitably, such crises also help undermine belief that a globalizing economy is of benefit to the vast majority of people. They make people anxious and angry, and rightly so. Angry and anxious people are not open to the world. They want to hide in their caves together with similarly angry people. That is what happened in the 1930s. Financial crises are the events most likely to bring the world back there. Equally, inevitably, crises undermine confidence in the elites. In democratic societies, a tacit bargain exists between elites and the rest of society. The latter say to the former, "We will accept your power, prestige, and prosperity, but only if we prosper too." A huge crisis dissolves that bargain. The elites come to be seen as incompetent, rapacious, or in this case both. The political results may come slowly, but come they will. Then, there are three huge failures of the Western elites. First, the economic, financial, intellectual, and political elites misunderstood the consequences of headlong financial liberalization. Lulled by fantasies of self-stabilizing financial markets, they not only permitted but encouraged a huge and, for the financial sector, profitable bet on debt. The policymaking elite failed to appreciate the risks of a systemic breakdown. The financial elite was discredited by both its behavior and its need to be rescued. The intellectual elite was discredited by its failure to anticipate a crisis or agree on what to do after it had struck. The political elite was discredited by their willingness to finance the rescue, however essential it was. The decline in confidence in these elites is even worse if the methods used to rescue the economy then make the parts of the elite most associated with the crisis richer than before. This undermines the sense of fairness that underpins the political economy of capitalism. There has to remain a belief that success is earned, not stolen or handed over on a platter. Second, the past 3 decades have seen the emergence of a globalized economy and financial elite that has become ever more detached from the countries that produced them. In the process, the glue that binds democracy, the notion of citizenship, has weakened. The narrow distribution of the gains of economic growth risks exacerbating this development. Third, in creating the euro, the Europeans took their project beyond the mundane into something far more important. The economic troubles of crisis-hit economies are evident. Huge recessions, extraordinarily high unemployment, mass emigration, and heavy debt overhangs. The constitutional disorder that has resulted remains insufficiently emphasized. Within the Eurozone, power is now concentrated in the hands of the governments of the creditor countries, principally Germany, and a trio of unelected bureaucracies, the European Commission, the European Central Bank, and the International Monetary Fund. The peoples of adversely affected countries have no influence upon them. The politicians notionally accountable to them are powerless. This divorce between accountability and power strikes at the heart of democratic governance. The loss of confidence in the competence and probity of elites inevitably reduces trust in democratic legitimacy. People feel even more than before that the country is not being governed for them, but for a narrow segment of well-connected insiders who reap most of the gains, and when things go wrong, are not just shielded from loss, but impose massive costs on everybody else. This creates outraged populism on both the left and the right. Yet willingness to accept shared sacrifice is likely to be still more important in the years ahead than it was before the crisis. The economies of the Western world are poorer than they imagined 10 years ago. They must look forward to a long period of retrenchment. Making that both be and appear fair matters. Every effort must be made to restore economies to growth, on both the demand and supply sides. Every effort must be made, too, to ensure that a similar crisis will not recur without eliminating those aspects of an open-world economy and integrated finance that are of benefit. This will require more radicalism than most recognize. We must not only learn the lessons about how the world economy went awry, we must also act upon them. If we do not, next time a big crisis arrives, even our open world economy could end in the fire.
This has been a Gildan audio production. For more affordable life-changing audio programs, visit our website at gildanmedia.com.